blow-off move to the highs after inflation didn't seem to scare anybody. We got retail sales, which is probably hitting the tape right about now. And as long as that's not negative, I think it clears the way for the market to continue to drift higher. I did have a Super Bowl that I took off yesterday. It was for today. I put it on 2 days ago for that same thinking. I was like, well, it seems like nobody's scared of inflation, and retail sales will probably end up being positive as well. And we'll just continue to reach new highs. For today, let's put up the schedule. Slight, the usual hijinks that we get on a day like today. We're going to get the normal stuff. But on top of that, we have a special guest at 9 a.m., Puru Saxena, and then we have Cem Karsan joining at 9:30 a.m. Central Time. So it'll be interesting to get his thoughts as far as what SPX floor traders were dealing with over the last couple of days and what led to that big move yesterday. So we're going to talk to those two guys along with the normal stuff we got going on, the usual hijinks, if you will. And then we have trades of the day, of course, kicking off at 11:30. Look, man, it's getting harder and harder to find a trade of the day in this environment. Things are pretty quiet, but we'll find something for you. We'll find something that's interesting. I kick it off at 11:30 a.m. Mike's at 15 minutes after me, and Errol's 15 minutes after that. You guys get the gist. Chris and Ilya also on trades of the day. So we'll provide it for you.
Yeah, those are always solid segments. You get a full 15-minute breakdown of the trade idea, which is always helpful if you are learning new concepts, learning new strategies, or just want reinforcement of those things. But yeah, it looks like it's going to be another doozy in terms of earnings reports here. AMAT down 30 points after the close yesterday. And this was unlike Cisco in the fact that it was just a straight line down, and then we flatlined near the expected move. So we'll see what happens there. But this one going to be a loser in my portfolio for sure, because my long option's only in the 8-day cycle instead of the September cycle like Cisco. So unfortunate move there for sure. But
what'd you do?
Just like 600 strike calendar shred. But I couldn't even take it off yesterday because it rallied up to 550, but the trade was a scratch. So didn't get any profitability out of it. Sad times.
Yeah.
Sad times.
Yeah.
But
I didn't see anything they said, but I imagine, was it data center? I mean, not data center, but was it free cash flow situation?
Yeah, I mean, it's always one or the other.
Great.
But yeah, hopefully we can get some movement in core weave that's beneficial to us, but we'll see. This one is the 195.90 calendar spread. This one was a scratch from earlier this week. I've got just today. I'm surprised that none of these got assigned, honestly. But the 90, 95, 100 strikes all expired today, so I need a downside move today, closer to 100, but it's still trading for a scratch. The reduction in extrinsic value in the shorts offset all of the value in the long. So we'll see what happens, but if we do get a little meltdown today, that position will come in, and that's really what I'm looking for outside of Cisco. Cisco, I need a movement towards 130, 135 over the next couple of weeks. But yeah. Other than that, just seeing what the market will do going forward.
Yeah, when I look at back on the week here, and I'm looking at what's been good, what's been bad. I mean, Dow, Nasdaq, and the Russell are all positive on the week. S&P, Nasdaq, and Russell are all three positive on the week. The Dow is the only one that is negative, and the dollar is negative. It's the third week in a row that the dollar is down. Oil, positive on the week. So that's another one that has bounced back to some degree. Even though it's not trading $90, it is up on the week compared to last week. And gold and silver also positive this week. 3 weeks in a row for gold, 2 weeks in a row for silver. So that's kind of the setup where we are. I mean, again, we're at all-time highs in the S&P. We're not at all-time highs in NASDAQ, but still it's been positive a couple weeks in a row. So things have been good in equities, obviously, and leading the way has been tech, which is interesting. Again, surprising that NASDAQ is not at all-time highs, but tech's been leading the way. Healthcare has been leading the way. So that's kind of been the landscape here recently in a low volatility environment.
Yeah, for sure. And I see some people in the YouTube chat. Looks like Jackie got out of that AMAT yesterday at $6, so made $1. I must have missed that. Maybe I was doing something else. But good on you. Love to see it. And then someone else saying to check out Reddit, which is making moves all the way back up to 176 from 158 closing yesterday. That is an interesting move there, but I don't have any positions in Reddit.
Me neither.
I don't know if you
but yeah, that's it was a S&P 500 ad. It's going into the S&P 500. Woohoo! Stocks making a move. You know what? Also, I noticed late yesterday made a move is Workday, WDAY. Apparently, I guess there was private equity interest, and it was mentioned. Before we always get carried away around here. Let's bring in Chris Vecchio here. Talk about some of these things, what's going on. Yeah, Workday made a strong move in the afternoon, I saw. I don't know if you saw that, Chris, but that was one that was making moves towards the middle of the day yesterday.
Yeah, Silver Lake Partners is apparently buying them out, taking them private. So nice little 25% bounce there. This is Adam Newman's company, right? Or was.
I think so. Yeah, right. Yeah, once upon a time. Yeah.
Absolutely incredible.
I forgot about that guy.
He's still doing things out there. He's got his latest effort, we'll call it.
All he needs is people just to believe in him, Chris. That's all.
That's really all any investment thesis needs. Just got to get a lot of people believing in it. Which is why I'm here to talk to you about Pentair PLC. I'm kidding.
We need that on Friday. We need that on Friday for sure.
Oh man. Yeah, it's trading around 206. Interesting to see the move there. I was just looking at the options to see if they zapped all the extrinsic value out of these yet, but it doesn't look like it right now.
So, do we want private equity? I shouldn't say this, but whatever. Do we want private equity having access to our information? I mean, Workday is what we use as a company. Do we want that? How do we feel about that?
Well, hold on a second here. Everything that we already do is categorized, cataloged, done online.
Our homes. They, lots of these homes that Blackstone owns all over the place.
Every single data feed is sold. I mean, if you guys use Amazon Alexa or Echo, whatever it's called these days, they ask you like such specific questions, like, "Hey, is this in the right spot in the house? Are we hearing you in the right spot? By the way, you might be running low on paper towels." It's like, how did you know that? What are you listening?
Yeah, no, I don't use that. I don't want to use it. It's in my car though.
I mean, I use all that stuff. It's so convenient. I walk around the house. I've done the voice recognition stuff. My wife has not. It does not recognize my voice, gives her guff, is very friendly to me. It creates a good deal of fun tension in the relationship.
I don't know.
Man.
I don't know.
Oh man.
Is it a woman too?
It is.
Oh well, of course that's the immediate. That's the real tension. She's.
Well, she like sighs when my wife asks her questions. It's like, I'll be like, "What's the weather?" And she'll be like, "Hi, Chris. It's a beautiful day." And my wife will be like, "What's the weather?" And she'll be like, "The weather is 72 degrees. Do you have any other questions?"
You trained her that way.
Brain busters.
What's her name?
Alexa. We just use the Amazon one.
Come on. You gotta give her.
It's that or Echo. It's like I'm not going to be yelling Echo around the house.
You gotta give a real name.
You changed the name?
Yeah.
Only between those two.
Oh, really? That's
Adam Newman is WeWork. Thank you, Jackie, in the chat. WeWork, Workday. My mistake.
Yeah. Whatever.
It's all good.
Yeah.
It's all good. So yeah, nothing really happened on this 730 print in the E-minis. Just a little spike higher and then a little retracement here. But looking at the implied move for SPX for the rest of the day, not too much. 30 points, literally the same story every single day this week. 30-point implied move. If we move on the open, maybe it stays bid, but if not, we'll drop into the teens in 15 minutes after the open.
Yeah.
And that's it.
Yeah.
That's that.
Yeah, I did that yesterday. Didn't work.
Nope. Yeah, yesterday was a cool 3 standard deviation move up to the upside for no.
No, what I really enjoyed is both of my short iron condors this week in SPX. One finished a point outside of my short strike. The other one finished like 5 points outside of my short strike. It's like, hey, but that's the nature of the game sometimes.
Mm-hmm. It is. Yeah.
Yeah, I now have a 0 day. That's going to be right at the money 77.98.99, and I'm at the 7,800. This is going to be in the money on the open if we stay here, but if we sell off, that could be good for a number of positions in his portfolio, because that's basically what I need, especially in CoreWeave. If CoreWeave sells off down $5 or $6 today, this will be a $300 winner, something like that. So that's what I'm looking for.
I do want to say, look, when things go bad, I think we have to, acknowledge it as well. So I'm going to acknowledge it when things are good. A lot of people have reached out about the SanDisk trade. I appreciate it. I mean,
Have you seen it pre-market today?
No, I haven't. Where is it? Higher?
1625.
Oh, that's awesome. So where's Micron? Because Micron, the reason...
978.
Yes. So it was a two-part thing. We had SanDisk, we had Micron. We had a call calendar in SanDisk, for those who don't know. We had the 1400, 1500, 1600. We bought that for $5.55 on the 7th or the 6th. And a lot of people have been reaching out. Some of them, might have closed it early. Some reached out the day before. What's your plan? I told them I was basically playing with house money, so I really wasn't worried about it. But yesterday seemed like a great opportunity. I guess it had Investor Day. I actually didn't realize that when we were on the show. And we saw it up in the morning, and then it jumped even higher. I closed it when it was trading 14.30 or something. I closed it for like $26. Nice little win. And a lot of people reached out. So thanks. Again, I'll take it. Again, look, use your timeline. I was willing to light this money on fire, the $555, because I had already made money, so I wasn't really worried about it. But use your timeline, and some people did. Some people closed early. Some people reached out for when I closed. Don't always close when I close, because I have a different portfolio and different reasons. So I'll just say that. But glad everybody, the folks who made out on it. I also closed. I wasn't trying to get crazy with this because I also have a Micron, which was a little further away, and now that's possibly in play today. That's my play for today, I guess. We'll see if it crosses 1,000. I have the 1,000, 1,100, 1,200. So I am rooting for this space to keep running. We'll see what happens.
Yeah, I mean, the 1,000 will appreciate for sure. This could be really nice here. Even you're 20 points out of the money, but it's a $1,000 product. Like, you'll still have tons of value in this 1,000. And you can see here, this was trading for $2, and then you're way up here at the 1,100, which is worthless. The 1,100 would probably stay worthless. Maybe it picks up like 20, 30 cents, but this 1,000 into this 30-point rally, if you just look at what the 1,000 closed for versus the 975 or 970, 30 points closer, that's a $500 difference. So this would be a nice little trade here.
Yeah, if this thing runs, if it runs a little bit today, that would be nice. If it ends up getting up to 1,020 or something, that would be awesome. I'll take it. We'll see, though.
I mean, I got positions on an AMD, semis, and SMH. Pick a name out of the hat: Oracle, Google, Broadcom, NVIDIA, Western Digital. So I don't have anything going on in SanDisk or Micron this morning, but SMH, of course, is going to play a big part of that. Guys, this has been a miracle for the past month. As I've been wheeling this thing out, assigned shares at $6.15 in July and figured, what's $5 or $10 between friends? They're semiconductors. They'll bounce back, right? And then we went down to 500. So I've been wheeling this thing out, selling calls against it. Positions almost bounced back. So if we get to 615 or so, I'm going to be very tempted to unload a majority of this off my book, because it's not been fun watching all that margin just being held up, buying power being held up by it's a big position, right? 100 shares of SMH, which I've sold calls against, but maybe today's the day, guys.
Could be.
Maybe.
Could
maybe.
be.
Speaking of trade of the day, I think I'm leaning towards doing something. And I saw a big move in Circle yesterday, and I think it was being attributed to the Clarity Act. I don't know if I'm going to do anything in Circle, but I'm going to look at maybe something in either Circle or just the whole space. IBIT, ETH, MicroStrategies. And they all. MicroStrategy, of course, sucks. You know what I mean? The story has been negative, right? But I feel like maybe this Clarity Act situation gains a little momentum in the fall. This space has been so quiet, and vol is so low in here, comparatively. I would say, So I might look to do something in here with the trade of the day. This has been a space that I've actually taken positions off because there just really hasn't been anything going on. But today might be the day to do something in there.
I'm, again, trying to find uncorrelated trades to a lot of the other things that are currently going on, which is why I've added stuff like CSX, Kimberly-Clark, Procter Gamble, because railroads, what are railroads doing compared to, say, the semiconductor trade right now? In that same token, we had the retail sales report this morning, which I don't know if you guys saw those numbers. They were just not good at all. Retail sales were down 0.6% month over month versus an expected gain of 0.1%. Why do we even care about that? Because the way that the numbers are actually calculated, okay, just taking a step back here, and I want to just, where did the data? I just flick around my chart screen here. Okay, so negative 0.6% in the retail sales. The retail sales ex auto, right, negative 0.3% versus plus 0.2% expected. And then the retail sales control group. Now, that's the one that actually is used for the GDP calculation. Okay, that came in at negative 0.4% versus an expectation of 0.3% here. So, again, why do we care about something like this for the retail sales themselves? The way that they are calculated, because retail sales are nominal, right? So you have to adjust them basically for inflation every single month. So if inflation's plus 2% and you have a negative 0.6% retail sales, it's actually negative 0.8% in real terms right now. And so what we're seeing here is that gasoline effectively is squeezing discretionary spending beneath the surface. Okay, consumers are pulling things back right now. One of the things that consumers typically do when they have to pull back is that they avoid eating out, okay? So I've been looking in some of these names like DRI, Darden Restaurants, and Yum Brands for potential opportunities here. These stocks have not been strong in what's been a very, very strong tape recently. And I say strong tape recently, not just for semis and tech, but look at RSP, look at QQEW, look at the Russell, all right? All the equal weighted stuff, all the smaller cap stuff is also pressing all-time highs. So this is not just like a last year market rally when everyone was complaining, it's just the Mag 7. Without the Mag 7, the NASDAQ wouldn't be up. Well, the NASDAQ was still up, and here we are. These names are not doing well in this tape. So if I can find an opportunity today, depending on the pricing, depending upon the strikes, I might need to go a little bit further out in time, but looking to sell call spreads in this area. That's kind of where my head's at on this Friday if we're going to be executing new trades. Otherwise, Fridays for me are usually roll out, take off, and de-stress heading into the weekend, because I don't want to think about position risk and gap risk, particularly for shorter dated trades that may be expiring Wednesday, Thursday, Friday next week.
Yeah, I think that's a great call out, and that's basically the MO that I have today for sure. Is just looking at positions that I can close or manipulate. This MU position with MU up 30 points pre-market. This is a Super Bowl I'll likely take off in September with the 1100, 1120 long call spread here. This could be probably $300-400 winner on the open. And yeah, just removing risk ahead of the weekend. We've seen weekend risk come into play quite often. So I think it makes a lot of sense to do it.
Yeah,
Can I give you guys some
entire week is just de-risking a lot of stuff and moving further out. I did that earlier in the week. That gave me a little bit of room. So I'm with you, Chris.
Could I give you an interesting stat here that I came across yesterday?
Of course.
Yesterday, the S&P 500 closed a window where it returned 5% or more in a 4-day window. And then it consolidated for at least 5 days in a 2% range or less. Okay? And then it breaks to a new high, like it just did. How many times has that happened before, where the market takes a big jump, consolidates, and then jumps again into a new high without breaking a 2% range? Don't go that far in your thinking. It's literally never happened before. Never happened before, right? So like there's interesting price action going on right now. When you do these sort of scans, like, oh, this was a market rallied, it paused, it rallied again. Is this continuation? Like, what has the market done when it's seen? Oh no, wait, the market's never seen something like this happen before. So August itself, right? It's this weird barbell month. We started the month off with this. Liz was asking me on Confirm and Send, like, what does the seasonality say? Are you bearish on stocks? It's like, well, from the volatility perspective, volatility tends to go up. But also, S&P has averaged a 0.84% gain in August. NASDAQ's also up more than 1.3% over the past decade. And it really hinges upon that OPEX state in the middle of the month. Right? If you look at the actual day-by-day seasonality of how stocks and volatility perform, volatility makes its August creep higher, basically the 15th onward. So, hey, that's tomorrow. Same thing for stocks. Stocks tend to get a little soggier in this back half of the month of August. They rally sharply in the first half. They give back some of their gains the second half. So, yes, we may have just seen a thrust here to the upside right now in a unique set of circumstances. But when you see unique set of circumstances play out, you have to question the rest of the data because clearly something ahistoric that has never happened before is happening. So what's a 10-year, 30-year, 50-year sample size mean? Maybe nothing at all. The point I'm getting at here, guys, is that pressing long stocks at all-time highs is very difficult. But studies show and history shows that investing on the day the market closes as a new all-time high, you'll have a better 6-month forward return, 1-year forward return, 3-year forward return than if you buy the market at any other day in its cycle. New highs beget new highs. So for me, sticking long ESH7 calls at 8,000. We've been riding those since April. Sticking long MES at 7,600. Been riding that since July. This train's not stopping right now, as far as I'm concerned. So let's keep going.
I wonder what gets the NASDAQ back to all-time highs. Is that something that's going to happen in the weeks leading up to NVIDIA, or is it NVIDIA itself? Or does it not ever happen?
I don't know. I think we're going to get back to all-time highs maybe in the next week or so in the NASDAQ, all things considered. But I would watch what happens with the Mag 7 here. I pointed this out in the morning note today, which is going to be published on the website once I can update the retail sales data for it, because what's the point in publishing a note that's like, hey, by the way, you have 1 minute to react? That's just, I don't see the point in that. Anyway, what I'm getting at here is with respect to the breakdown right now, and I want to bring up the very specific thing I wrote because I thought it was pretty good. The AI trade is alive, but the market tells you pricing still matters as it's grading each layer differently. Memory right now has momentum, cloud infrastructure has backlog, equipment has valuation risk, and networking needs margin proof. And if you drop all of the earnings for the companies into those various little buckets, you'll see that the ones that have done well are more towards the infrastructure side, more towards the memory side. It's the networking, the cloud. Maybe that's been a little bit more difficult to wrap your head around. So where does NVIDIA sit along that spectrum? It's definitely towards, the infrastructure side, right? It's GPUs. So I don't think we're worried about NVIDIA itself. The market needs more than just the hardware producers, though. And this, Jermal, goes back to a thing that you and I talked about frequently on Futures Power Hour last year, earlier in the year. We're in the picks and shovels phase. When do we go to the actual gold mining phase of this rush? So we don't need more good data from the picks and shovels people. We need more good data from the applications. That money's being made for the folks who are using AI for productivity, for software, for business purposes, and they're turning a profit on it. They're not just lighting that money on fire.
Yeah, that's exactly what we need, and maybe NVIDIA will provide us that. We got, a couple of weeks here now? 2? A little under 2.
12 days.
That's the next big catalyst, right? That, and of course, Jackson Hole around the same time, around the same week. So we're waiting.
That to me is really the window, Mike. I mean, you get the OPEX, and I know Jim's been talking about this with you guys, but you get OPEX next Wednesday, and then we go into NVIDIA and the Fed's Jackson Hole the following week, right into Labor Day when liquidity is going to be super thin in the market. And with vol sitting at 14, I'm thinking about taking a page out of TP's playbook, also using the seasonality there. If you head on over to the VIX, some of these VIX put spreads right now, I'm very tempted to jump in there just on the other side of that expiration window for this particular set of risks. So that would be the September 2nd, 18 days to expiration. And looking at the 14.5, 14 short put spread here. Obviously right now the market pricing is a little awry, but if we can go 50 cents wide and get a decent trade there, I think getting a little bit of vol in your portfolio for that week may make some sense.
Yeah, I think I think this could be a situation where you get a little bit of a catalyst. I was also looking at earnings next week, and you've got a lot of consumer companies. So you have Home Depot, Lowe's, Target, Ross Stores, Walmart, TJ Maxx. Do you think we can glean any information from that, or do you think it'll be in line with what we've heard from the CPI, PPI data that inflation just doesn't exist?
Yeah, inflation doesn't exist, my ass. Sorry, just these prices are just come on. No, I was. It's so funny because I was looking up. We have 2 cars, right? One of them is a used. Now it's used. We leased it and then we own it. 2024 Escape, and looking at the Kelly Blue Book value for it. How is this car still worth more than what's remaining on my, on the payments? We're going to sell this thing now, right? You're going to give us more money for a 6-year-old car than what we have remaining on our loan. We'll just take that, pay it off, and get a new car. But what's going on with that? How does that make any sense? So I don't know. Yeah, the consumers though. This is what's interesting about this retail sales report, guys. The feed throughs into it are directly from the names that are reporting next week, and we get the retail sales data every single month. It's the one sector in the economy where there's actually like a direct line from economic data that you can point to, and get a good understanding here. I see Target sitting up at 155 right now, which is I believe a 52-week high. You mentioned other names like Home Depot here. Home Depot doesn't look too hot. Target does. I'd rather, if I'm trying to, call a top in anything, which is not really my forte, but I'd rather bet on Target weakness right now than necessarily like Home Depot or Lowe's strength. And that's more of a thematic idea I have in my head, which is to say that because mortgage rates are so damn high, people aren't moving. And as we saw during COVID, when people don't move, stocks like these do well because folks go, well, if I'm stuck here, I might as well make it look nice. Right. And they spend more money, fixing up their house. And so if we're in a period where mortgage rates are high and you can't spend outside of your home because, the rent is too damn high, as people say, maybe this is where you can get a tailwind within the consumer space. But we're not seeing it right now. I'd rather play the restaurants. That's where we're seeing some cutback, as it were. DRI and in particular, Young Brands. Young Brands looks not so hot for a stock that's been in a market that's sitting at all-time highs across the board from a variety of index perspectives.
I'm with you on that Home Depot thesis. I actually was trying to get a long position on the other day for that thesis alone, just to see if it would play out. I couldn't get in the options, man. I was trying to get a Super Bowl on. It would not let me in. It was hard, but I wanted to get in here. I did.
I think
360. Watch 360 is all I'm saying as the price line.
Yeah.
I just redid my bathroom and I bought a vanity from Home Depot. It was like 30% off, and it's like construction grade, like contractor grade, heavy material. So I wholeheartedly support going to Home Depot.
I was trying to get the SEP 330, 320, 370, 385. It just wouldn't let me in. 30-cent credit.
Remember, every good trade needs an investment thesis, which is why we'll be talking about Pentair later on today on the show.
Yeah. The first time I went to Costco, my girlfriend was like, "Why are you mad?" And I'm like, I'm such an idiot for not investing in this 10 years ago. She's like, "Oh my God, can we just go shopping?" I'm like, no. It's like if I would have known the glory of Costco, I would be deeply long, and I would have gotten all these gains. But unfortunately, I didn't get any gains.
Yeah.
My two worst trades. My two worst trades. Instead of spending $50 to invest in NVIDIA in 2002, I bought an NVIDIA GeForce, 4X or X4 so I could play Counter-Strike. Okay. And then my mom got rid of my binder of original base Series 1 Pokemon cards, which had 4 Charizards in it, which I like to remind her that the estimated value of that book today is around $500,000. So sometimes you leave some money on the table, folks.
Yeah. The funniest thing about the Counter-Strike thing is you're like, the argument is, I'm at 50 frames per second. I need to get up to 100 frames per second. Don't you get it? Don't you understand?
How am I going to clip these guys unless I'm moving faster than them through walls?
Jeez.
Unbelievable. Well, on that note, Chris, appreciate you. We'll see you later.
See ya.
See you, man.
Adios. E-minis up 7, Nasdaq up 78. Crazy market here, and by crazy I mean dull. But maybe on the open we'll get some kind of movement. But we're going to take a quick 90-second break. Join us on the YouTube chat. We're looking at the chats coming in. We'll answer any of your questions, trade ideas you've got. We're going to take a quick 90-second break. We'll see you on the other side. You're watching Tasty Live.
But baby, your love is too good. You knew what you did when you planned it, you scammed it, making right off like a bandit. I know that you worked a bit harder, 'cause baby, your love is too good. Touch me, hold me, love me, know me. I like how you do it, you're helping me through it. Baby, your love
What's up, party people? We are back. E-minis up 6, Nasdaq up 76. Jermal, it's been a wild week of not much going on in these markets, but we still can find those opportunities, and we've been trying to do so. I think AMD is going to be a nice move to the upside here this morning, but really Micron's going to be the first thing I close on the open. If this thing holds, looks like it's creeping up higher towards your long strike in that butterfly, 980 now.
Yeah.
But yeah, basically this trade's going to be $300-$400 winner. I'll just close it right away. 35 days to go. Got to capture that value, deep value.
Deep value. yeah, for sure. Matt, we mentioned that earlier. That's moving to the downside, of course, after earnings. What else is moving around here? Geez. I mean, a bunch of other names I don't really look at too often or care about. Boost Run. Never heard of this name. BRUN. Don't even know what that is.
That's another tech random name. Stocks that we've never heard of are the ones
it's clearly where we are at this point in time in the cycle. You know what that usually means, moving towards the end of the cycle. We were talking about VIX just a bit ago. Micron just gapped 985. Keep going, Micron. We see you. Give us a little fun Friday. Love this. You remember a couple of days ago I was saying I had the August VIX futures in the micros, and I was like, what's the point of this? Like, there's nothing happening in August, and I rolled to September. I'm kind of glad I did. So I could add to that position, or I could, that's kind of where this is a time where I would say it's actually kind of worth almost buying VIX now, if you want, as in, volatility as an asset class, right? Like, this is the time where you see it so low. Again, historical low is like, I think $8.70, I think was like the historic low. So this is not like all-time lows, but this is definitely well below the long-term average of like 19 or 20, however you look at it. And these are the times where it's probably worth, like, if you want to do something, whether it's a long call spread, low of $8.56 in 2017, November of 2017. If you want to do something, you could possibly buy calls. Again, always remembering, for those who trade VIX, always just know, just like when we look at Micron and we look at options across all the landscape, and we know that it's all moving based off of this stock price, VIX is different in that if you're trading the August VIX, you need to look at the August VIX future. If you're trading September VIX options, then you need to pay attention to the September VIX future, so that kind of thing. Make sure you understand, right? Especially in this situation of contango, where there's a big difference between August and September right now, almost $2 it looked like earlier. So the futures. So always know that whatever VIX options you're trading, pay attention to that corresponding VIX future. In this case, looking at October VIX options, you got to know where the October VIX future is trading to be fully aware of where at the money is in upside and downside. Yeah.
And that is it's basically going to be where the at the money options are, or where the calls and puts are trading for a similar value. That's the true at the money area. So this 20 to 19, where they're trading for around $2.50, this is your true at the money strike for the VIX that is looking at the futures. And this is a big gap between 1920 and the current spot price of 14.5. So this speaks to the contango that we have in this market. And you should expect, like, unless you get that pop, this short put spread, if you sold like the 2019, the futures are going to drag down towards the spot price over time. So you need a pretty big pop in the VIX. But again, we're sitting at the lows of the year, ultimately, if you think there's some kind of catalyst that changes that. Especially with NVIDIA earnings coming up, that could be something interesting.
Mm-hmm.
But yeah, interesting turning point with the NASDAQ. If you look at where we've come from and where we are, NASDAQ is still lagging behind in terms of reaching all-time highs, unlike the E-mini S&Ps. But this could be a situation where we kind of falter from here and get back down to these levels. But if we do that, I think you'll see a similar thing in the E-minis. Like, this was such a huge gap higher last week, and then we've done nothing this week except for yesterday. So
yeah,
still some
for sure.
Decisions to be made.
As far as movers, AMAT's down 6%. I'm seeing NVIDIA's up almost 0.3%. SpaceX is up 1%. It looks like Reddit. We mentioned that earlier, being added to the S&P 500, and that's up near over 10%. Uber up 1.8%. I closed on my Uber positions, I think, either earlier this week. I believe I did. SanDisk, of course, is moving to the upside. Continuation and move 7.5%. Micron is following along with it. Tesla up almost 1% right now. And you mentioned AMD earlier, up 0.75%. So we got a couple of movers here on a Friday.
Indeed. See some questions in the YouTube chat. We can cover those. So people looking at AMAT post-earnings trade, we can take a look at that. Is there an adjustment in the AMAT calendar? No. We can maybe fly it off. I mean, it really depends on what this option opens at. But I have a 600 strike calendar with a 30-point move to the downside and a big vol crush in the 7-day. This option's probably not trading for too much, but if it is still, we can turn this into a butterfly by getting rid of the short option in the 0-day and then going to the 7-day, selling 2 of the 610s, buying 1 of the 620s, or selling 2 of the 620s, buying 1 of the 640s. Like, we'll see if we can do that and just create a butterfly by reducing basis a little bit. But it really depends on what this option opens for. But for a new trade, post-earnings trade, I think you certainly could do something like a longer-term calendar where you're long October, short September at like 550 or even 600, depending on the price point and how expensive that is. But that's probably where I'd land, is still going with a diagonal or calendar spread, given the heightened implied volatility that we'll still probably see in September relative to October. What do you think?
Yeah, I mean, like you said, possibly flying it off makes sense to some degree. The stock may bounce back. Who knows?
Or Super Bowl.
Yeah, or Super Bowl is possible. Again, with the stock this size and the type of moves that it has and the whole industry has at times, I think it's not like it's a dead trade that you have chances here.
Yeah. RC Mower asking if we can go over a Super Bowl on the global trading hours before the open. Sure can. So
if we had $1 for every time.
I know. These trades are, so this all just goes back to the fundamentals of options. If you understand how a put spread works, short put spread, and you understand how a long call spread works, that's all a Super Bowl is. It's combining the two to create a small credit. It's that's all it is, literally. So if you go to like a 77.50, 77.40 right at the expected move in the 3-day cycle, pick up $1.15. Okay, I can buy a call spread now for about $1. So I can just look at these strikes and say, okay, 78.50, 78.60. That's trading for like $2, so that's a little too expensive. I'd probably have to go further out of the money here and go like 78.85, 7900. Like, this is kind of in the wheelhouse where you're still picking up a small credit, but if you get a big move to the upside like we saw yesterday, where you get a 50-point rip to the upside, this 15-point wide call spread is going to appreciate dramatically. And you can see this here with the P&L Theo. If I look at this from a theoretical standpoint, and we move this, let's zoom in a little bit, and then just move this from 77.98 where we are, just up like 20 points. 20 points here is like a $150 winner. If you get a 50-point rally, that's like a $500 winner. So basically what you're doing is you're giving up 70 cents of credit. You still collect your credit, though, in the middle, so your pop is still high, but you're trading off your stagnant short put spread profit potential for a dynamic upside call spread. And this is how I was talking to Julia about this yesterday. I'm like, this is how you can, if you're directionally right, you can pocket 6 or 7 more winners in one trade versus just selling the put spread. And there's immense value in that, especially for premium selling, where the biggest issue is getting blown out on 3 or 4 in a row, and now you have to have 20 winners in a row. Well, not in this case. If you have a couple of big Super Bowl winners, you have a lot more winners under your belt, and that's why I love this kind of strategy.
Yeah, I do, and we've employed them a lot on a 0-day or 1-day basis. Sometimes you can either, I think, I feel like this is a trade where you can go maybe up to like a week out. After you get a little bit harder to do in that, you really have to define, like, for the most part, we get lucky. I shouldn't say get lucky. We benefit from the moves and the direction that we put these on. Again, we put on Super Bulls and Super Bears. We usually benefit on the move pretty much immediately in either direction, or know immediately it's not going to work on that specific day. I think if you go further out, Like, Mike just showed you the strikes he chose. I mean, if you go way further upside in a product like SPX to try and get the credit, and you might not necessarily, that you want. So it's a little bit difficult. So I feel like there is sort of this time barrier for the Super Bowls and Super Bears. It just really depends. I think I would say, like, I don't know, 10 days on in, they work really well. A little bit further out, 30 days or something, it's a little bit harder to do. But not impossible, I shouldn't say that. But it's just a little bit harder to do. You have to choose further upside strikes. So I think my point is it's probably, if you want to go further out in a name like this, I think it has to be something that's a longer term thesis. So let's just say, like we did with Microsoft, we went further out in Microsoft. We were able to do that because we were playing for further upside. We were able to collect a nice credit on the downside, and that stock was really depressed, right? So we were looking for Super Bowls in there. Same thing we just did in Meta more recently. A stock that was really depressed, we were able to go a couple months out, and it worked out really well. And I'm just saying, for S&P 500, like doing a Super Bowl, I don't know, what does that look like? Let's take a look, and maybe I can explain what I'm talking about here. Like if we look at October, what does an October Super Bowl look like in the S&P 500 for further upside? I imagine you're going to have to go to some crazy upside move for that to make sense.
Yeah, I think because SPX is so expensive, it's a $7,800 product. Like that's why it makes it harder, because these options now are $15,000 options. So if you're trying to do a 4-legged spread, you're going to have a pretty wide break even or a wide bid-ask spread. But yeah, October, let's just go to like 7,500, slightly in the money. I mean, you could go.
See, their loan is part of the problem, right? Only $1.60 for that.
Yeah. Yeah, and we're inside the expected move. So 7,500, 7,490. And then to the upside, these options are still very expensive. So you're like, to Jermal's point, you're going to have to go, like this is a debit, a 10-point wide put spread. To try and buy a 10-point wide call spread, you're paying a sizable debit. Even a 5-point wide. So like this is a great example of like you have to go much further out of the money on the upside here. And that can be harder to get to, but you can still have a decent profit potential if you do. And then another thing is like these strikes up here, they get limited pretty quickly. Like these are now 10-point wide strikes. You can't go further. You can't go more narrow than 10 points wide. And then eventually these get to like 25-point wide strikes the further up you go. There you go, 85,
that was my point.
8,600. So, yeah, it's tougher to do longer term in something like SPX. But if you go to XSP or SPY, it's going to be easier to do because now you have a smaller price point in terms of the stock price. And that, if you're trying to do longer term Super Bowls and Super Bears, I would go to SPY instead of SPX. But yeah, I think on the open with AMAT down, we can look at what a Super Bowl looks like longer term in October and see if it makes sense for the portfolio.
You don't remember anything we said? Just make sure you're collecting a credit for that trade. Selling the put spread, buying the call spread.
Yeah, selling a put spread to buy a call spread for credit, and then a winner, you would route it for a credit also on the exit because your put spread loses value, which means a lower buyback, and your call spread gains value, which means a higher credit for an exit there. So yeah, they've been fun trades. And again, the biggest thing the question that it answers is, how do you offset the big losers by just selling put spreads or just selling call spreads? Well, you need some kind of asymmetry. You give up some of that credit and you buy a call spread with the sale of the put spread and still collect a credit in the middle. That is how you can get a big return on a big directional move that works out for you.
Yeah.
We're going to take a quick break here, and we'll take a look at some prediction markets on the other side of it. We'll have the opening bell in about 15, 14 minutes, but keep the questions flowing in the YouTube chat. We'll have tons of time to answer all your questions today with the E-minis and NASDAQ doing literally nothing. But yeah, we'll see you on the other side of this break. You're watching Tasty Live.
I'm rowdy, I'm grounded, and I get my way. I'm proud and I'm howling around. What can I say? Ooh, let me see you move your body, see you shake, you make 'em turn it up and drop. Ooh, let me see you get it started, see you working up a sweat. I'm all about it. I'm all about it.
What's up, everyone? Welcome back to the show. We got E-minis chopping around NASDAQ up 70 almost. E-minis up 5. I was filled on that Super Bowl, posting it to the follow feed right now. And that was for the 3-day cycle. So shorter term Super Bowl, but covering the weekend. And really, it kind of hedges my existing... Yeah. Exactly. It hedges my existing position in SPX. That's right at the money. I have just an iron condor that was going to expire today, or that is expiring today. That's right at the money. So if the market does rip higher, I can offset some of that risk with the Super Bowl if we get a couple $100 out of it. So, yeah. Hopefully we don't rally from here. Hopefully we sell off a little bit, like 10, 20 points. And then on Monday, we rally 300 points to the upside, and we have a gap higher. That'd be the best case scenario. Best case scenario.
I think we're just going to keep drifting higher. I just think that's the case. I'm looking at VIX on a 1 minute here, and this thing is like moving to the downside even more. 1449 now, Mikey. I mean, I know we're saying it like it's a bad thing. Let me explain. The reason why we're saying it like that, because we know that at some point this is going to make a strong move to the upside. So we're just preparing ourselves. But look, honestly, this is great. This is a great thing for the stock market that we're at all-time highs and VIX is at lows. This is a great thing. We've been in this long enough that we know that this will not last in perpetuity.
Yeah. The further we go and the lower the VIX goes, the closer we get to the next catalyst.
Yep.
That's another way to think about it.
Yep.
When is that catalyst? What is the catalyst? I don't know. I'm kind of afraid to know. But
right.
Yeah, if the VIX hits the 13 handle, I might just throw up on air. Well, let's
my God.
Put that on the record.
VIX hits 13 handle. I'm definitely buying some VIX calls then. For sure. September, by the way. I know beta moves most with August, but look, August is about to expire in just a couple of days here. August VIX options and future expires next week on the 19th.
Crazy.
So.
Crazy. Yeah, some people like in the Super Bowl discussion. Yeah, just make sure if you're doing it for pre-market that you're routing it in the global hours. So that might be your issue. If you've got your regular hours on the trade session, it's not going to route till 8:30. Global hours is where you get that 24-hour access or near 24-hour access. So just flip it to global hours. The nice thing is the system will just automatically route it into regular hours. Even if you have global hours selected and you have an order working and then it flips to 8:30 a.m. and the market's open, like it'll still fill if the market hits it. So yeah, that is what you need to do to get that global trading hours session enabled. But yeah, got filled there. 10-point wide put spread to buy the 15-point wide call spread further out of the money. And yeah, you're just looking for a directional move to the upside. If you get a 30-point move to the upside, which is implied for today's range, then this will be a $200 winner. You can take it off.
Sweet. What's going on in prediction markets these days?
Good question. So yeah, these are available now in the Tasty platform. You can enable them. You can start trading them. They're piped through Kalshi. So you can get commodity predictions, crypto, economics, financials, and more. And yeah, I think for these, at the very least, I like to look at these for economic probability data. So this just gives you everything you need in a one-stop shop. You can look at CPI year over year, month over month. You can look at Fed rate decision for a bunch of different decision dates and just look at maintains rate hikes, like what are the probabilities looking like? What were they yesterday or a couple hours ago? So at the very least, use this for data, make more intelligent decisions.
Yeah, and also use it to for dates as well, like you mentioned. I mean, the next Fed meeting is on the 16th, right?
Yep.
Looks like. And
September
Bank of Japan rate decision, is that coming up soon? I saw something the other day that said they are, okay, it's the 17th. So I heard something that they are leaning towards doing a hike, and as you can see where it is right now, 79% chance of a 25 bips hike. They don't hike all too often, so that's pretty high, by the way. And you would imagine if they hike, we'll see a movement in their currency as well, 6J, which we've seen before. I actually have a couple of calls in there. I just bought it after the crazy move, seeing we're going to move higher. I'm actually down on it. I'm down $600 on two of the calls right now. which is fine. It's in October, but that's my next catalyst, so I guess I'll hold them and wait. And ours is the 16th. This is the 17th. Bank of England must be around the same time, I'm guessing.
Yeah.
Why that's important is because they were Bank of England, the ECB. They were the ones hiking rates. If you guys remember during the last rate hiking cycle in 2022, they hiked rates before we did. So that's why it's kind of interesting to keep an eye on some of these other countries as well.
Indeed. But yeah, check these out. You can trade these directly in the platform. And when you have them loaded and you're in a position, it shows up on your positions tab, just like everything else. There's a little events position type you can see in the upper left corner here. So yeah, check them out. Someone asking where the global hours option is. So it's on the trade page when you are about to place an order. This trade session in the lower right. Let me know if you can see my mouse. I don't know if you can see my mouse.
I can see it. Yeah.
Can you?
Yeah.
But yeah, regular hours is selected by default. So you have to switch to global hours. You can see the time frames listed there. But global hours is how you get access to 24/7 basically markets, except for the weekend, of course. But SPX options, RUT options, VIX, and XSP. So, and these open on Sunday night too. So when the Sunday session starts going, you can start trading these even in that session. So,
and for those, yeah, that's a good point. Like, if you go to, I don't know, for lack of a better, just pick Microsoft. For those who say, list like this could be for those who I don't know who fully understand this concept of options, but let's just say you bought puts. Say you had money, you bought puts, and Microsoft dropped 10%, and you were somehow long some puts, and you were like, yes, you're cheerleading, but you just don't know what's going to happen. Say it happens after hours because there's some bad news. What you can do is, speaking of these trading sessions, you can go to the stock, right? Say you want to buy stock, right? Pick that stock and you could say, let me buy it. Same situation, trading instead of regular hours. You could change that to extended and you can buy in the after hours. That's what you would have to do. Say you wanted to hedge some puts that you were long, you wanted to buy stock. I would think anybody who was doing this would already know this, but just to kind of bring that up, you would use extended hours. So say it's a stock that you need, say you're long some options against it and it's moving and you want to be able to sort of monetize that move, you can do this in the extended hours in this manner. So changing those, just showing you can change those extended hours for certain products in certain ways.
Yep, 100%. And right now, that's like the only way to hedge is by buying shares of stock. Like that's the crazy thing about markets is like Microsoft can announce something after the close, and the only way to hedge is to buy shares or short shares against your options that you own or you're short. But eventually, this like global trading hours for the indices is just a precursor to the future. Eventually, we'll have global trading hours for these single name stocks like Microsoft, Nvidia, you name it. And that's going to be really fun because that will be like in the Cisco trade where we had the gap higher, those calendar spreads I would have been able to close. And or I could just have a GTC order, like an extended hours GTC order in. You get that move, I can close it for a couple $100, and then 30 seconds later it drops 10 points. It doesn't matter because you're out. So that's what I'm really excited for is like avoiding these initial wins that are wiped away because a conference call happened 2 hours later and someone said something that the market didn't like. So
yeah, true. That would be cool. That would be cool. And in the scenario I just laid out, it kind of made me just realize why people would want single stock futures, I guess, for those reasons. Instead of doing extended hour buying stock, a single stock futures are already trading. You can just trade those.
Indeed. Long put options after hours, and how do you short the shares to monetize? So if you're long a put, you are synthetically short the stock. So if you're trying to hedge, you would buy shares to offset any kind of reversal to the upside. So you're basically trying to lock in gains if you have a long put that's in the money, and then you buy shares at a lower price.
Yeah, like I guess we can make it real. Let's do a name like Oklo. Oklo's trading like below 20 right now. I thought it was. Never mind. I'm trying to think of a name that's like really low dollar name. I actually don't have any in my portfolio because I don't really trade names like that. But I don't know. Anyway. Just trying to make it real because most times people aren't going to want to buy stock against some of it is pretty expensive, but there are some scenarios where maybe you might want to buy, some, say you're long, a couple of puts or something. That's the best way I can think about it. And you want to it's after hours, just making a move, but you're not sure if that move is going to stay tomorrow, and it's actually making a strong enough move that you feel like you want to monetize it, and you know where your puts would be worth, you could buy some stock in the after hours. So happens every now and again.
Yeah. Right now we got about a minute and a half. We'll fix. I see you in the YouTube chat. We'll fix that so you can see my mouse. It's probably because I'm sharing the platform and not my desktop, if I were to guess. But yeah, about a minute here until the market opens. Let's look at the 1 minute chart. Let's see if we get a little action here in the E-minis. Right on.
You know what's funny? Now I see what they're saying. I don't. When I'm in Zoom and I look at your screen, I can see your mouse, but for some reason on the actual stream, I don't see it. It's weird.
Yeah, we'll get that fixed.
It's a ghost. It's a ghost mouse.
Yeah, which makes it hard when I'm trying to show you stuff and you're like, "What is he pointing at?" I can't see it.
I mean, I see where it is,
Yeah,
so
you
it's
see
not
it.
like
Yeah. Yeah, lots of people looking at specific names. So we'll take a look right on the open at some of these names: HIMS, SMR, ACHR.
The people love hymns, man.
I know.
People
SoFi.
love hymns.
Yeah, SoFi is interesting. SoFi I thought was just going to rip, but apparently not so much.
Do you know SoFi gave, God, who did they give the patch money to? One of the colleges. Was that? Hold on, I got to look it up. Notre Dame. They gave Notre Dame a lot of money for the patch on their jersey. It's the big thing this year. The patches on the jerseys. For these schools, they gave a lot of money, bro.
Classic. E-minis open now, only up 3. We got the 1 minute chart here. You can see the live action, the live tape. Dow just ticked red. Russell just ticked red. Bitcoin, ETH, red. Crude flat. I don't know. Make a decision.
No.
Oh, we're about to go red here. It feels like. Micron, what's your trade looking like?
Right now I'm up. Basically, I'm up 30 cents over where I bought it. So I bought it for $4. It's trading for 70. So it's settling out right now. So that's basically flat.
I love it. I'm putting a market in, or putting an order in above the market. See if I can get filled here. That'd be crazy.
For your Super
$300
Bowl.
winner.
That'd be nice.
Come on. E-minis just went flat. Micron's selling off here. Come on,
Yeah, you gotta
Micron.
You gotta talk to it. You gotta talk to it for sure.
Please. Please. Yeah, I mean, these markets are still pretty wide, so I'm trying to work it for a favorable price here. 275. We're sliding. Don't like it. Don't love it. Let's leave it at $1.50. That's as low as I'm going to go here.
Mm-hmm.
$250 profit.
Man's got to have standards.
Yeah. $1.46 exactly is a $250 profit for the Super Bowl. So I'll just leave it there, see if we get filled. We just sold off like 10 points right on the open here, unfortunately. What else we got in the P&L day that's moving?
This Rocket Lab has been lifting all week and then fading throughout the day. But it keeps fading somewhere around like 82 or so. I know because I just bought a VIX mini future. I have a couple of these now. Just bought one for $17.95.
I like it.
It's my little, like every day, just a little something. Like we did the butterflies and put butterflies in SPX and put butterfly in NASDAQ. Just a little something.
A little something here. What am I doing with Cisco? Let's take a look. AMAT's down. I'm going to wait for these markets to settle down a little bit, and we'll see if we can get this into a butterfly. But Cisco, nothing to do here. Cisco, I have the long calls in September, so I'm just going to wait. These options are the 0 days are going to go to 0. But CoreWeave is the one that I've got my eye on. CoreWeave is green. Come on.
Green on
This
the
is like a
screen.
scratch right now with this up at 108. I'll probably just leave this on through the end of the day. This is one of those scenarios where because I wasn't assigned on the 0 days, like it's not going to do anything. You don't get assigned intraday. But if this E-minis go red and the NASDAQ goes red, I imagine CoreWeave maybe goes red, and if we get a move like down 3 or 4 points, this will be a winner. Like this is going to be a super sensitive trade right now because these 7-day options will gain extrinsic value on a downside move, and these 0 days are just going to have nothing. So this will be a super sensitive trade, but I'm going to keep my eye on CoreWeave for the rest of the day, see if we get a sell off here, and that's pretty much it.
Entirely possible.
Yeah, Micron.
Oh no.
Only up 10, unfortunately.
No Micron.
Yeah, it feels like this market's going to turn red here, which could be good.
Turn
for the
red to
SPX.
turn green.
That's right. So I had this $1.55 Iron Condor. We're trading at 78.03 in SPX. So I'm just going to put a GTC order in for this 0 day to book 50% profit. We've got this little tool where we can see close at 50% profit, just immediately hit go. Buy it back for 80 cents would give me a 75-cent winner. So let's put that in just so that if we get a little flash crash intraday, I'm not stuck holding the bag if there's a reversal. MES and MNQ, I moved these positions. So this was the 7,800 straddle. I moved it up and out to the September 30th to the 7,950 straddle, picked up more credit. I think that's another question people are asking is like, if you're moving in the same cycle, how do you get a credit? And this one, the MESU contract, I think is a good example. So the MESU, I now have the 7,800, 8,000 strangle, but I basically, where are we at? Yeah, so I had the 7,400, 7,900 strangle, and 7,900 was getting tested to the upside. So I shifted the whole thing up. I moved the put to the 7,800 and I moved the call up to the 8,000. So I went from a 500-point wide strangle where I was getting tested to the upside to a 200-point wide strangle where I moved the testing to the downside and I picked up a credit of 45 points. So this is how you do it. You just take on more delta risk, and that allows you to force a credit by making these adjustments. And over time, you just pick up tons of credit, and you're left with a nice window for where the market can move, and you can still make a profit. So this MES strangle with 12 rolls, I have like 900 points of wiggle room beyond the strikes. So down to 7,000 and up to 8,800. So this trade, like it's going to be a winner at the end of the year, unless the market drops 50%, in which case it'll be a scratch. Because I'll be able to move it and manipulate it. So yeah, love these trades. Someone was like, "Why don't you just close it? You're above 50% profit." These trades I'll have on for the rest of the follow feed. Like I just won't ever close these. There's just no reason to. I think we've proved that you can just do these perpetually and manipulate the strikes. And the further the market falls to the downside, the more delta I want to get to the upside, anyways. So I think this is where we'll live, is just adjusting to the upside, eliminating upside risk, and then taking on downside risk when the market moves that way.
Yeah, it serves as an anchor to a position in your portfolio, actually, and you sort of subconsciously have it in the back of your mind while you're trading kind of everything else. It's actually really helped me out a lot. I want to thank you because it's really helped me out a lot in how I think about my entire portfolio. I needed something like that. So it sort of acts as an anchor and helps me decide how other positions enter the portfolio and how I do it. Again, we constantly sort of lay out some of these put butterflies to the downside and the major indexes and NDX and SPX. We start to do those when we are making more money in this. It gives you that ability to do that. So it works out well.
Indeed. Micron catching a bid here.
There we go.
Up 13 again. Let's see if we can get hit here. I have this GTC order in to close at $1.46 credit, and that would yield a $250 net profit. But yeah, nothing else is really moving all too much. This USO
Where's Reddit?
diagonal spread. What's that?
Where's Reddit?
Reddit. Up 21 points. Look at that. Would you look at that? How about AMAT? Let's get a post earnings AMAT move in. Can I fly this off?
Yikes! Wow, it's tanked.
Yeah,
It's trading 500, right? post pre-market was trading almost 500.
It was at 550. Now it's at 515.
Yeah, it traded 498 in the open. It's bouncing.
Yeah, so I could do this. I could do something like this, like a 20-point wide butterfly, pick up 60 cents. Let's try and do this. So I go to a 7-day 600, 620, 640 butterfly, pick up another 70 cents of credit. All right. So butterflied it off, reduced basis by 70 cents. I got to buy back this extra short call that would explode against me if we get a reversal here. I guess I don't really need to, but I'll pay a penny to just get rid of it. Oh, 2 pennies? 2 pennies market? Fine. Fine. Okay.
No commissions on that, by the way, when you close that. No commissions.
That's right. Yeah, so now I have a 600, 620, 640 butterfly with a reduced cost basis. So giving myself the 7-day shot, if we get a big rally and reversal back up to 550, 560, 570, this could be a winner. But at least we've reduced basis. We've waved the white flag, and that's all we can really do.
Yeah.
Micron, come on, keep going. Someone asked me
Micron.
the NDX butterfly, am I keeping it? Yeah, these butterflies, we're making money elsewhere on the upside. These butterflies are just hedges. So this, the one that's expiring today, unfortunately, not going to hit it. But this 14-day is another one where we're wrapped around 28.8, but it's down a little bit right now, but it's not going to really depreciate much more than this with 14 days to go. Even though we've continued to rally out of the money, it's still going to hold on to value because it's a 14-day butterfly. Same thing to the downside. If we get the sell-off, it'll appreciate more and more the closer we get to expiration. So it's better that we have this on and it loses days to expiration as the markets move here.
Yep.
AMAT. Real quick.
It really is bouncing. It's bouncing.
It just might bounce. But yeah, I think AMAT, we can take a quick look, see if we get a little post-earnings Super Bowl in. So I would go to October, personally. You could go to September, but October, you can get more time for this thing to work.
Yes.
So, like, these markets are not great, but let's see. Yeah, 450, 440 put spread. These markets are really wide, so you got to just recognize, like, even if you get filled on this thing, you might have to give up some of your profit potential to get out. But this could be interesting. A little 10-point wide put spread to buy a 15-point or a 20-point wide call spread for a small credit. Or you could just narrow it and definitely get a credit here. 10-point wide put spread to buy a 10-point wide call spread for $1.60 credit. This gives you this nice risk graph in the middle where you have no risk in the middle because you're collecting a credit here. But if we go to expiration risk graph here, if I pick up $1.50, I can make $1.50 in the middle. But if you look at Theo, if we get a rally back up to 545, 550, you'll make $200 or so. So longer term trade if you're playing for a reversal. I like it. So yeah.
Yeah, if I'm playing for 600, I would definitely go to October for sure.
Yeah. Let's see what we can get here. $1.90. Probably not. I won't go lower than $1.50. So let's do a little 10-cent price discovery. Give it a couple seconds here. E-minis are now green. Nasdaq's green a little bit. Yeah.
Yeah, those are the ones that are weird when it's like, that shows you like markets are a bit wide, right? Like it's showing $2 and change credit, and you're at 170 and it's not getting you filled.
Mm-hmm. Yeah. Crazy markets. And it's because one of these, like this leg is $5 wide. This leg's $2 wide. So like, really, I shouldn't even be doing this. I should just avoid this for now.
It's a little weird. You would think you would get filled on a day like today where it's actually, there's a lot of trading happening. So it's a little strange. I had the similar situation when I was talking about Home Depot the other day. Just wouldn't let me in.
Yeah. I'll leave it at $1.50 if we get filled. nice. If not, it's going to be okay.
Yep.
But yeah, CoreWeave, you can see this was down like $150. Now it's chopping around a scratch with CoreWeave down like $2 from where it was. So yeah, we'll see what happens here. But we're going to take a quick break here. Join us on the YouTube chat. Again, we'll be answering questions all morning. Give us your trade ideas. We'll take a look at them. We'll do some analysis. But we're going to pass this over to TP just on the other side of this break. You're watching Tasty Live.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80-plus Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
Good morning. I'm Tom Preston, and let's take a quick check on the markets this morning. No surprise. S&Ps are up again. Small rally, and it's just following this. I think what is a little bit more interesting right now are bonds. We're down 8 ticks. They were down a little bit more earlier. Notes were down half of a tick, and that is a much bigger move in bonds than notes. Typically, I've described before, bonds move about 2 times what notes do. This is a much bigger move. So notes down 1 tick, for example, versus bonds down 8. That's about, 4 times bigger than they normally are. Couple of things I'm looking at. Reddit came in, and the guys were talking about it this morning. Reddit up sharply. Apparently that's not part of the S&P 500 or going to be. Might check out some trades in there. Reddit's markets, I don't trade. I think the last time I traded Reddit was last year. But the markets are relatively tight in here for Reddit. Okay, it's not a super hot stock, but might see some interesting opportunities in here. Looking at SMH down a little bit, no great surprise. It's what was AMAT is down $11 right now. That came out last night. And again, Cisco, see if Cisco's rallying up. No, Cisco's killing me. I'm short my put spread in there. Let's take a look at Stub. I'm short the 17.5 puts today. A lot of my stuff is expiring. So I'm short the 7.5 puts. Where are they trading right now? At 5 cents. I'm gonna cover it. I'm gonna see if I can buy these back
For real?
while we're on here. Come on. Let me go in here. Positions, find my stub trade. Stub. Let's get in here. Pink, close position. All here, and let's try for 3 cents. Let's give him a penny, see if it get filled. Yeah, filled at 3 cents. Okay, not bad. So that actually turned out to be a decent trade. Let's check out SpaceX. I'm short an Iron Condor in there. That's actually holding up pretty well. I'm short the put spread should probably close this out, the 22.24, and then the 42.44. The what is it? The PPI number, is that what it is, or the CPI number, Consumer Price Index? I guess it came out not looking great, but the market does not care. This is just another one of those cases of what gains with the economic headlines don't. The market's already absorbed that stuff, and with the S&Ps, rallying like this, it's just bulldozing upwards. So yesterday's cherry bomb, I wrote up a potential trade for a put spread in the SPY, and the rationale is that the Treasury bond yields, they had an auction yesterday and didn't go so well. The demand was kind of slow. And because of that, they had to push the yields even higher. So the yields in the 30 years are the highest they've been, I guess, in 25 years, since 2001. Is that horrible news for the market? Well, it's, obviously the market doesn't care that much, or else they'd be down, right? But there is a point where a couple of things will happen. First of all, it's going to start pressuring those higher rates, despite the lower probabilities of Fed rate hike at the upcoming FOMC meetings. Despite that, okay, that there's going to be upward pressure on consumer borrowing. Credit cards. Well, credit cards are already out, but you want to buy a house, borrow money to buy a car, et cetera, et cetera. That's going to get a little bit harder for people. The other bigger point too is for savers, and savers over the past couple of years, people just who have cash in their accounts, have been really doing well with CD rates, ranging from 3.5% to 5%, a little over 5% in some cases, if I recall. So anything that pushes interest rates higher and makes them sit on that cash, even like, hey, I'm earning X percent. That's pretty good. I'm happy with that. Okay, fine. I'm not going to argue with it, but that could start slowing down the money flowing into equities. One of the things also I was looking at is the volume, and here's a chart of SPY right now. The volume, volatility is, that's another question. The volatility is just cheap. The VIX is sub 15, and that complacency, I just got to think it's going to punish the market at some point. So the volume was relatively low on this rally. So what you don't see is it's not an indication of, geez, we got to cover our shorts. That's not what was happening. But it's kind of a tepid little rally, much stronger volume on this rally here as you look at it. And again, right here, a lot of stronger volume on some of the other moves. It's not happening here. Again, I wouldn't write off the S&P completely. I'm not shorting S&Ps right now, but I am going to buy a spider put spread out in 39 days. Let's see which ones I get. The 78.46. Let's do this one. See if I get it. So what I like about the 780 put spread is a bearish trade. A couple of things. First of all, it has a fairly high P50 number for a debit spread. 68% probability of making half its max profit, $55 or so, versus $84 of max risk. That's pretty good. Okay. And the reason I'm choosing another big point is that it's generating 26 cents of theta per day. The reason it has positive theta is the debit of the vertical. In other words, the 85 cents is cheaper than the intrinsic value of that 780 put. So the 780 put with the stock at 778.36 is $1.60 or so in the money. It's trading about 60 cents or 70 cents cheaper or so than intrinsic. So that's not bad. I'm going to route this at let's try 86 cents. See if somebody bites. I'm sure they will. And then let's go in, just because I want to get this done, let's go into the SPX. Let's do our little iron condor. Let's start with this. Not quite $2. They are sucking volatility out of this thing. I can just tell right now. $25 away to the 77.45s. Let's go up here. Do I have any $2 option? No, this is dirt cheap. I don't love doing this trade. For some reason, I have a bad feeling about this trade today. But you know what? I'm going to get in there and play because it's the discipline and execution. Are there any? Should I pull this up? Let's pull this up here. Take in a little bit more credit to give. Yeah, to give myself a little bit more room in the credit. Let's ship this. 275. See if anybody plays. One of the things I got to look at are some positions. Bank of America is going against me. My yen position is going against me. I'm short a call spread in the yen. I'm short a call spread in the British pound, 6B. Those are both up against me today. Losing a little bit of money in there. And I'm going to start looking at maybe selling some filled in my iron. And I'm going to go in here real quick. Let's do this. So what is 1/2 of 275? What about $1.40 or so, $1.35? Let's do this. 1.35. Let's do that. 1.35. I'm just going to buy it back for that. Just route in order. Again, we'll see if it hits. Let's go into crude oil real quick before I have to sign off. CL. So my rationale for a neutral trade in crude oil is you get this push and pull with the, oh no, they're blocking the Strait of Hormuz, or we don't really care, that sort of thing. Negotiations are on, negotiations are off. And right now it's, just reading an article that Scott Bessent, the Treasury Secretary, is going to start squeezing Iran with more economic stuff, whatever that is. I don't really care about the what, or I don't care about why it's happening. It's just what's happening. Crude oil is down 31 cents right now. The long term, I'm bearish on crude oil, but for now, I think it could just noodle around like it is. Let's check out, let's see what we get for 3 days. Probably not that much. Again, crude's a big contract. Let's see what we get for this. Just outside its expected. Let's do this. So I can make $260 versus $740 of max loss. Let's tighten this up one strike to right here. Let's just see what happens. Yeah, $330 versus $670 of max risk. Again, like I said, folks, it's a big contract. Let's see if I get filled. Let's take a shot. Working. Nothing done yet. So that's what I'm looking at right now. As far as some of the other stuff like NVIDIA, thinking about maybe reestablishing a short put spread in NVIDIA. Apple hasn't been doing so well recently. Maybe looking to sell a put spread in Apple. Volatility, IV ranks fairly high. So that's what I'm looking at for today. We have a lot of stuff coming up for you. Some great guests coming up on the show. Coming up next, I will be back on with Chris Vecchio at 10 o'clock to take a look at some of these markets again and answer any questions you have. If you do have questions, send them into research@tastylive.com. And I will be back on at 1 p.m. this afternoon for half an hour of just live trading. So with that, I'm going to sign off and hand it back to Jermal and Chris.
So it's something our own way. We're making our own way. We're making our own way, Watch the world fly by. Watch the world fly by. We're making our own way. We're making our own way. We're making our own way, We're making our own way.
What's up, everyone? We are back. E-minis flat, NASDAQ flat. Everything's flat. Nothing to do in this market, but we do have some single name stocks making some big moves. Jermal, why don't we bring on our very special guest, Mr. Puru Saxena from Dubai. How's Dubai right now? What's the weather like over there?
Yeah.
It's super hot. I just got here actually. I was away in Europe for about 3.5 weeks traveling across a few countries. I'm just here now for a bit. So it's super hot right now.
I can imagine. So these markets haven't been moving all too much this week, but is there anything that you've got your eye on maybe over the next couple of weeks, or anything that's stuck out to you from the movements this week?
Well, we were expecting this big sell-off we saw in the AI names, the semiconductors, the memory stocks, the Kospi. So we basically took some cash off the table. We sold about 45% of our holdings, raised cash, bought some short-term puts to protect some of the downside, mitigate the downside. And then we had this horrendous July where, many of these AI stocks were down 50, 60% very quickly. We also had a drawdown. Our portfolio was down about 20%, which is pretty acceptable given what happened in the broader names. But we sort of started reinvesting the cash over the last 2 weeks or so. We thought that, the market was pretty washed out. Not the broad market, but the AI names, the sectors which had been hit after the big run-up of the March lows. So we reinvested some of the money, removed the hedges and stuff, and now we've been positioned for a rally. We think that this rally will probably continue for at least, a couple more weeks. We may get a bit of a wobble in September, but we think, the next few months, especially year-end, historically is a strong time of the year. And with the Fed now on hold and the expectations of a rate hike off the table, we think, we could be setting up for a nice multi-month run-up.
Yeah, we saw a lot of those moves in those AI names, as you mentioned. Free cash flow has been really the catchphrase there, and all of them. It seems like spending too much has been one of the things that has caused these names to struggle. I'm curious, what made you feel heading into the earnings season? What was it that made you feel a little trepidation in some of these names, and why did you choose to sort of exit positions in some versus maybe hedging with options in others using puts or anything?
We just saw that the price action had gone absolutely nutty, to be honest. Some of these stocks were up 200, 300% in 2 months, 2.5 months, and they were very, very overextended relative to the 40-week moving average. Now, we use at Alpha Target a combination of fundamental research and technical analysis, stage analysis to be precise, to manage the portfolio. And basically, whenever our holdings run up too much and get too far extended relative to the 40-week moving average, we tend to take 40-50% off the table. So coming back to your question, we looked at the options pricing, the premiums on some of these names, and some of the really volatile high beta names, the premiums were super expensive, very rich. So in those cases, we sold like 80-90% of those positions, effectively cashed out and locked in the gains. In other names where the premiums were a bit more modest, 8 or 10% of the total value of the position, we basically trimmed half and bought the puts. So it was really a decision based on what the pricing of those options were. And some of the volatile names, we just cashed out 80-90%.
I like it. Yeah, I think similar to how we treat options trades, if you're reaching a profit that's a greater profit than you are expecting in a certain period of time, it makes a lot of sense to take that off or find hedges to offset some of that future risk. So yeah, moving averages, especially if you're using static delta, looking at the moving averages and the Bollinger Band ranges and things like that, you can really see when you're exceeding the implied movement or implied ranges. So I like it. Yeah, I think this market is interesting with some of these single names like AMAT crumbling 4% after earnings today, after earnings yesterday, I should say. Some of these other stocks, NVIDIA's coming up though. What's your thought on NVIDIA? Are you bullish, bearish, neutral? Do you think it's going to have a big move? Right now we've got a 15-point implied move for the 14-day cycle. So pretty decent, all things considered.
Well, we follow the AI trade very carefully, because we've got a big position in some of the AI stocks. We don't own NVIDIA. Perhaps we should, but the multiple is very cheap. The market seems to be concerned that we are at peak earnings. If you look at the data for, the metrics which we track for the AI boom, nothing suggests that we are basically, deteriorating or we are at peak cycle. If you look at, GPU pricing, that keeps increasing. You look at what these companies are announcing. They're announcing, record orders and so forth. The neo clouds are, making, their business is booming effectively. There's nothing to suggest that their fundamentals right now, at least, have changed for the AI boom. So we just think that, NVIDIA likely being, the big fish in this arena is likely to do pretty well. I would be very surprised if the numbers came in weaker than expected. I think they will beat, and I think the stock will likely react positively. We just invest in high growth names, so we cashed out of NVIDIA about a year and a half ago, locked in the gains, and we've been invested our own portfolio in some of these younger companies which are growing at a much faster pace. We just think that there's more money to be made there.
Yeah, it sounds like you guys are in the picks and shovels, as we say, with regard to that idea. And I feel like a lot of people have mentioned that ideology. You talk about compute future. There's a reason there's compute futures now, right? These prices continue to go up, and now you can even speculate on where they're going. But I know it's something else. But all in with you guys. You mentioned you guys have been basically all in the AI trade specifically. But have you sort of been in any ancillary trades as well? We saw such a rotation play out for the better part of July, right? Back and forth between chips names, back and forth between software names, the ServiceNows, the Microsofts of the world. And then we also saw a little bit of rotation in the consumer staples as well. Have you guys, I'm sure you noticed it as I see you nodding, are you guys in any of those other names, or has it just strictly been mostly AI stuff?
We've been strictly in the AI stuff. We've got positions in semiconductor stocks. We've got positions in some of the connectivity stuff. The neo clouds and so forth. We've been looking at energy, but energy stocks have run up so much already, the ones which are involved. So we are basically concentrating more in those companies which have something unique to offer, because open source models are actually not very good for the frontier labs because they will compress their margins. But the cheaper open source models are actually fantastic for the AI proliferation, because if AI is cheaper to use by companies and consumers, the demand for AI will go up, and that's actually wonderful news for AI infrastructure companies, because the more computers used, the more data centers that are built, the more money these guys are going to make. At some point, we will see, in my opinion at least, having lived through the TMT bubble in 2000 and 2001, which is when I just started my career in the late 90s. So I've been doing this for a while. We had this insanity then. I don't see any signs at the moment, but if history is any guide, if you have a major technological shift and animal spirits run rampant, then historically you end up with a big bubble. So I would not be surprised at some point if we do have another big run up. Perhaps starting in September and then going all the way into early next year, where some of these stocks, they may get completely unhinged from reality. And at that point, we'd be on high alert and probably be looking to lock in our gains, because we don't want to be holding back on the way down. But so far we still think that, there's money to be made at least over the next 6 to 8 months holding these stocks. The memory trade looks a bit precarious to us because, yesterday SanDisk announced that the revenue will continue to grow in the teens from 2028 financial year until 2030. But the issue there is that, we've done some research on this, and our analysts have looked, and basically memory stocks in the past, guys, have peaked when the growth rate has peaked, okay? So these companies may still continue to grow, but when the growth rate normally peaks for these stocks, that's when the stocks peak, even maybe a month or two in advance. So if the growth rates or the revenue growth rates, these memory stocks peak sometime, next year, history suggests that these stocks will put in a top maybe 2 or 3 or 4 months prior to that. So we may have one last, hurrah in these stocks over the next, few months or so. But I would be very careful with memory names because, when a company which is growing, at a few 100% a year, suddenly the growth rate goes down to, 14, 15% year over year, the market doesn't like it. And, a lot of people now on Twitter say, or on X, they say, these stocks are so cheap because, the PE ratios are so low. And, the market is not stupid. These stocks are cheap for a reason because the market doesn't believe that these peak margins and these peak earnings are sustainable. And, historically, when these cyclical commodity type names have become, very cheap after a huge run up, that has been a sign of an imminent top. Now, I'm not saying that these things are going to top tomorrow, but, I'd be very careful holding memory stocks past maybe early next year.
I mean, you've been doing this for a long time. So if you're like Mike and I, when you travel, you see things that sort of give you trade ideas or fall into different theses. I haven't been out the country in a while. Mike was in Japan more recently in the last year and change. But you've just traveled to Europe and you're in Dubai. I'm curious, have you seen anything that gives you sort of inklings to say this AI trade, this is incredible, this is real?
I mean, Europe, for me, I've been to a few countries. I was in Europe last year, went to several countries. This year, I went to, south of France, Holland, Germany, Prague, in Czech Republic, and then Vienna. And, Europe is, a funny continent. It's historically fantastic. The architecture is great. The nature is nice. It's a nice place to spend the summer. But technologically, Europe is just so far behind. If you look at cities like Hong Kong, or you look at even the US, or if you look at Dubai or any of these new cities, Europe, doesn't even accept credit cards, in restaurants. So if you eat the meal, then they say to you, okay, we only take cash. So once or twice I was forced to actually leave the restaurant, go back to where I was staying, pick up my wallet, take the ATM, go to the card, go to the ATM, leave my son behind as security in case I didn't return. It's happened twice, And then I was in a supermarket in Cannes in south of France, and then there was this lady there, who was paying for the groceries with a checkbook, and I was thinking, gosh, in which century are we in? There's no cards, no cash, people writing checks. So, Europe is not really a yardstick, in my opinion, at least to, see where the AI trade is. If you want to see that, you've got to be in the US, or you've got to be, in one of these newer cities in the world to see really what's happening. But, just to give you an idea, agentic AI is now proliferating, and agentic AI, inference workloads and so forth, will be the vast majority of the AI workloads in the future. So I still think that this is early innings as far as the proliferation of AI is concerned. It's not going to be a straight line. I think there will be air pockets if you have a recession, if you have some exogenous shock where capex basically slows down or dries up. Some of these AI names are going to go down 50, 60, 70%, but then they will recover and come back. But so far so good, and I just think that we're still very early in this. Simply because if you look at some of these forecasts which are put out by McKinsey and Bloomberg and so forth, they are forecasting that AI inference workloads are going to grow by about 30-40% CAGR over the next 10 years. So we are still pretty early. The vast majority of the population hasn't used an agentic AI, in their life. Most people use ChatGPT and stuff for queries, and Anthropic is now doing great things as far as enterprises are concerned. But ultimately, I think if you have a multi-model world where you have different LLMs running, that actually is very good for society. That's actually safer for society. And that's actually very good for AI as a technology, because if, one or two players control this thing, then, we are looking at some serious problems. And obviously, the cheaper the technology is, the more it is used. And as long as, the cost per intelligence keeps going down, then means more and more people are going to use it. And AI is going to be used in the vast majority of industries, maybe 5-10 years from now.
Yeah, I think that is ultimately going to be the reality, regardless of whether we like it or not. We'll have dashes of AI in all businesses. I mean, even in the businesses you don't think you'll see AI, they will certainly be using AI to make their business processes more efficient. I know we do all the time, even at Tasty, with show descriptions, titles, those kind of things. It takes out the work that takes a lot of time, or even a little bit of time. We could do it in 10 seconds. So that will be the future for sure. So I think there will be some validity and lift for a lot of these stocks that are in AI. But just like any other like bubble type move, you're going to have your winners, you're going to have your losers. There's going to be products that we're talking about now that we're not talking about 5 years from now, because they'll be gone. That's just the reality of the way that these things work. So we'll see. But yeah,
based on what he
NVIDIA
said, what's going on in south of France, we need to get long more of these stocks, is what it sounds like.
I mean, these guys ask for cash, and they tell
That's
you that
crazy.
after you have the meal, not even before. So you basically have to run and get your wallet and go to the bank and get some money out and get your son released from their custody. It was a bit crazy. You don't have much
That's crazy.
in Asia, but I mean, it is the way it is. And, most of Europe doesn't even have air conditioners. You go there and most people say, that, it doesn't get so hot here in the summer. I've been hearing this for the last 10 years. It's been routinely going up to 35, 36 degrees. So, apartments and stuff don't have air conditioning and stuff. So it's just, a sort of strange place, given, that these countries are not exactly poor. Per capita GDP is pretty high. And, they're sort of kind of be stuck in the last century.
And you add on the fact that they're probably going to raise rates before we do. Huh?
Yeah, it looks like it. I mean, the economy is not great in Europe. All the innovation happens in America. China is doing great things. Semiconductors, obviously Taiwan. Korea is doing good stuff in memory. The UAE is doing pretty amazing stuff as far as AI is concerned, and autonomous cars and so forth. For some reason, call it socialism or government policies or whatever, there is just no incentive for people in Europe to set up a business. I was talking to business owners in Europe, and they were saying, that they just don't hire people because it's just so expensive for them to hire staff, because once they hire somebody, they can't let them go easily, and then they have to pay, pensions, and you have to pay all the other stuff on top, and taxes and so forth. So who suffers at the end of the day is the customer. You go to a coffee shop, you go to a restaurant, you order a coffee. The same person takes your order, the same person makes your coffee, the same person heats up your panini, they make the sandwich, and then you have a queue of 10 people waiting and getting angry and agitated as one person's just running around like a headless chicken. It's not a way to run a business. But if you look at it from the point of view of the business owner, they say it's just too damn expensive to hire people. And too onerous. If things go wrong, you can't let them go, and they just don't hire people. So the customer service is not great.
That's fair. Well, thank you so much.
Great
Puru.
insights.
Appreciate your time.
Yeah, good to meet you.
And enjoy Dubai.
No, thank you very much, guys. Yeah, thank you very much for having me on. Let's do it again sometime. My pleasure.
Sounds good.
Okay.
E-minis flat, NASDAQ flat, everything's completely flat. We're going to take a quick 90-second break here. We'll be back on the other side with Tim Knight. You're watching Tasty Live. What's up, everyone? Welcome back to the show. E-minis down 2, NASDAQ down 2. What a day. What a crazy, massive sell-off we have here in the market. Tim, welcome to the Friday session where we talk
Hey guys,
about...
hear his theme music.
Yeah.
Oh,
You hear it.
I got to get a mustache or something.
There you go.
Yeah.
Brought the sideburns a little bit.
Yeah.
A lot
Got
of it.
mutton chops, maybe a
Did you have the
eight-track.
sideburns as in the teens? Did you have those? Did you have the long sideburns?
Well, here's the thing. Let's talk facial hair a bit. No, I've never had a mustache or beard or anything like that. Back when our children were younger, my darling wife would take them on these long fencing expeditions because we're knights, so we fence, and sometimes they'd be gone for like as much as 8 days. And during those 8 days, I'd be like, let's give it a shot. So I just stopped shaving to have some semblance of like what it would look like. And by day 8, it's like, wow, I look 15 years older. And so I can't really use that. Plus, and I know my wife. I've known my wife since we were kids, and I know she, God bless her, she wouldn't say a thing, but she'd probably be just like, ew. So before they came back, I would shave. So no, I've never had anything like that. And men know that even if your hair, which I'm turning gray, but even if your hair is not gray, that beard will be. So yeah, you want to look like a wise wizard. Just go for the beard. I'm not going to do it.
That's great.
Well, that's the end of our program.
And that's that.
And that's that. No facial hair. Got it.
Yeah. So, hey, let's look at some charts. How about it?
Let's do it.
So, a couple of things cooking. Let's start with the basics. We'll just peek at the ES and the NQ. On the one hand, bulls absolutely in control. Not that they haven't been in control for the past 18 years, but after the quagmire we were in through the summer, last week, they just grabbed that baton and ran with it. And yesterday, they just kind of put icing on that cake. And at the moment, we're kind of not doing much of anything. We're down just a touch on the ES and the NQ. On the ES, what it would take, I doubt there's any bears surviving out there besides poor old Tim. But if there's what you want to see is we need to have a failure of this breakout line, which would take something big. I'm guessing a really large meteor heading for the Earth. And the NQ, this one is not at lifetime highs like the ES, and has not violated this descending trend line, but it has shown real strength. And so kind of the last wispy hope for any diminishment here. And let's face it, late August, September, early October, these are all months, and this is all seasonally when the VIX should start climbing, when worry should start to grab the market. If we want to see that kind of downturn, we must not violate this uptrend. We've got to start to not only see some selling, but to crack beneath this bar right here to kind of do away with, because this is tiny, but that little saucer we've gotten over the past 6-7 trading days has definitely given the bulls a nice lift.
Yeah, it's been a wild run, but seeing a little bit of a pullback today in the E-minis and NASDAQ. But to your point, it's like, what is the catalyst that can bring us into the mid-14 VIX up into the 20s again? And I don't know.
Global thermonuclear war. That's it.
Yeah.
That's all that's left.
Feels like it.
Yeah, I mean, if we got global thermonuclear war, if it was a full-on conflict, existential crisis, I'm thinking VIX in the mid-20s, possibly.
Yeah.
But save that, or the aforementioned meteor. Yeah, we're down at we're grinding around like at 14. It's just sad. But seasonally, honestly, it should, especially with, I hear there's an election coming up, there should be some dynamism coming back into the market, I would say, awfully soon. And, looking really, really, really short term, just in the past couple or 3 hours, the NQ has given up. It's the NQ and the ES are both red. It's not much, but it's not nothing. And this is what we want to possibly see, and forgive me to go back to the ES here, is what I would describe as kind of a failed bullish breakout, because this was tremendous. This rise here was just explosive. And the question was, will this momentum continue? Can they add to that? And they did. But I don't know if it's just Friday profit taking, or what, but I'm still focused, and I've had a couple of bright spots this week that I'll touch upon. But this has been very much a week for the bulls ever since a couple of Wednesdays back. But at this immediate moment, at least the bears are getting a little teeny bit of, a thimble of ice water in the desert right now. So, hey, this has been a rough week for the bears. Let me just hit on a couple of brighter spots and some interesting charts. And I've got kind of a sector to look at too in a moment. China, it's a little bit green right now, but on the whole, this has been going well. I don't understand the mechanics as to why. Clearly, China is sort of in a world of its own versus the U.S. stock market is not tethered to U.S. stocks. And as I've shown before, this multi-decade chart has produced this really interesting kind of cyclic phenomena going on around that line. And although they're not highlighted here, every single instance of these rounded, the kind of really inverted V's, has been followed by a nice tumble. And a general point I try to make with my charting is that stocks are like people; they have personalities. And you may have a stock that produces pattern after pattern after pattern, and it fails every time. What should have happened never happens. Well, you can pretty much count on that continuing to be the case. Whereas with FXI, one of the appeals for me is that it seems to be really consistent, forms a certain pattern, and it follows through. And so that's its personality. So that's why I'm into this one.
Yeah, it's been a tough trade for anybody who's bullish on China over the last couple of years. And you look at that chart, I think a lot of people. We did this last time. I reflect on that 2007 period. That's when I first started trading 06, 07. You could see this just crazy move. And over the last couple of years, it's just been kind of blah. So I don't blame you for fading this.
Yeah, and the other one, which I'm grateful to the trading gods for, is our buddy Bitcoin. I did, and I know we all do different videos here, and I know historically crypto/Bitcoin videos aren't that popular. And I just did one which isn't getting the views it should. I'd like to really encourage people to check it out, because even if you don't, I don't trade crypto. I have no Bitcoin, but I love the product because it's really important in terms of psychology. And so I would encourage our viewers to check out on our YouTube channel the Bitcoin video I did yesterday, because it talks about the long-term pattern here. And for the week, red is red, 1, 2, 3, 4, 5 red bars in a row. I like it. And so this has been slogging down on the futures from around 65,000 to, it's not a huge move, but this has been a very placid market lately. So about almost $3,000. And so, I'm, as I've mentioned, I'm short MARA, MARA, short MSTR, and long the BITI, BITI, the inverse fund. So just want to really tell our viewers, check out the video. Even if you have no interest in Bitcoin, it's still interesting from a asset psychology perspective.
Yeah, Bitcoin has been one of those things where we're kind of pushing it around with a stick, being like, do something here, give us something. It hasn't done anything at all. But if there is, what's crazy is if there is a big run up in Bitcoin, is it because there is a massive run up in the NASDAQ and it's just positively correlated, or is it something else where there's some crazy inflation number and people start going back to that mentality of, Bitcoin is the safe haven for fiat currency going to zero?
Yeah, right.
It'd be crazy.
Yeah, feels like this is the quietest Bitcoin has been since they started trading the futures, which was late 2018. I feel like this is like the quietest it's been for some time.
Well, we've hit upon this whole gambling thing this week, and I think a big part of this is that there's just so many other places people can go to get their yayas out in terms of speculation. And just like volatility tends to feed on itself, so does placidity, or whatever the antonym you want to use is. And we'll get alliterative here. Bitcoin is boring, and I think that people are just kind of walking away from it. And the other thing, which I'm hoping is the case, is that it looks like it has the tendency of, like, when assets are surging, it just kind of sits around doing nothing, and when assets are falling, it really falls. So it's kind of this diode. We'll see, if in the next 20 years stocks ever fall more than 1%, we'll see if Bitcoin tumbles hard. But it's behaving itself because, it's able to actually go down when everything else is going up. We're almost out of time. Let me hit real. Yeah, let me super quick, and I'll just bang through 3 related charts really quickly. And this touches, Jermal, on something we were talking about with respect to price stops, stop loss orders. And this one saved me yesterday because I was short workday, WDAY, and my stop was right about here. And I got stopped out of loss, but it wasn't this loss. And so I realize you guys tend to trade options as opposed to just straight equity or short positions. But I think that's just a good example of why I have those things in place, because this happened really, really, really fast, and that's exactly the function they're supposed to provide. But relatedly, I do think that even though they're kind of in the same sphere, there's a couple of stocks people might want to peek at in terms of possible bearish positions. One is Salesforce, CRM, which is getting quite close to what I consider important resistance up here. And the other one is Intuit, INTU, which is just about sealed its price gap. So the whole SaaScopolis has undone. It's been surging for weeks and weeks, but there are, I think, opportunities within that realm. So just food for thought, CRM, INTU.
I actually agree with you on CRM. It's actually hitting the 200-day moving average. I think it's getting resistance there. You're absolutely right.
All right. Well, it's been a long week, everybody. I hope you have a good weekend.
Likewise.
You as well.
Okay. But yeah, we'll see if we can get some movement out of this. But appreciate you, Tim. We'll see you later.
See you guys on Monday. Bye-bye.
Sounds good. E-mini sliding here, down 9, NASDAQ down 35. We got Cem Karsan on the other line of this, or the other side of this break. So we're going to take a quick 90-second break. Join us on the YouTube chat if you haven't already. You're watching Tasty Live. What's up, everyone? Welcome back to the show. E-minis down 11, NASDAQ down 55. Things seem to be taking a turn here, aside from some single name stocks that are moving in polar directions. But enough about that. We got Cem Karsan on the line. Cem, how you doing on this fantastic Friday?
Happy Friday, TGIF. Good to be here, guys.
Likewise. TGI Fridays, I used to love the honey mustard.
Oh, man. Listen.
The primo honey mustard at TGI Fridays.
Yeah, at a certain age, that was good eating. That was good eating right there.
At a certain age. I don't know that my stomach can handle that anymore. But yeah.
Exactly.
Yeah. Now it's a big risk, high risk.
For sure. Yeah. Jim, it was largely a quiet week, several days until yesterday. Take us through the mind of SPX traders over the last 24 hours and what's been going on.
Yeah, so towards the end of the summer, the flows are still very strong. Vol compression is still there. People are out at the beach. In other words, the volume is low, but the structural flows, the kind of the Vana and Charm flows that I talk about, the supportive delta buying that happens at the index level are strong. And they're actually at their strongest entering the Friday into Monday, right? So this is where we're of OPEX. After that, kind of level off until and kind of plateau, start falling off after expiration the Wednesday till OPEX, then it really falls off a cliff. Okay, so that's the general kind of structure of what happens, and so a lot of kind of sideways action leads to even more vol compression in the short term and more buying. So I think you pair that with the fact that momentum has been, as we kind of highlighted, something you want to watch, has been quite strong, like the momentum factor, the growth names, and that has given enough kind of buying pressure to kind of carry on kind of momentum in that part of the market as well, despite what I would argue is actually not great flows specific to that part of the market. So in other words, follow through to what support, consolidation for a little bit, natural Vana charm flows and the peak part of where that demand is coming in. You open the door in the morning, and that's when those flows kind of come in. And if it can sustain that, then the natural kind of low volume is to keep drifting higher, right? But again, as I highlighted, you really want to watch that momentum factor, and we're seeing a little bit kind of sideways today. But the next week, important to see follow through there. And the reason, just so I'm clear, is because there are all these calls. There's massive call positioning still on that part of the market, long call positioning in that momentum kind of growth area of the market. So if you don't see fall through, the natural thing is dealers are short those calls, long stock, that going into OPEX they sell. So you need to kind of activate kind of the gamma, which is what happened a little bit yesterday. But again, if you don't see the follow through, what happens? This morning we didn't get follow through. So early in the morning, what happens? Sideways, and then kind of start rolling in that part of the market. So people are used to thinking in two dimensions. You either buy or you sell. Important to understand that calls options positioning is not 2D. It is you need to either activate the gamma and create momentum, and then in which case you get a really fast move like we saw yesterday. And then if you don't get continued momentum given the price, then you'll see what we see today, which is a slow kind of selling back out of some of those deltas. And so that's how I would describe the last 2 days of action so far. But generally speaking, at the index level, very supportive. Even if you get a decline here, I would expect it to be small. And honestly, most likely outcome today is a sideways supported market that digests yesterday's move.
Yeah, I think right now we're looking at a less than 100-point move in SPX for next week. So somehow the volatility is even lower next week than it was this week. Only a 15-point implied move for the rest of today, which shouldn't surprise anyone. But yeah, I think these intraday moves, the pricing of the intraday moves is really low, which I think can play more into the hands of if there is that continued gamma move to the upside. Maybe you see an outside move to the upside, an inside move to the downside, but we're going to have to see.
But one thing I will say, I want to jump in here is one thing to take a look at is yesterday we saw market vol up again, right? This vol is getting to a floor. It's too low. When you rally, it's sliding to too low a vol. And what do you see? A bit of a call squeeze. So, and even with the pullback today and the sideways action, you're seeing the VIX kind of hanging in here. Remember, there's that Friday effect. So this actually, when you're seeing the decline here on the VIX level, that's actually not as bad as it may look, right? Because there's the weekend ahead that they're still pulling out in terms of time that's not being priced in that VIX calculation. So know that the VIX has been strong. 30-day plus vol, which is what we called for, has been quite strong in the face of kind of hitting a floor. Meanwhile, market's not really net going much of anywhere, and the net effect is you're getting selling straddles in the very front, meaning days, first week, even a couple weeks here is actually performing decently well. So that calendar thesis we've talked about, let's start buying that vol that's longer than 30 days. Being short the shorter dated stuff is actually been working quite well.
Yeah, I mean, as Mike just showed, looking at the VIX term structure, there's about $2 and change difference between month 1 and month 2. And of course, August VIX is expiring next week. August OPEX next week. Typically, you would think it'd be quiet for August, but you say that it's not necessarily the case.
Important concept here. So the month before a quarterly OPEX, that expiration tends to be a very important expiration, and the month of OPEX tends to be historically the ones where risk can really appear. So this August to September cycle for the monthly expirations, February OPEX to March OPEX. Anybody remember anything that might have happened exactly Feb OPEX to March OPEX at some point? Anyone? This is the COVID crash, literally day to day. I don't know if people know that or not on here, but the day after Feb OPEX is when the COVID crash happened. The day after March OPEX is when the V bottom started. That's not a coincidence. By the way, we knew about COVID in December. Market rallied right to Feb OPEX. And it's like
not that you say that. I remember there was this huge bullish move on September, through September 3rd. It was a huge move. I remember that in 2020 for sure.
Yeah. So you get these very important kind of cycle moves. Why might that happen? Why is that important? Is it just random coincidence, data mining? No. All the big positioning is in these quarterly OPEXs. The skew, the risk is concentrated, that positioning in those quarterly OPEXs. So
see that peak right there? I think that's September, the one. No, not that one, Mike. To the right, to the other way, the right. Yeah, right there. That's that. I remember that. Yeah, I remember that.
So the big idea here is that can be supported if you get through these first 2 weeks of the cycle or 3 weeks of the cycle. Yes. That becomes Vana charm support. But early on, that risk is out there. And if the market can start to decline and activate that gamma, that vega in those out of the money puts, in those quarterly OPEXs, it can lead to real big declines. Okay? And I'm not calling for a crash. This is not like, up, down. This is, be aware that these cycles, as you come out of the August OPEX, can often represent tops, short-term tops, that then lead to a meaningful decline. They are riskier than usual. Again, if you get through the first 2 weeks of, at the end of August here, and things are kind of sideways and muted, it can eventually turn to support as the Vana and charm flows, the delta buyback from the hedges comes back in. But those gamma effects and the potential tail in the market definitely exists here. So this is a big reason why September can be a big risky period. It's also why what's the second worst kind of period. The cycle February to March is actually the second worst month after August to September. Same reason here. So one's after kind of a dull, low volume, vol compressing summer where vol can expand, right? This is that summer of George concept. One is after a very supportive December, Santa Claus, January effect kind of period where you tend to have the ability to retrace in Feb to March. So these are important kind of months. Again, November, December is a little different because it's at the end of the year, and there's a lot of big structural flows that are, what do we call re-leveraging effects at the end of the year. Also, big holiday compression in that period from Thanksgiving and Christmas that helps support that period of the year. And this other one falls in the summer, right, May to June, but the sell in May phenomenon is really tied to that mid-May to June. So really these three monthly cycles are incredibly important for the reasons kind of we mentioned, and more important than ever, I'll highlight, because the vol and options positioning is dramatically bigger than ever.
Yeah, you've been talking about the summer of George for a while. Summer's almost over, man. I mean, what are you going to do?
I know.
Do you have a name for the fall?
Well,
do you have a name for next summer?
Well, you remember, part of the reason I love the summer of George concept is what happens to George Costanza at the end of that episode. Do you guys remember? It doesn't end well.
I love Seinfeld, but I don't know him. I don't know him by name episodes like a lot of people do. Which episode is this?
Yeah, this is this. It's called The Summer of George. It's literally the name of the episode.
Is it? Oh,
yeah,
okay.
And George basically gets a leave from the Yankees. Gets fired. Or the Yankees gets. This paid leave, and he's like,
That's right.
And so
I remember. Okay.
Yeah. So it turns into like, this is gonna be the summer of George. I'm not gonna do anything, and then he runs into some problems. Just check it out yourself. But point is, the summer's coming to an end, and it all started all very calmly, and everything very, very much seemed like it would be the best summer.
Well, is it going to be the fall of Jim?
I don't know about the fall of Jim, but the fall of markets. Yes, usually you get some interesting volatility because, as we've talked about, that vol compression goes away after the summer because people come back and other volumes increase, and the vol compression, which is dominant during that period, then becomes smaller and less pinning. And so there tends to be a mean reversion, and that vol increase tends to kind of create some wider ranges and introduce potential risk.
Well, we got some preview catalysts, right, Mike? I mean, we got in under 2 weeks here, we got NVIDIA earnings. We'll see what they say about CapEx and about free cash flow. We got, the Fed meeting, Warsh again, who hasn't really said much, but yet without saying much, somehow it's affected markets in a couple of ways. And these are all on the other side of VIX expiration and on the other side of August OPEX. So we definitely have the catalysts coming up and, another holiday, right? Which we're sure to hear stuff over the holiday of what the hell is that damn holiday? I should know. My daughter's birthday is right at the time. What is it? September 5th, 6th? What is that?
Labor Day?
Yeah, thank you. Labor Day. A long weekend. I mean, there's no way we don't hear more news about possibly the war. Who knows what else? So we definitely have a setup here.
I'll also highlight a couple quick other things. In the last 3 midterm elections, SPX has fallen 10% or greater. Midterm elections, September 19th, 2014, September 20th, 2018, August 16th, 2022. Each one of those was the beginning of a more than 10% decline, and it's the last 3 midterms. That's not a coincidence. One of the actual declines start September 19th in 2014, which is OPEX day. September 20th, the day before OPEX of the September cycle, and August 16th, the day before VIX OPEX. That's an August one. So point here is all 3 of those declines started either the day before or after VIX or OPEX itself. Not a coincidence. Okay. So again, it doesn't always happen here in August. It could wait till SEP OPEX and after the Vana Trump flows to a final supportive, and then you go. But these 2 cycles in their own way tend to be very dangerous. And so not all days are the same. Certain days matter more, especially nowadays that options expirations have bigger and bigger volume and are more dominant in terms of the flows.
Well, Jem, the people are frothing at the mouth for a trade idea. I know we've talked about this before, like call calendar spreads and SPX to kind of articulate this, but you can see it. I think this is a pretty clear visual here. If you're short the 34-day representative of a 240-point implied move, and then you look at this cycle back here in January, only relatively a 600-point move. There's 5 times the amount of time in this January cycle relative to SEP, but you're collecting 1/3 of the premium if you're looking at that. So that's kind of like the short front month or short 30-day and in long inventorying delta to the back end post-holiday, post all of this. Is that the kind of setup you're looking at?
Yeah, and with all the regular caveats that this is not investment advice.
Yeah.
Don't trade based on this, but figure out your own trading.
Mike said it. You didn't say it.
Exactly. But here's the deal. So people are like, why a call spread instead of a put spread, right? I thought we're talking about we want to be long puts. Yes, but what will happen naturally here is that you're likely to be supported, as we've seen, as I've said, like, yes, we're going to go chop sideways. It's going to be low vol. But as we slide higher, we're likely, right, to decay into, right, a vol that's going up. So that's why I call spread, to be clear, out of the money call spread. And obviously, as that short-dated call decays away, what do you want to do? You need to get short delta against your long vol, right, that you're now getting at a credit. So you can do that with stock, which is probably my preferred at that point, right? So now you're just left long a call, short stock at a massive credit, and now you can more comfortably be long vol, knowing that you've kind of decayed into it at a very cheap level. And by the way, we're at the lowest kind of VIX levels In terms of VIX, if you want to go look at a VIX chart, we're right at the floor, right? So imagine now getting it at a meaningful credit to that as you get into the fall. That's very compelling, particularly in a midterm year. If you can get that midterm vol, which I think is cheap as an event vol, do that. Go get November, December, right? So that's the trade idea. It's been working really well since we've talked about it a couple weeks ago, and I would lean into it for another week at least.
Love it. Love it.
There you go.
Well, Jem, appreciate your time. Hope you have a glorious weekend in preparation for some potential volatility on the other side of it.
We'll have a name for it on Monday. We'll talk Monday.
The Fall of Frederick. Something like that.
We'll see you on Monday for Tasty Crumbs, 3
All
p.m.
right, buddy.
Central Time.
See you guys Monday. Take care.
All right.
Sounds
later.
good. Likewise.
Be well.
E-minis down 8, NASDAQ down 35. Market's trying to turn over a little bit, but interestingly enough, VIX down, market down, at least for now. But yeah, some single name stocks. I see the people in the YouTube chat asking about some particular trades we have on. So we'll talk about that on the other side of this quick break. Join us in the YouTube chat if you haven't already. But we'll be back about 90 seconds from now. You're watching Tasty Live. Hello, everyone. Welcome back to the show. E-minis down, NASDAQ down. We got about 10 minutes. Let's make that 7 minutes before we kick it over to the next crew. But wanted to just quickly recap our trades that we placed so far today. Starting with a lot of these are from the YouTube chat, I want to say. So SPX, Super Bowl, 77.50, 70.74. You've put spread 10 points wide to buy a 15-point wide further out of the money call spread. That's for Monday. So the 78.85, 7900. Routed that for a 35-cent credit. So if all options expire worthless, I have no risk in the middle, but really just playing for a 30, 40, 50-point move to the upside. Probably not going to happen today. At least doesn't look like it right now, but could happen on Monday on some strong weekend news or whatever the case may be. Looks like you got a Super Bowl on in Caterpillar.
I do, actually. I already had one. I actually added to the position. I feel like it's been kind of quiet. It hasn't really bounced back like some of the other AI-related names. I know it's weird to say Caterpillar is an AI-related name, but that's what we've seen it do more recently. So I'm just playing it for another move to see if it can return to 1,000 and maybe a little bit higher.
Love it. Love it. Speaking of going higher, Micron chopping around 970 here. That resulted in a $250 winner. I got out of that for $1.46. I collected about $1.04 on the opening trade. So that was a 20-point wide short put spread to buy a 20-point wide long call spread and into this rally. Got that appreciation in the call spread, which is why I was able to route out of it for a credit. And then CoreWeave, I got out of this position. CoreWeave had a little bit of a sell-off about 30 minutes ago, and that triple calendar spread ticked into the green. It was around a 50-cent winner overall, but I had to leg out of it because there's so many legs. So close the 95 100s first, since those are the most sensitive, being closest to the current stock price. And the 90 is basically just in the money. This was like a small loss, and these were small wins. So net 50-cent winner overall. Glad to get a winner out of that. And then I saw someone in the YouTube chat asking if I'm holding on to Amazon. So Amazon is a trade where I kind of manipulated this in a crazy way. So had a 240, 255, 270, 15-point wide crab trade. And then Amazon gapped higher, much higher. So I had a completely in the money crab trade that was a loss. So instead of taking the loss, I moved the 255, 270, 15-point wide crab component out to the 21-day cycle, and I widened it. So it's similar to like turning a 5-point wide put spread into a 10-point wide put spread, where you're adding more risk and you're forcing a credit. Same exact story here. I turned this 15-point wide crab into a 20-point wide crab on the upside to force more credit. So I took on $500 of risk, but I collected $1.70 in credit. So that's a net risk added of $300. But Amazon has since sold off, and this couple $100 winner is now a scratch in Amazon. So I'm going to hold on to this, because if we get a continuation next week from 263 down to 255, this could be a $500 winner. So that's what I'm looking for. It's basically, if you look at it now, it is an in the money crab trade where I need a sell off towards the short strikes at 255, but my basis is 745 on this. So still plenty of profit potential, but that's the adjustment you can make. Like, it's everything you do is just debits versus credits. So if I'm comfortable taking on more risk and I can force a credit, I can do that. And that's really all it is. Like, same story with moving our MES and MMQ positions. It's all just debits and credits, and just never paying a debit to make an adjustment. Always collect a credit, take on more delta risk, especially if you're in the trade for a long time. I'm fine taking on delta risk, especially if it's downside delta risk.
Yeah. For me, this week has been about closing some positions, reducing buying power, moving further out some positions that I like, mostly, to October, if you will. Longs in October, short September is kind of the portfolio right now. And, we just had Cem on talking about what to potentially expect for the fall. We had, a great guest in Puru talking about what's going on with the AI trade and how it might have it might be in the beginning, the early innings. So I kind of feel, I'm kind of with both of them actually a little bit right now, and what's going on. And so I've, got a lot of capital ready to go. I feel like we're going to see, somewhat of a shift. We've seen a little bit of a shift already. We haven't seen the same thing in a strong way that we were seeing for weeks on end, which was that rotation back and forth between the chips and between the software names. That whole thing is kind of chilled out, which lets me to believe that something else is going to, a new thing is going to come sometime soon. I just want to be ready for it. And I don't want to be too locked into what was happening before and to not be able to shift to what's coming next.
Yeah, indeed. We had a little poll in the YouTube chat. What's next for gold futures? 62% said 4,500. 38% said 4,400. Interesting.
I mean, I think we hit resistance. We've hit it a couple of times now. I can see it looking at simple moving average. Simple moving average, if you're looking at it for gold right now, is around 45.06. We touched basically that area, basically 4,500. We touched it 3 days ago, 2 days ago, and yesterday. And so that's very telling. I think 4,500 was a resistance area right there. We got to get above that. And I don't know what pushes us, but I thought it was interesting yesterday when gold was, I think it was yesterday when gold was down, we were on with Tim, and I was like, this doesn't really make sense. I mean, we're seeing rates fall, we're seeing dollar fall, gold should be up, but clearly it was just the resistance setting in.
Indeed. Well, Jermal, it's been a wild morning watching the E-minis move in a 10-point range. But I've had fun. Hopefully you had too. And we've posted those trades to the follow page. So check those out if you want to see what we're doing and what we've done this morning. But if you want to reach out to us on Twitter, you can also do that. I'm at Trader Mikey B. Jermal is at Jermal Chandler. We're going to take a quick break here and pass it over to TP and Chris on the other side of it. But we'll be back for the trade idea of the day in about an hour and a half or so. So stay tuned for that. But keep watching Tasty Live. We'll see you soon.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
We're back. You're watching Tasty Live. This is Confirm and Send. I'm Chris Vecchio. He's TP Tom Preston. TP, how's your morning going?
Do we have any issues with Chris's audio?
It seemed, I'm getting you guys coming through.
Yeah, all right. And all right. So, all right, folks. Okay. We have Chris all shaved up and, glasses back on and that stuff, but apparently they killed his audio. He's been, they hunted him down. The black helicopters flying over his house. He was just talking about too much sensitive stuff. So apparently they killed his mic for now. I guess he'll probably be back up. Yeah, so I have the YouTube chat open if you want to comment about anything. Chris's audio, yeah, too low for Chris Vecchio. Yeah, that's fine. Anyway, Flame Shirt Friday. Back to my flame shirts on Fridays, or as best I can do it. The S&Ps are, let's see, SPX down $8. And let me see if I can share this quickly because I want to show folks some stuff. Okay, here's SPX. So one of the questions I saw coming up on the chat a few minutes ago was a person couldn't see this volatility graph down here. This is only on, for now, only on the web-based platform. Okay, so it's, if you're on the desktop or if you're on the software, this functionality doesn't exist. So you have to be on the web-based platform to see this volatility chart, and it is in here. If you click on this little, here, let me zoom in. And that's another nice thing about the web-based platform. I can zoom in and out so people can see better. But it's under this indicators. Click on that indicators and scroll down to, I already have it loaded up, but scroll down to going, implied volatility. All right, that's that indicator. So most equities have it. Some futures get a little weird with the volatility data. This is all pulled the way we do it. This is the VIX style volatility calculation performed on it. Let's pull up a difference. Let's Apple. So this is the VIX style volatility based on Apple's options. So that's what the number is. It's a hypothetical 30-day to expiration set of volatilities. The point about it is that it relies on historical option data. So every day we capture that data we started when it goes back. We had to buy some data, load it up into the algorithm to calculate the implied volatility, and away we went. So after that, we could just store it every single day. And I've been pushing for this for years because this is I think it's a useful indicator, not an indicator. It's just a useful piece of information. So you look at Apple and the stock came down, volatility bumped up. And if you want to have a visual representation of the typically inverse relationship between volatility and an equities price, stock's price, you see it right here. Okay, so the volatility bumped up when we saw this. Okay, great. And then the stock's been just going nowhere for the past few weeks, and volatility's predictably come down. So that's how you see it. Like I said, there are a couple of things on the web-based platform that you can't yet get on the desktop. So if you go to mytastytrade.com, you'll find that functionality in there. You'll also see our prediction markets that I like to play with. They're fun. Anyway, let's talk about a couple of trades. Let's zoom out here. I don't want to see. What have I done? Well, let's get out of this. I want to minimize this. Hang on, folks. Yeah, we'll work with this. So SPX, by the way, let's check that SPX Iron Condor. I am short the way you can do it is the trade's loaded up. I'm working it to buy it back for $1.35. It is why am I having problems with this? Come on. Let me zoom out. That's probably it. There we go. So zoom out. And so I am short the 77.50, 77.75, 78.35, 78.65. I sold that for what I get it for? Where am I? 275 right there, and I'm buying it back for half the price. So that's the trade I'm doing right now. I'm also trying to sell an Iron Condor in crude oil, and nothing done on that yet. So it's, I may try again and see if I can get filled on it. But I'm like I said, I'm neutral on crude oil going forward. Bond prices, bonds are down 20 ticks. Earlier this morning, I was talking about bonds. They're down about, 8 ticks. Now they're down 20. And ZN is down 6. I'm short call spreads in ZN. And that's, the trade's working out for, that's actually scratching. Maybe I'm up a tick on that right now. But, so I'm short the ZN call spreads. Bonds are having a nice little sell-off. Chris, let's see if you're back in here.
Yes, sir. Can you hear me?
Audio's a little low. So let's see. Any questions? And by the way, like I said, I have the YouTube chat.
This audio sucks. This audio sucks, TP, but it's what we're gonna have to work with today.
Oh, that's all right, Chris. You look fantastic, by the way. So that's whatever. It's you can just sit there and pose. Really,
I will.
The viewership, the numbers skyrocket when you're on air, Chris. They want to see, what you're wearing and all that stuff. You're huge. You are huge, and it's nice he can't respond to me, so I can just say anything about Chris I want. So anyway, so Chris, I don't know if you want to weigh in on this in your Dominican.
Yeah, you were talking bonds here, right?
Yeah, I was talking bonds. So one of the things that I thought was interesting was yesterday's auction of the 30 years, pushing the, and I think you can confirm this or maybe correct me. They said, there's an article that said the 30-year yield was the highest it's been in 25 years. I was very surprised by that. The demand for the auction wasn't horrible, but it was kind of weak. The tail was, the difference between what the ending yield was and what the expected yield on the bonds was moderate. Again, not catastrophic, but I was surprised by how weak it was. And on top of a relatively weak 10-year auction the day before, I have no problem being bearish on bonds right now. Like I said, I'm short a call spread in ZN, but I'm also thinking this could weigh on the market at some point also.
The bond auctions weren't great, right? And in the wake of those inflation reports that we saw this week, TP, Fed policy looks like it's going to stay looser for longer, which gives inflation and growth more reason to breathe, and that means higher yields at the long end of the curve. And it's just very textbook macro in that sense. Mm-hmm. Bond auction yesterday was gross. When we talk about it tailed, it's either tailing or stopping through. I'd encourage people to go to their Google machine and head over to literally type in tastylive, how to read a bond auction, or just how to read a bond auction. I think we're like the second or third search result for this. And you'll see the explainer that I put together there. But in doing so, TP, you'll see that when you see a tail, it's usually a bad sign. How big was this tail? We haven't seen yields this high in 25 years, since 2001. The bid to cover ratio came down. Bid to cover ratio is a measure of demand, right? Was 2.44 in July, 2.392 here in August. Weaker, not terrible, but the indirects are down. Dealers are left with 11.5% of the auction, which is higher than the 6-month average of 10.6%. So all around the margin, right? Not great. And then today you get a little bit of oil bounce back, and oil is not substantially higher here. It's up by 0.5%, and bonds look scared. They look so spooked because they're sensitive now, right? No one wants to be the marginal buyer. So with you, I am long ZB put spread here. We put this back on a few days ago. The 108, 109, the 107, 108 here. It's making nice progress today, obviously. It still has some time to go. I have it at 14 DTE. I intend on pushing that for the next week or so.
Yeah, and so what Chris and I are talking about are what I would loosely term market internals. It's not the most, talking about the tails and the coverage and stuff like that, the dealer inventories, that's not something you typically read about, and certainly not something you're going to see on most financial media. And it's not an obvious, oh my gosh, look what's happening in bonds. No, it's something that it's, like I said yesterday, with skew, for example, it's the wind blowing one way or the other when you're trying to play darts, and you adjust. And so the weakness in the bond market, yeah, I was kind of a contrarian bear on bonds anyway. And this just reinforces it. That's all it really does. It doesn't mean the bonds are going to go down anymore. I'm just bearish on bonds.
Oh, I'm there with you. And maybe it's having an effect on the market today, right? We were up a little bit at the open in stocks. BS is back down by 0.2%, NASDAQ 0.3% here. But just from the way I'm eyeing this, TP, stocks come in when yields start going up again over the course of the past hour or two. I mean, really since 8 o'clock this morning is when, I say 8 Eastern, 7 Central is when bonds really took that turn lower and stocks started to struggle. So that can't ignore the two. It's going into the weekend, right? Maybe that doesn't bother stocks so much Monday, Tuesday, but all of a sudden yields are going up and oil's going up on a Friday, and we have weekend risk. And did you want to deal with that gap risk when something could happen with the wars? This has been typical since late February, early March, right? Folks de-lever a little bit on Fridays.
So gold is back up. It was looking ugly. I'm short a put spread in GLD, and they opened up lower, threatening my short put strike. And okay, fine, it's a one lot and a couple of points wide. I can handle it, but it's nice to have it rallying back a little bit today. The crude oil was down a little bit, up a little bit. Like I said earlier, I'm trying to sell an iron condor in there. I am neutral on gold, on crude oil short term. You haven't been able to get anything filled. I'm going to go in and try in a bit, but that's how I'm positioning it today. There are no earnings to speak of today. That's why I'm thinking we're probably not going to have could be completely wrong. I don't think we're going to have a very crazy day with a big move up or down. Let me check the liquidity. In ES, where's my liquidity?
You're looking at 34 days TP. The short iron condor right now is actually paying you pretty much on the nose for what you're looking for. I was looking at 71, 72, 90, 91 as the strikes there, and that's given us what 36 cents credit.
Which ones again? Which ones again, Chris? In
71
FTX?
No, in CLV6.
Oh, CL.
Yeah, you said you're looking for a short iron condor there. Yeah. I have one that I've eyed up. 71, 72, 90, 91 is giving you 36 cents of credit on dollar wide strike.
In 3 days? How many days?
34, unfortunately.
34 days. 34 days.
Yeah. That's where I'm looking, because that's where like my
70,
time frame for oil has worked out the best for me.
70, 72. And what's your call strike?
Go up to 90. Start there. Go 90, 92 then.
Yeah. So it's, 2000. This is and like I warned people, this is a big product. Okay. Crude oil, $1,000 a point. So yeah, you're faced with $670, which is 1/3 of 2,000. That's what Chris is talking about. 1/3 of the width of the strikes. I kind of like that trade too. However, if you're playing at home and you're not, you want to keep your risk, your capital usage under control, you could move that down to 1 strike away, $1,000 worth of risk, or half a point. That's the nice thing about the crude oil options, 90 half. So you pull it in a half, that's $500 wide. And yeah, you can tailor these to have a little bit less risk, a little bit less capital usage.
ATP, we are here just past the halfway point of confirm and send, which means we should.
So, all right. So with Chris, so I'm going to rely on the producers for this.
I actually have the questions up here in front of me, TP. So when they put them on the screen, I'll still be able to read them off.
So all right. So the producers will put them up. This is first day with the new hands, by the way. Okay. I'm not authorized to be touching the confirm and send questions. So it's.
I get it. I'm so
that's what we're seeing. All right. So Chris, what is question number 1?
We reach into our grab bag here, which you can join by sending your questions to research@tastylive.com, research@tastylive.com. Those that go in the YouTube chat, we likewise try to respond to throughout the course of the day, but you can send your questions via email, so they're featured on this segment. First question, Reddit's up 12% purely because it joins the S&P 500 next week. Everyone knows the date and knows index funds have to buy it. When the buying is that predictable, is the move already in the options, or does it still have to play out?
The short answer is, and by the way, the symbol, if you want to see it, is RDDT. RDDT. The market already knows this. The option markets are already pricing this in. So if you open up the 35-day options, and I was looking at Reddit to do a trade in here, stocks at 180. So the skew is definitely pointed towards the upside. So the options already are they're looking forward to Reddit being included. So when the buying is that predictable, is the move already in the options, or does it still have to play out? It's already being built into the options. Now, how much Reddit might rally on that news is another question. Can it sustain this rally? Another question. But yeah, when you look at the skew of the options, and that's all I'm doing, out of the money calls versus out of the money puts, it's showing there's risk to the upside. The market thinks the Reddit might continue higher.
Known events get priced, but flows still have to clear TP. This is almost the mirror image of what happened with SpaceX, is it not? Mm-hmm. We have this big unlock announcement event coming. All these shares are going to hit the market. The stock is declining into it. And then the event occurs. And then what happens? The flows just never arrived. People weren't selling en masse when the lockup ended. And so the stock bounced. Right. I would point to the fact that, the easy move may be over here. Okay. When you get that 10, 12, 15% pop, it may be over. The flows will determine what happens next. And so that's what I'm going to be paying attention to. I'm not chasing Reddit up here because it's getting included in the S&P, but stocks that generally are included in the S&P or at an index level, there's a lot of research out from the CFA Institute on this. They do tend to outperform their peer group because of that forced rebalancing and usually the first 6 months of their inclusion. but that's about it.
Well, let me see. Do they have market cap on here? I think market cap. So it's a $31 billion stock now, or company. Now that's a lot. Okay. I wish I were worth $31 billion. I'm not. But the bottom line is it's not going to be a major component like Apple or Amazon or Nvidia or Microsoft. Okay. It's going to be kind of, towards the median of the market caps. So yes, is it important? It's more important for Reddit than it is the S&Ps, but whether or not everybody's going to be clamoring to buy it, because the allocations, if these funds are basing their buys on the percent that the stock represents in the index, Reddit's down the list. I mean, it's not, they have to buy some, but whether it's going to be a long-term bullish for it, maybe not.
On Reddit right now, I was just pulling it up. It has 141 million shares floated right now. I read the research report this morning from JP Morgan. They're estimating that a little over 16 million shares will need to be purchased by index funds to rebalance. So on one hand, 16 million shares isn't a lot. It may be a lot for a company like Reddit with only 141 being floated, and it does have about a 13.5% short interest. So this could really just be an unwind today. In terms of it moving the market moving forward, right? You mentioned, I think, TP, there's nothing else to say. It's not an NVIDIA or a SpaceX or a SK Hynix size company that's getting added to the index. So that's it.
All right. So that's Reddit. All right. Let's go on to the next question.
We do have a second question here. We actually have 4 here today. NVIDIA reports in now under 2 weeks, and it's the one print the whole market is waiting on. Does Ivy start building in the index this far out, or does none of it show up until the week of? I think it starts building already, TP.
Does the Ivy start building? If you're talking about Nvidia, yeah, they're already going to start looking at this. So the easy way to do this, you go to the trade page. This purple on this black background, they come out on August 26th. So that line represents earnings. So everything ahead of this, and if you just look at what's happening, okay, before the earnings, the volatility is, 34, 35%. After earnings and right after earnings, 46%, about 10% higher or 10 points higher. If I look at going back to what we talked about before Chris got on, this volatility chart. Okay, now NVIDIA's volatility has been coming down recently as on the strength of the stock. Watch this number or watch this graphic if you want to see it start to tick up. It will almost certainly start ticking up. We have about 2 weeks, as you said. Yeah, it's going to start coming up in the next week, but volatility will stop. I believe will stop dropping ahead of that number. It might not go up very much, depending on what the market sees. But as these expirations come off, 0, 3 days, 5 days, 7 days, all the excitement's going to be packed in to the options around here. That will probably lift the volatility.
I mean, there's a sequencing here, TP, and it's something that I've noticed before. But when the market gets ready for NVIDIA earnings, of course, you have a few weeks before, and when the rest of the market has gone through its earnings, and so you're in this kind of earnings valley, and then NVIDIA is on the other side. And so when the NVIDIA earnings, the market starts pricing it in, depending upon how seriously the market's going to take it, it starts to spread to NVIDIA suppliers, other names in the supply chain that would be directly impacted. So just as an example here, you're thinking about what are direct NVIDIA competitors or related in that range. AMD, Broadcom, Marvell, ARM, Micron, SanDisk. You can think SMH, Soxel. Going over to Foundry, right? TSM, we know is a major supplier. So the point is, if this is going to be going into the index level, it starts with the individual single stock. It filters through into the related sector and components that this company does business with. And only then, when enough of those individual stocks of okay, this is an event, the index begins to reflect it. So the index will be slower in.
Well, yeah, okay. So the point you're making, Chris, is a very important one. It relates to the Reddit question. That NVIDIA's implied volatility itself will start rising ahead of the number, but because NVIDIA, and I don't know what the actual percent of the S&Ps it is, an individual stock has a hard time moving the VIX. Okay. Yes, if Nvidia's volatility tripled or something like that, and everybody was panicking and thinking, oh my gosh, it's going to cause this huge wave through the SPX, up or down. I'm going to start bidding up those out of the money calls and puts. Yeah, maybe it can. But I think, just like Chris said, unless this starts trickling down into related stocks that represent a bigger percent of the market cap of the S&Ps, the volatility of individual stocks doesn't necessarily translate into a higher VIX.
Right. That's all there is to it. Next question, as we run out to the last 5 minutes here. 3, comparing premium across stocks makes no sense to me. A $40 credit on a $60 stock and a $400 credit on a $600 stock feel completely different. How do you normalize that to know which one is actually richer?
So I want to be able to read this. I'll see. So if you're talking about here it is. Okay, a $60 stock versus 600, $40 versus 400. That is already normalized, and I don't want to dodge this question. If they feel different, it comes down to the risk you're taking.
Yes.
Okay? So there is a linear relationship. All other things being equal, time to expiration, volatility, interest rates, dividends, all that stuff, all other things being equal, we'll try to make this simple. A 90 put on a $100 stock will have 1/10 the price of a 900 put on a $1,000 stock. So this is a direct linear relationship. If I see $40 on a $60 stock and 400 on a 600, that is exactly what it's supposed to show. That means days to expiration is the same. The percent out of the money on that option is the same. Volatility is the same. It is the same risk reward as far as that goes. So that's just apples to apples. Whether or not you want to do the trade is another question, because that $600 stock is going to have the option on that is going to have a much bigger margin requirement, much bigger impact on your buying power than $60 stock. Okay, so it depends on position size. Looking at a scenario like that is perfect. I love those types of scenarios because it makes the decision making simpler. It says, okay, I'm getting as much credit for a given stock between a $60 stock and a $600 stock. So it's all I'm thinking about is how much capital it uses. That's it. If I can afford to do the trade in the 600, maybe I'll do the 600. If I can't, I'll do the 60.
You point out bigger stocks have bigger strikes, right? So the way that you think about this, I always do. Give me like the credit as a percentage of the strike width. Okay. Mm-hmm. And if I'm looking at this, if it's a $40 stock or a $400 stock, and I'm still collecting a third of the width of the strike, the question is how much risk do I actually want to bear? Because if I'm trading like a J&J, for example, next to an ASML, bigger strike, bigger risk because it's a bigger dollar size. But at the end of the day, you normalize it by just looking at it in percentage terms. What's the percentage of what's the expected stock move in percentage terms? What's the credit as a percentage of the stock move in those terms, TP? But that's why we always say a third of the width of the strike. We're not saying we're looking to collect $1.67 of credit, because if you're going $5 wide or $10 wide or $50 wide, and depending upon the instrument, it's going to have a very different reading. So normalize it through percentages. Last question here, TP, and then you get the final word on this. We have 1 minute left. The expected move is one standard deviation. So in theory, the stock stays inside of it about 68% of the time. Is there research on how often it actually does, or does it come in tighter or wider than the math says?
So I want to make sure that let me see if I can blow this up. Come on. Because I'm seeing it. There it is. Expected moves, one standard deviation through stocks. Is there research on how often it actually does, or does it come in tighter or wider than the math says? The research suggests that it lands inside that range a bit more frequently like 72% of the time. So I did a cherry picks last week or 2 weeks ago that looked at the Mag 7 expected moves, the stocks in the Mag 7 versus SPY, Qs, and IWM. And when you're talking about an index like SPY, Q, IWM, it's about 70. The predicted range or the predicted amount is 68% of the time. They land inside the range about 72% of the time. It's that edge that over time should generate profits for short premium strategies. Yes, you're going to have some losers. Yes, it's going to blow through the strikes at some point. Yes, you will. It's a tough way to make money, but that's the edge that I'm fighting for. In individual equities, it's maybe a little bit more on balance between, let's say, 68 to maybe 69 or something like that. It's much smaller. In other words, it's much closer to the expected number of times it's going to land in the range. That's why equities are a little bit tougher, I think, to sell premium in. Witness my trading in all the earnings stock this past week. They blew through my strikes. I was expecting, whether it's Cisco or Envis or whatever, right? That's equity trading. That's why I don't trade those equity iron condors in any kind of size. I'm doing one lot, okay? Because it's less reliable in that respect. So what I'd say is for indexes, it lands inside the range about 72% of the time. For individual stocks overall, and it depends on the stocks, the sector, but I would expect maybe 67 to 69% of the time.
TP, it's interesting that you say that. It's interesting that you say that here.
It's like a $27,000 account.
I should say 1999 to 2018.
Say that again.
Shows Mike, Jermal, you've talked about this. It's more than the 68% of the time. There's a low IV overstatement. But we are done here in Confirm and Send. We need to get going. I know that Errol is waiting in the box to take over the show here, gentlemen, as we have pushed faster time. Research at tastylive.com. Get your questions sent in. We do our best to answer them. We will take a brief break, but then you have the one and only. You know you're here for him. It's Errol Coleman up next on Tasty Live.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
What is going on, everybody, and welcome back to Risk and Reward. Today's Friday. We've had a pretty, I'd say a pretty anticlimactic week so far. I know Monday we had an inside day. Tuesday felt like another inside day, and then post CPI, we didn't get the usual volatility that I was at least expecting. And then today on Friday, we're getting a little bit more fall through, a little bit more of an unravel from all this pent up volatility. So we're seeing a little bit more directionality to the downside right now. But before we get into it, hope everybody's doing well. Let me know what you're looking at. Let me know what you're trading. And we'll jump right into the Tasty platform here. But yeah, no, I mean, Friday trading, especially post CPI, we typically will get a little bit more clarity in terms of what the market wants to do. But SPY still sitting near its highs. QQQ starting to barely pull back just beneath its all-time highs. What's going on, Brett? What's going on, RSU? What's going on, guys? What's been top of your mind today? I was just kind of pointing out how this week felt a little bit anticlimactic. I mean, we really haven't had any massive moves. I think yesterday was the first move, was the first extended move that we had really gotten. We pretty much consolidated all through last night, and then today we're now seeing a little bit more of a pullback. So it'll be interesting to see how far this can go. It's the first decent pullback that we're seeing in maybe the last 24 hours. But with that being said, we still have on a few of these trades here. We got the crude oil trade still on. We're rolling with that one. And I was thinking, guys, maybe whenever we take this crude oil trade off, if this continues to the highs at around 84, 85, I think we should be able to take out like maybe $1,000 or maybe $1,200 out of this trade. That's only if we make a new high in oil. If we continue to pull back, we'll most likely cut this trade and take profits at maybe $500 or something like that. But I think we take the profits from this crude oil trade and then we do like, we do some like zero DTE stuff with the profits. And then let's just see if we get any type of follow through on that, because we are coming closer to the end of the year. I mean, this account is somewhere, it's like $20-something thousand, just under 30,000. So I think we could take a little bit of profit, take some more, I think, risky shots to really try and, beef up the portfolio a little bit more. So if we get more follow through on crude oil, I think we might do something like that, but we'll keep an eye on it. I mean, crude oil has started to consolidate a little bit more over the last couple of days. You can see we put in this high August 11th at around 84.5. Initially, we were going to exit this position at 84.5, but we ended up pulling back before the market opened up. So I think this was around, I guess this was actually at like 4 a.m. We hit that price point that we were looking for, but we weren't active enough to take it off. So since we pulled back, I was like, you know what, we're going to wait. The market is either going to sell off, take us out at about $500, or we're going to wait for the market to put in a new high, and maybe we get a little bit more continuation above that level. If we end up seeing it, I like to pay attention to the order flow when it comes down to some of these products as well. And just very quickly, whenever we look at the oil product, we can see down here at these lows, we can see these large bubbles, which just represent aggressive sellers entering into the market. And so far, we've had a lot of aggressive sellers entering the market at these lows, and they're not getting much fall through to the downside yet. So what that lets me know is there may be a lot of passive buyers, right? A lot of limit orders, a lot of liquidity providers beneath these levels that are supporting this underlying a little bit more. So that makes me comfortable sitting in this oil trade a little bit longer. But that's the thesis that remains over there. It's just been a patience game since getting in this trade from last week. What's going on, Sam? What's going on, guys? Yeah, not too much going on this week. I know we had some more trades of the days. Those are starting to pan out a little bit more. We have Apple on the board. We got a little bit of short delta on in there. We had gap down off the all-time highs on Apple, just looking to catch a little bit more of that drift to the downside. We're not looking for an aggressive reversal here, I guess you could say. But it does seem that Apple was getting ahead of itself relative to a lot of the other, Mag 7 underlyings and a lot of the other larger companies in the market. Apple just flying under the radar, just chilling at its all-time highs. So a little bit of a relief, a little bit of consolidation, a little bit of a drift to the downside would really be helpful to this position. We have 35 days left till expiration, $5 wide vertical spread. And we're up a little bit on the position, but it's going to take some time to be patient over there. But something that I've been a little bit more happy about in the portfolio is AppLovin. AppLovin is another underlying where we had gapped down post earnings, and then we ended up having more consecutive days to the downside. So that's what made this a little bit more attractive. And over the last couple of days, we finally have caught in some type of bid. And these trades can be so difficult because whenever you're putting in new lows, right, whenever we look to the left of the market structure, whenever we recognize we're putting in new lows, you never really know where the bottom of that move is going to be. So getting into a trade like that, it does feel like you're catching a little bit of a falling knife. So these trades feel a little bit more comfortable whenever you kind of catch them or see that it's already so extended to the downside. Because again, you never really know where the bottom is going to be. So again, with that being said, we ended up selling an out of the money put spread to give us a little bit more of a cushion on order entry, just in case we keep stepping down lower. So with that being said, shout out to Brett, Sam. I think they had, bought up App 11 a little bit more, and it's working in my favor. I'm catching a little bit of a bid there, but since it does seem that this downside pressure is pretty aggressive, we're not going to overstay the welcome here. But this is a $10 wide vertical spread that we put on. It was the only width that was offered within the September expiration, so we have a little bit more risk on this trade. I think we have about 600. To be exact, like $665 worth of risk on this trade. So that's going to be the max loss, a little bit larger than the normal like $200 to $300 that we risk on a $5 wide. So we're going to keep an eye on it. It's working pretty well so far today. And then Microsoft. Microsoft is one that I'm not fading super aggressively, like where I think Microsoft is going to have a very distinct pullback. I mean, I don't want to fade any type of momentum, especially not when Mikey Butler is 8 for 8 on Microsoft right now this year, and he's long. So that makes me reconsider some of the short delta that we have on here. But looking for a little bit of consolidation, looking for a slowdown in that momentum is going to continue to help this trade that we have put on. So that's a little bit more short delta. It is a $5 wide. And again, taking advantage of that vertical spread in that trade. Errol, I have cash, so looking to get in some cash secured puts. I like that. Are you anybody in the chat ever do the wheel strategy where you're kind of doing that covered call strategy, but you're kind of rolling it into the other side of the trade? Does anybody else do that? I know that was one of the more popular trades that I had seen in options when I was first getting into options in 2021, I think it was. But we haven't spoke about covered calls, I feel like, too much lately. I was going to do a poor man's covered call in Roblox. I had a zebra trade on. So synthetically, I had almost 100 positive deltas in there. And I was going to start selling some calls against it. But whenever Roblox had popped up, over $100 in profit within about 12 hours, I decided to just take it off the table, take the profit to help hedge some of the other drawdown positions that we have on in here. But I was even thinking about doing a poor man's covered call, but curious if anybody else is doing that wheel strategy. I know that can be pretty effective. I said, yeah, I just started wheeling some stocks again. I like that. I hear you, KT. Yeah, Old Tasty taught me against the wheel strategy and to look out for skew and be selective. Yeah, 100%. I remember I was kind of told something very similarly when I was first hopping in the Tasty programming and Tasty trading at the same time. So I hear you on that. Brett says, yeah, wheeling is a plan. Yeah, let us know how that goes. Again, I remember that being one of the most popular strategies because it's very conducive for really any type of trader or investor. And I still really like that strategy. And I think once my focus is on building more of my long-term portfolio, I actually intend on doing the wheel strategy for most of the underlyings that's going to be in there, right? So obviously, the trading portfolio and long-term investment portfolio can probably look a little bit different and probably be separated for a lot of traders, but still a lot of option strategies I think that are super effective in a long-term portfolio. And I got to say, I think the democratization and the retail investor starting to manage their own portfolio is only going to grow in popularity over the years. Like, I could only imagine how much of a hit those management fees for finance are going to take a hit over the next decade. But with that being said, a lot of Tasty Nation is already kind of ahead of the curve when it comes down to active management. So that's going to be the Microsoft trade. Got a little bit of short delta on in there. Micron has kind of been blowing my back out the last couple of days, I'm not going to lie. With memory names, semiconductors catching a little bit more of a bid over the last 24 to 48 hours. Today we're seeing a little bit more of a pullback, which is nice. But we're going to keep an eye on it. And I have another trade of the day that's going to relate to this Micron trade as well. Very similar to what we were talking about yesterday. But with that being said, guys, we're going to take a really quick break, just a quick about 30-second break, and we're going to be right back here. So be sure to stay tuned. We'll talk a little bit more about the rest of the positions that we have in this portfolio. And I want to touch on a little bit more points about that wheel strategy. But stay tuned and we'll be right back.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Investopedia says we're the best for options trading. Stockbrokers.com says we're #1, and BrokerChooser raves about us too. So what else can we say other than boom? Trade like a trader. Tasty Trade.
What's going on, guys? Back for risk and reward, just from a really quick break. And I had seen the discussion about, long-term portfolio versus short-term portfolio. It looks like there's a lot of Tasty members that utilize that wheel strategy in the long-term portfolio. And I think it was, who was it right down in there that is doing the wheel strategy right now in Marvel? I think it's John. Yeah, that's actually really cool to hear, because I could imagine that certain underlyings are probably a little bit more conducive for the wheel strategy, and there's probably some underlyings that you like the premium that it offers. I had even seen in the chat how there's some underlyings where you like the weeklies, the premium on the weeklies a little bit more. So it's going to be fun to engage in more of those conversations, because I'm very much so looking forward to utilizing that wheel strategy a little bit more. And I mean, I have some shares in the long-term portfolio that I think is going to be nice. Look, you have to have at least 100 shares of that specific underlying to start selling covered calls against, right? And then implementing that wheel strategy. But it is funny, because I remember when I was first learning about the wheel strategy, right? You look at stocks like Apple, right? I mean, some of these stocks are trading at way higher multiples, at way higher stock prices, or what's the word that I'm looking for? Stock prices than it was, even like 3-4 years ago. I remember when Apple was the first company to hit $1 trillion market cap. I think I was like a freshman in college when that happened, which is actually quite some time ago. Like, time has been flying. And I think, Apple was, SPY for that matter, I think was trading at a way lower price point than what it's trading at right now. So with that being said, I do know you need to at least acquire 100 shares, or at least choose an underlying where you don't mind potentially acquiring, right, 100 shares of that underlying. But it is interesting just to see how, first, learning about that strategy, some of the same underlyings are like 2, 3x, 4x, the cost from just about 4 years ago. So I think it was Marvel John was looking at. I just want to take a quick look at that. Was it Marvel? I think it was Marvel Technologies you were talking about. I get confused Marvel and Marvel sometimes. But if it's Marvel Technologies, IV rank is sitting at 55 right now. It's traded about 7.4 million shares on the day. This underlying looks very similar to a lot of names like Micron, like SanDisk right now, like an AMD. It kind of looks like it can belong in that category. In terms of what price has been up to, it looks like it has a very similar sentiment. But with that being said, IV rank of 55, I just want to quickly check to see. It's a $218 stock. So if you want 100 shares of that, it's going to run you around 20 grand, right? Like, these wheel strategies definitely are, pretty capital intensive. Like, if we wanted to do a wheel strategy in this portfolio right now, we would need to liquidate every single one of the trades that we have on, and then we would need to choose a stock around the same price point as Marvel. So we're not going to do that, but I am curious to know the names that are really nice for a strategy like that, but we'll circle back around to it. Oil getting a little bit more of an uptick on the day. The P&L on oil has pretty much stalled out over the last 48 hours since we've pretty much just been consolidating and trading within a pretty small point range. But the last two underlyings we didn't go over in this portfolio is going to be QQQ. We're getting a little bit more of a sell-off to the downside now. We're on the dance floor. That 725 call is being tested right now. 7 days left to expiration. I'm hoping that we still get a little bit of a deeper pullback in these underlyings right now. I was really hoping to get on a little bit more short delta this morning. I'm not going to lie. I was waiting for higher prices. I was really looking at the micro NASDAQ, and I was looking for oil at least to test this value area low that's sitting at about 30,296, and we went up to a high of 30,280, and then we just missed the entire move. And I was worried about that wider risk to reward that's going to be on the trade. So I decided to not pull the trigger, but you can kind of see these large bubbles again indicate aggressive selling into the market. So whenever we see something like that, it kind of shows us that momentum might have a little bit more continuation to the downside. But then you got to ask yourself from a scalping's perspective, like, do I want to chase this move right now? Sometimes you can do that. Sometimes it'll work. But whenever you do chase a stock, it widens that risk a little bit. So that's always something that's in the back of my mind, is really just visualizing and conceptualizing the type of risk that's going to be on the table. Because sometimes it's so easy to think about the potential profit. And then whenever you make certain decisions or you get into a trade and the opposite happens, that can then affect, maybe other trades that you put on, moving from there. So always having that risk first and foremost and seeing if we're comfortable with that. Brett is saying VIX is at a high a day right now. It's looking like Qs are trading at their lows, most likely going to be the same with SPY. Volatility index trading at 1470 right now. Is volatility not getting scary low right now? Does this make anybody else feel some type of way? Volatility trading at 1470 right now, especially post CPI last Wednesday. And then, on top of that, kind of headed into, September time. We're about mid-August right now. And then we got October, then we got November. Volatility trading at 14. It's getting a little quiet down here, I will say. It's getting a little quiet. Maybe we get an expansion in volatility sometime here soon. But that's going to be the Qs. Excuse me. More short delta on in there. And then we have SMH, the semiconductors, 98 days left to expiration, $5 wide vertical spread. We sold that for $220. We were able to collect a lot more credit just because we have 98 days left to expiration, which is a long time. Like, we always talk about, like, why is there not a lot of young people getting into options? And it's like, because a lot of young people don't necessarily want to put on a trade for 98 days, if we're being completely honest. Extremely useful tools, though. Don't shoot the messenger. I'm right. Yes, I believe the younger generation and my generation, we can be a little bit impatient. But I mean, that's totally the discrepancy right there. I mean, nobody 22 years old or 20 years old is going to want to put on a trade for 100 days. But we'll see how this one pans out. That was just a little bit of a sidebar. I was looking at more conversations, or I was listening into some conversations over the last couple of weeks, and it was some guys that have a start in the crypto market. And, crypto's been a little bit more of a topic of conversation because of the fact that it slid into a level of irrelevancy. I feel like crypto has been spoken in those terms. But the reason why there were so many young people so active in the crypto markets was because of the volatility, and the volatility was there, right? Even when it comes down to like a lot of the meme coins, right? We're not that much of degenerates here. We don't really trade these meme coins. We don't really trade these crappy companies. We don't really do that. But that was the draw into the crypto market, was the volatility for a lot of these young people. So just looking at, what is usually drawing people closer, it does seem to be, the crypto markets for sure. And then also just getting a quicker turnaround or a quicker feedback loop, I think is what it is. And you know what? I don't even think a lot of young people I think a lot of young people actually do. I take some of what I said back. I think a lot of young people do have the patience for longer duration trades, absolutely. But I think the upside just has to be there. I think if they don't believe the upside isn't worth it, then it's not going to be as attractive. Because then when I think about some of the coins that younger people are holding in crypto land, I'm like, look, some of these guys have been, diamond hands. That came from the crypto world. When people say diamond hands, just hold. And when we think about diamond hands, the reason why they're comfortable with holding something for an extended period of time to which they don't know when they're going to sell is because they believe the payoff is going to be worth it. So I also got to throw that 2 cents in there. But with that being said, we got 98 days left to expiration. A little bit of short delta on the semiconductor space right now. And then hedging that a little bit with a little bit of long delta on in the bonds. And again, I got to say, I think Gus and I might be 2 of how many people are in our generation trading bonds right now. How many people are trading bonds? Probably not too many. I mean, I probably would have been better off if I wasn't trading bonds because I'm down $122 right now on this bonds position. It is a 0 extrinsic back ratio, so a very synthetic, directionally long trade that we have on in here, but we do have 7 days left to expiration. So it's nice that we're not going to have to worry about that theta decay ramping up on us as we get closer to expiration, but we only have 7 days left to expiration. And because this is a synthetic long position, right, we don't get to keep those shares. So maybe we could have looked to reducing the cost basis on this one a little bit quicker. And maybe we could even look at the trade page and see what some of the calls are going for right now. We could sell something out of the money. Yeah, that's going to be tough because, look, I mean, it's going to be plus or minus 76 cents for the next 7 days in bonds. And it is one of the reasons why I didn't mind putting on, the zebra trade in the bonds because it's a trade that's not, extremely volatile. We go to a 2 standard deviation move in bonds. A 2 standard deviation move in bonds right now is 2.5 points to the upside, which is crazy. I mean, less than that. Just over 2 points to the upside is a 2 standard deviation move in bonds. And the expected move into the end of next week is almost half the 1 standard deviation move that it's pricing in right now. So with that being said, not much we're going to be able to do with this position, but maybe we catch a little bit of a bid over the next 7 days. But we'll be keen on managing this one. Again, if we keep sliding lower, I mean, the expected move again into next Friday is just shy of 81, so just below 81.5. I mean, I'm comfortable with that. We're trading at 81.88 right now. So what max loss on this position, if we don't get a bounce by next week, we'll probably lose an extra, $30 maybe, $40. Maybe we have an outlier move. You never really know. We could get that 1 standard deviation or 2 standard deviation move. But with that being said, we'll see what else we get in the market. We'll be back for another trade of the day here coming up really soon. But before we go here, let's quickly check. For trade of the day, potentially going to be doing something in SanDisk. Maybe get a little bit more exposure, a little bit more short delta on some of these memory names. Go to the trade page here. I know we've been propped up over the last couple of days. Most of the strikes are going to be $10 wide, so we'll be patient to see what the market wants to give us. But with that being said, guys, we are going to be coming to a close here for risk and reward. We do have trade of the day coming on here very soon, so be sure to stay tuned for that. But we got a lot of more amazing content coming on for you. With that being said, Brett, Ryan, I appreciate that, Ryan. Brett, Ryan, even Av, John, Michael, everybody, thanks for taking the time to hang out with us. We will be back for more amazing content, so be sure to stay tuned for that. And we'll catch you guys here shortly. Peace.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stock.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
It's time to trade smart, post PDT rule elimination. Now, traders of all account sizes have more flexibility than ever before. With rapid order entry and bracket orders that let traders manage entry, profit target, and stop loss, all in one ticket. Tasty Trade.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Hello, everyone. Welcome to the Research Deep Dive. It's a new show, and the research team is going to take it over. I'm Kai, and this is Sahil. How are you doing?
Doing good, doing good. How are you, Kai?
Doing fine. It's a quiet Friday.
Yeah.
The market doesn't move at all. We have the core retail numbers coming out. The market barely moves 5 points the whole morning until 10:30-ish. And start to going down a little bit, but still trading in a very tight range within 20-25 delta. If you sell 0DT SPX, still within the range.
Yeah, the reversal always happens at some point, but I don't know. The market is at almost all-time highs, but right now it's just trading a little bit sideways. So it's an interesting trading market. Good for the bulls. Anyone who's bearish might be feeling a little weirded out right now, but
yeah, exactly. So talking about a 0DT, I'm still having my iron fly positions on. So if you hear the ding, it's probably I'm taking off the profit. If you haven't heard it, it's probably still suffering.
For your 0DT positions, Kai, when do you generally like to take them off? Do you generally like to hold them all to expiration, or do you generally like to take them off?
I stick to my to the rules that I post on the studies. So I started with the 830 and taking off 25% or 50%, depends on whatever the position I put on. So normally I put on somewhere between 10 to 20 delta iron condor. Depends on the market. I feel more confident or the IV levels. Right now the IV is so low, not extremely low, but 14.5 VIX. The 16 delta put in call. If you put it in the at the market opens, it's only less than 35 points away from the underlying price. But when the IV reached 19 handle, the VIX reached 19 handle, you normally can have 60, 75 distance between the short strike and the spot price. So this is kind of a quiet market. You got to be careful. I didn't put on at the market open this morning, but I watch because I never hit my price, but I still watch it. It hits 50% within an hour. So I actually put on an iron fly after the market goes down, like a 0.25%. So I'm still waiting.
Yeah, that makes sense. I've not messed with 0DTE stuff too much. I put on probably a couple trades a week though, just to try to get into it a little bit more. Just because if it really goes against you and you're not doing it correctly, you're not defined risk, you're not taking it off, whatever, then it can really hurt you.
Yep, exactly. All right, so talking about the 0DT again, so we're going to discuss two pieces that we've launched before. We picked a couple of good topics we want to talk about in the on the Friday morning. So the first piece is 0DT, and we're going to be talking about the width of how the width of the wings is going to impact the performance. All right, so for this study, for the first study, we're going to fix, before going to the presentation, follow us on the Twitter or X, Option Kai for my account, and Shark Malhotra for Sahil. So we post analytical stuff, earnings, and articles for almost every day. So follow us if you can.
Yeah, we deeper articles, deeper dives into our segments, try to explain it a little bit more than we can when we're just speaking, so it's super cool stuff. Yeah.
Yeah, cool. So going to the first piece, we're talking about how to adjust the width of the wings and how the different width is an impact of performance. Normally, we fix our short delta at 20 in this study so we can have a fair comparison. We almost always use a 20 short delta, and we make the width of the wings different. And the smallest wing width we use is $10 wide in SPX. Although this is not the tightest one, but because we use SPY data, we can only use 10, 20, 30, 40. So these four are the one we're testing right now. So good news is we're getting the original SPX intraday data, which has $5 wide wings. So we actually can do more study with more flexible width of the wings and the delta. The data is going to be more accurate and it's more flexible for us to build different strategies. But for this one, we use 20 delta and we use $10 wide all the way to $40 wide, which fall into the range that most people will select. So apparently, for a lot of traders, when you start trading, not even 0DT, 45, whatever strategy, we probably tend to choose the very tight width of the wings. I remember the first trade I put on, or the very first batch of trade I put on, is SPY, and I use $1 wide, which is the tightest strikes you can select. The benefits of choosing the tight wings is you actually can limit your downside risk. You know what you're going to lose if the market goes against you. So if you use $1 wide, your max loss is not going to be more than $100. And you collect certain premium, so your max loss is going to be $100 minus whatever the premium you collect. So let's go to the second slide. So this is the very basic comparison. So this is from the historical data. So the average credit, you can see the tighter the wing we choose, the lower the credit we're gonna collect for sure. This is pretty obvious. And one of the good benefits is that the buying power is going to be lower because the max of the wings is going to be only $10 for the one we choose here. And another potential benefits of using very tight wings, a lot of entry traders is very excited about, is the potential max return on capital. Max return on capital is calculated based on the credit divided buying power. Because the buying power is so low, even though the credit we receive is slightly lower than the wider wings, proportionally, we still can get more potential return on capital. The max return on capital we calculate here is if the position expires worthless. So you can see the numbers 43% for $10 wide and only 20% of a $40 wide. So if you use tight wings, 0DT SPX for $10, potentially you can get more than double the return of $40 wide if you can almost always hit the max profit point, which is not possible. We all know that, right? So, but this is the psychologically, this is the reason a lot of people or new traders choose very tight wings. This is one benefit. So let's go to the second slide. The next slide. So the next one,
I'm liking these numbers, especially for like smaller accounts, that we do, because especially it's like stuff that I have, because I think the max return on capital numbers means we should not be afraid to, take it a little bit small, take a little bit of risk off, especially in 0DT trades. Unlike, other types of trades where we might want to go a little bit wider. So, but we have more protection.
Yeah. So the first benefits of using tight or small iron condors or wings is you have potential higher return on capital potential. And the second one is definitely the most obvious one, is the risk control, right? So largest loss is going to be much smaller, and the C-bar, of course, very similar, is going to be much smaller too. So you almost have 1/4 or 1/5 of the risk you take compared to using wide iron condors. So these two are the biggest point, the reasons why traders choose tight iron condor versus wide iron condor. Put or call spreads are the same, right? You choose tight put spread, has very similar risk profile compared to the iron condors. Now we're going to switch the tone a little bit. So let's go to the next slide. Using tight iron condor or spreads has one biggest downside. That is the probability of profit. Because we collect less premium, because we use the same short delta, right? If we collect less premium, our break-even point is going to be closer to the underlying price by choosing $10 wide compared to $40 wide. I don't remember the specific number, but it's two slides you can check. So let's say if we collect $3 in the $10 wide iron condor, we collect $7 on the $40 iron condor. Then we have $4 buffer, more buffer by using wide iron condor on either side. So that's why your success rate is going to be higher by using wider wings. So in this example, the success rate is 69% versus 75% between $10 and $40 wide. A lot of traders would argue, oh, this is only 4, 5, 6% success rate difference. It's not like a day and night 60 versus 90%. Yes, we know that. But success rate can change a lot of things, which we're going to discuss in the next 2 or 3 slides. Let's go to the next one.
Yeah, this has always been the problem that I've had when trying to do, naked strategies or whatever, is those provide a higher probability of profit. Your defined risks don't necessarily, but I think SPX and stuff that people will be doing 0DT trades in, NQ, whatever, are high enough products that you'll be wanting to use defined risk strategies anyways. So for most people, if you can trade naked in the in SPX, you have a very large account. So
it's understandable people start to choose very tight iron condor at their first trade, but looking at more numbers, you will understand you probably should only focus on one criteria, which is the risk, right? So we choose tight wings. We focus on the risk. Max return capital, most people know we're not going to hit that. So that's the cost. So this slide shows the max loss percentage. Not only we're going to see more number of losses in the tight iron condor, which are presented in the previous slides, the success rate, right? If we have 69% success rate, then our loss rate is going to be 31%, right? 31%. But this one is even more scary. This is the full loss percentage. So in that 31% of the losses, $10 wide iron condor, 22% of the total number of currencies actually hit max loss. So which means they're only 9%, right? We have 31% total loss rate and 22% reach max loss, which means they're only 9% gap. The underlying eventually fall in between two wings, $10 wings, short strike and long strike. That 10% fall into this category, and the 22% actually fall even far beyond. You actually reach the max loss. But look at the $40 wide, you only have 4% of the total number of currencies fall beyond your long put or long call strike. So this is very differently when you trade, change everything, your trading performance numbers, and psychologically it changed behavior, how you're going to trade. Because when you see a portion of the losses, you can handle that. You can keep the plan. You keep the mechanics work. You close at 25% or wait for 2x or 3x of the stop loss. But when you see 22% of trades might reach max losses, you actually, I would panic. It is, especially when you trade big, you see numbers that hit like if you use $20, then your max loss is 25, 26. $1,600 max loss for each one contract. That's a huge number of losses, and you're going to see your beta become negative when the underlying breach certain point somewhere between the long and the short strike. Then everything becomes different. So that is why using very tight iron condor, you have to suffer more in between that 3, 4, 5, or 6 hours in trading time, unless you close your eyes and just wait to hold it to expiration. Or the road that you're taking is going to be really, really bumpy. Even though your max loss number might be smaller, but the percentage of the volatility is going to be higher if you considering using the same buying power. So you can see this is 5 times more volatility, or the max loss volatility compared to the wide wings. So this is something a lot of new traders probably wouldn't even consider or can't imagine.
Well said. All about trying to reduce those losses. So this is a really interesting slide. I think that.
Yeah. So next slide. Next slide, we're using a similar concept because so all the previous 4 or 5 slides, we compare the strategy by looking at one contract, right? We trade one contract, $10 wide iron condor, 20, 30, 40, but the buying power is different. One contract, the $10 wide only costs $700 buying power. $40 wide iron condor costs about like $3,200 to $3,100 buying power. So buying power is very different. For portfolio management, you don't only compare one contract risk, because if you have $1 million or you have $100,000, you don't only trade one contract, or you don't only trade 10 contracts. You scale based on the asset value you have. The more capital you have, the more number of contracts that you're going to allocate to certain strategy. So same to these. If you take, if you have, so in this example, we take $25,000 capital allocation into all these strategy, assuming we have enough capital to deploy into these strategy, then you're gonna trade more number of contracts of that one $10 wide iron condor compared to the $40 wide iron condor. It's like a 700 versus 32. It's about like 1/4, 1/5. So you actually can trade 4 or 5 more number of contracts for that $1 iron condor, $10 wide iron condor versus 40. So now the risk profile changes. You actually pour more credit into the very tight iron condor. Your potential return to capital is the same, looks great, looks aggressive. But the problem is because you have so many losses, and majority of those losses actually land in the max loss area. So that actually caused a lot of downside risk in the smaller iron condor that you didn't expect. Because for us, we expect lower volatility, small losses in the tight iron condor if we only look at one contract. But the problem is when you trade in a portfolio, when you look at the percentage of the capital allocation, smaller iron condor probably is going to give you higher volatility and large downside risk. So these are the numbers you show. The max losses for the worst scenario is more than $23,000 if you allocate $25,000. So, which means you pretty much wipe out all the capital you deploy on that day. You only have like a couple of hundred, $1,000 left. But for $40 wide, because rarely we hit that max losses. I think that's 4%. We hit max losses. So that is why, on average, the volatility is actually lower for wider wings. This is if you ever sell a strangle, it actually looks scary, but look at the P&L swing by using the same amount of capital. Iron condor actually creates more volatility.
Yeah, I think this makes sense. This goes back to the other research that we've done, that you should not, if you're trying to go bigger and try to have more credit, or you have a larger account, more capital allocation, you should not really trade necessarily more contracts. You can just widen out the wings a little bit. And if you are, have less, then you should tighten the wings. But really, you should only generally deal with 1, maybe 2 contracts. But don't try to put the number up too much, because then the losses will magnify for each contract. So.
Exactly. So we had an old study. We use the title is trade bigger or trade more. We always tend to trade bigger first, which means you increase your individual positions of risk rather than just replicate your trades with more number of contracts. All right, so takeaway, I pretty much already walked through the takeaway. The takeaway is, yes, by using the small iron condor, $5 wide, $10 wide in the SPX, you do have lower single contract risk, have lower CVAR, lower buying power, and also potential return to capital looks attractive. However, when you have a little bit more capital, you're looking at a percentage of the capital allocation, you might want to widen out your wings to reduce your total capital volatility, not looking at one contract.
All right, well said, Kai. I like this, the zero DT stuff. They're definitely becoming more and more popular. So that had to do with SPX, the market, zero DT, what generally people trade. I wanted to look at Bitcoin a little bit and see what's happening, because Bitcoin's been on a very long downtrend right now. And you know what happens with these alternative products is when they're not performing as well as they used to, then people start to freak out. Oh, is it over? Is this stuff in the stun? This happened to Intel a lot when Intel was on its downturn until, of course, it came back. So I'm just going to look at, does Bitcoin still have room to run? How is the current Bitcoin moves, comparing to the previous ones and everything? So yeah, let's go to slide number 1. So slide number 1 is just the introduction of that. So it's been one of the most transformative digital assets of the past decade, gaining widespread adoption. It seems like everybody is trying to get into Bitcoin, trying to get into Ethereum, all these different cryptocurrencies. You don't even need to trade the cryptos directly. You can trade futures with these cryptos. You can trade options with these. It's like so many different things that you can trade, and the liquidity is definitely there. But right now, it's not doing so hot compared to how it has been historically.
Yeah. Just for your information, right now, crypto futures trading at 63,000 level, and the lowest point was in the beginning of July 1st. It's actually 57,800.
Yeah.
So not very far from the bottom right now.
So I have that on the chart on the next slide. It's just the chart. Yeah. So we can talk about it over here. I mean, you can just see that I have both Bitcoin and Ethereum on this chart on slide number 2, where.
That's right.
You can just kind of see everything is on its downturns. It was on its highs, and then everything is just coming down. And both Bitcoin and Ethereum, obviously being very correlated together, it moves always. The moves always usually go together. But Ethereum being a more historical volatility compared to Bitcoin, and we generally think of Ethereum as being more volatile than Bitcoin. The moves are larger. You can just see the red, which is Ethereum, and then blue, which is Bitcoin. They move together, but the moves in Ethereum are larger than the moves in Bitcoin. So that's why people generally like to focus on Bitcoin. So, do you trade these products, Kai? You trade crypto?
My 0DT positions.
Your 0DT. You're always into the 0DT. I think your portfolio is now 70%.
No, not that big. Not that big. Because
not that high? Okay.
the capital actually released much faster because you release within a day. So you don't have to use a big chunk of the capital into the 0DT. And also, it's not wise to use 75% into 0DT.
No, that makes sense.
If some one day, it can blow up your whole account. Which I've been experienced a couple of times last year. So I learned my lessons, and I'm trying to do the right thing.
April 2025 taught us some stuff.
Oh, for sure, yeah.
Yeah. All right, so on the next slide, on slide number 3, I have the volume data just to show what's been happening. So Bitcoin volume is still on it's on elevated levels, but the volume has definitely decreased from what's been happening before. There's a volume every single July 1st because Bitcoin started right around on the February-March period. So generally people like to do July as the yearly cycles, whatever. So volumes remain elevated, but they are low compared to its highest points, basically. But I mean, it's the most liquid crypto underlying that you can trade. So most of the stuff, most of the crypto people are going to be talking about Bitcoin, maybe Ethereum. So this is a really important thing to look into, I think. So the most interesting slide in the study, in my opinion, is number 4, the next one, which basically shows. And number 4 is the chart form of this, and then number 5, slide number 5 is the table form of this. And this is showing the largest percentage rallies and crashes that happen in Bitcoin from the year's activities, and basically since Bitcoin in 2019. And we can actually see that the percentage moves and drops that have been happening in Bitcoin, it always goes into a cycle. This is something that people, don't necessarily understand. And even like the largest moves and largest crashes that we've been having in Bitcoin, the crash that we've been having right now is not actually the largest crash that we've had before. Because when we're dealing with percentage numbers, obviously, when the price is lower, when it goes down to an even lower amount, that percentage drop is a lot more in previous days. So we can see just the green lines, it's going up, the red lines, it's going down, green lines, it's going up again. And this stuff all occurs in cycles. So there's a very good chance that, Bitcoin it's not over right now. And, there will be a green line that brings Bitcoin all the way back up. If we look at the table form on slide number 5, we can see, I basically write it down into words where the current sell-off in Bitcoin is not any more severe in terms of the number of trading days compared to previous Bitcoin sell-offs. In fact, the sell-off in 2022 lasted for a longer period and was a higher percentage drop overall. And as seasoned Bitcoin traders will tell you, Bitcoin is more likely to come back by the end of this year than continue down its current sell-off. And if we look, the 2029 rally was like 97 days, and then the drop happened 181 days. Then we had the COVID crash that happened for around 273 days. Then the really, really big Bitcoin crash that happened was in 2022, where the drop happened for 122 days before coming back up in 2024 with 270 days, and then again dropping at 183 days. The point is, this stuff happens with the 100, 200 day cycles, where it goes up and then goes down in between 100 and 200 day cycles, give or take. Obviously, we don't know exactly when. And so the current crash that we've been experiencing right now has been happening for a while now. But give it maybe a couple days, maybe 50 more days or whatever, and hopefully it'll start coming back up. So don't give up on it yet.
Yeah, these are great charts and tables, especially this one and the previous one. It shows us how volatile this product can be. The volatility is not at the same level as SPY or even Apple, or not even SNDK or MU. Yeah, maybe these chips stocks are more volatile in the past year, but Bitcoin and the cryptocurrency has been extremely volatile over the years. I think past 2021 or whatever, when the big banks start to jump into the cryptocurrency, before that, when the liquidity was thinner, the volatility was even higher. Right now, the more money pouring into this market actually drive up the liquidity. This is actually very helpful for the retail traders to manage the risks. Even though right now I saw a lot of articles saying the money is started pouring out of the cryptocurrency and getting into the chip and AI sectors. It doesn't matter. Still, the volatility of the volatility of the crypto market is extremely high.
Yeah, so this is the last slide of the study before the takeaways. We're going to be basically looking at the correlation that it had with stocks, Bitcoin had with stocks before 2020 and then after 2020. A lot of studies we're going to be doing now, actually, because COVID was such a big change in the market, a lot of studies we're going to be doing now are going to be comparing what happened before 2020 and after. And we can see that before 2020, the stocks had a near zero correlation with Bitcoin, but now the correlation is definitely adjusting a little bit. It's now 0.50, and it's immediate positive reading. So people are getting more of a read onto Bitcoin. It's kind of correlating with everything in the market. It seems in the market that even if you're trying to diversify right now in 2026, anything that you take is kind of moving together or moving against each other. It's just the nature of the market that we live in. So I just thought this would be an interesting way of comparing the historical volatility and the correlations that both Bitcoin and Ethereum have. I have both on this slide, have pre-COVID and then post-COVID. And yeah, you can see basically what's happening. But right now, the current trend is that it's kind of moving a little bit with the market. Obviously, the crash that it's happening right now compared to the rally that we're having in the market is a little bit different. That's why it's only 0.5 correlation and not any higher. But yeah.
Yeah,
over,
so this
over
is
a long-term period. Yeah.
Right. Great point. It's actually not after 2021, somewhere between 2020 and 2021. A huge amount of money, institutional money, started pouring into cryptocurrency, which is a very positive sign for the whole industry sector.
Yep, so just going to move to the last slide then, which is the takeaways. So Bitcoin's current sell-off is significant but not unprecedented. Market activity remains strong, and then Bitcoin has become more correlated with the stock. So this is just everything that we've talked about kind of in the takeaways. If you want to read into this a little bit further, just I think a very nice look into Bitcoin, which is a thing that we do not focus too much on. We tend to focus on the equities and the tech stocks and AI stocks a lot, but this is something that you can look into to diversify a little bit and get into some more interesting strategies with Bitcoin. Don't lose too much hope on it yet. So yeah.
Yeah, great segment. Beautiful. Yeah, I think we're good for today, and I hope everyone can have a nice weekend. And we're gonna start a zero DT and other trading game starting next week.
Oh yeah, get ready for all the zero DT stuff. All right, see you guys after this break for some more Tasty Live. Yep, bye.
Peace.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
Investors Business Daily raves about us. Stockbrokers.com says we're best in class for futures trading, and Broker Chooser thinks we're pretty great too. So what else can we say other than trade like a trader? Tasty Trade.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
What's going on, everybody? Trade of the day. It is Friday, August 14th. We're trying to bring these to you on the regular. It's been good. We've been getting good feedback, so we appreciate that. Keep sending all of that. Today, I decided to do something, that's out of the realm of tech, which has largely been what I've been trading for the last couple of months here. I wanted to go with something a little bit different. I am starting to regret the direction a little bit, but it's fine. We're gonna take the contrarian approach to it. So, I was looking at Home Depot, and this morning we had retail sales that actually ended up coming in kind of negative. I was thinking that kind of would have come in positive to some degree. Why? I mean, because, well, the last two inflation reports we just had were flat, even though I don't necessarily know if that tells the whole story, but never let the story get in the way of a good trade. So inflation reports came in flat this week, basically in line, meaning that inflation isn't necessarily high, even though we've seen oil jostle around a lot. And, whether you know it or not, I mean, oil controls just about everything in your daily lives, whether it's from your gas or whether it's just the products that it's made with. See Landman, he'll explain it even better than I could. But there's a lot of polymers that come from the breakdown in oil. For those of you who don't know, a lot of you probably do know that. And so as a result, that's why a lot of prices are high, right? A lot of things that we buy, a lot of things that we do, whether we travel, etc. But yet the inflation reports didn't necessarily show that. However, retail sales showed a little bit of a pullback here. And so I bring this up because our trade of the day pertains to Walmart. This is one that to Home Depot. This is one that we've been eyeing up, mostly just from the chart standpoint, let alone the story. I mean, the story is interesting at times, but this chart this name has struggled quite a bit in recent times, and it does have earnings coming up. So we are going to hear a little bit from them about what's going on with the stores, what's going on with people. I mean, one thesis is that people aren't necessarily moving in and out of homes as much as we saw in the last couple of years. I mean, you probably saw the charts. People flocking to Florida, flocking to Arizona, and these areas really saw a huge improvement in home prices in Texas as well, particularly. I mean, hell, Elon Musk moved a lot of the company from California to Texas, and obviously we saw inflated prices as a result of that. You hear about Ken Griffin moving Citadel from Chicago base, from New York base, mostly down to Florida, even though they are still keeping some type of base. So you're hearing about these large companies, corporations moving to a lot of places in the South over the last couple of years. That's been kind of the trend, and you've seen this increase in home prices. That has calmed down. And so my thesis on one hand is maybe people are just going to not necessarily move away, but just kind of stay in their homes and sort of improve those. But we haven't seen that follow through in Home Depot here. The stock has been near its low. So I figured, why not? Why make a contrarian play? Now, the retail sales obviously is backward-looking thing, and that didn't show what I was hoping maybe for this trade as earnings are coming near. But I figured, why not? I figured I'll go with a contrarian trade anyway. So Home Depot does have earnings next week, about 4 days from now, 4 actual days, I guess 3 trading days, if you will. 2 trading days. Forget today. And I would imagine it's before the open, but let me clarify that for sure. It doesn't really matter too much. We're already in the trade. But just as a talking point. It does happen on Tuesday before the open deck, I figured. We'll also get Lowe's, too, I'm pretty sure. Lowe's and Home Depot usually report in the same week. Sure that's still the case. Yep. Lowe's is the following day. So sort of a 2-day look at consumer. And there's some consumer names that I think are going to be reporting next week. Now, this is consumer discretionary, though, right? I mean, I always describe the two of them as consumer staples. It's the stuff that you need, and the consumer discretionary is the stuff that you want. And so that's really the big difference. People don't necessarily have to spend money on upgrading their homes. They just choose to, for the most part, to upgrade their home value, right? And so this is one where I was looking at, how do I want to get long it? How do I want to play it? And I did decide I want to get long it, mostly from the chart, not even so much the story, mostly just from how the chart looks right now. And this thing is, so my lines here are the white line here is the 200-day moving average. We do see an upward sloping red line, which is the 50-day moving average. So we need that to get above that 200-day moving average. That would be what's called a golden cross. When you see the 50-day crossing through the 200 moving average, the white line here down to the downside. Let's see if it did it back here. I would say it did it around here. This was the death cross, right? When you see the 50-day crossing through the 200 to the downside, and you can see where the stock was at the time. It wasn't looking that great, although unbeknownst to that stock, it would get worse, which it did, going around here back in May, right? So the technicals didn't necessarily look that great, but they look like they could be turning a corner. A good earnings report would help with that, of course. And we could see possibly that 50-day cross back above that 200, which would be a golden cross, which would be really nice. So I'm looking at this top here, though, around 360. That's kind of my area to identify. It looks like it just recently crossed over 350, and it did fail from there. You can see that was kind of a high back in April sometime, and then also that 360 that was earlier in July. So I'm looking at that as an area where if it can cross and get above that, maybe you can see some higher prices. So for that reason, and then for the downside, I mean, essentially we're looking, more recently, it's been staying above 320. Knock on wood here, it's staying above 320 and change. So I kind of identified that as a near-term downside. So for those reasons is why I chose my strikes, right? We saw it around 323, around that low. So I chose split the baby on that one and basically sold this put spread. I actually tried this trade a couple of days ago. I wouldn't get in. I mentioned this on the live show this morning. Sometimes these markets aren't the greatest, I would say, in Home Depot, but it did work out when I did it earlier. So I sold the 330, 320 put spread to finance buying the 360, 375 call spread. I wanted to find something where I could get $15 wide. And you can see it's interesting, man. I tell you, what's so dope about options and what's interesting about trading, which I love, a lot of times when you identify certain areas, you'll see that it's identified within the expected move as well. So I just told you and I showed you on the chart where 360 seems to be a level where it needs to climb above. And you can see right here, that's on the upper end of the expected move for 35 days for September here. So, we'll see if it can get above that. Maybe we'll get it with volume, and then we can see possibly that upside of 370 or 375. So that's why I chose my strikes. Again, the story right now says consumers aren't necessarily going out and spending crazy money. This is a consumer discretionary stock. So I do understand, there's an uphill battle potentially. But I'm placing it around earnings for a reason, because I feel like that could be the catalyst. If they say something positive, despite whatever data we got going on in the larger economy, then that's what can lead to this thing possibly moving higher. I did go with September. I could have, gone a little closer in, but I want to give this a little bit of time, right? And so that's why I decided to go with September. Again, you can do. We were discussing a little bit this morning about different time frames and how you want to place trades. I could have gone here, but to October, but you can see I do like the areas that I outlined, especially in the nearer term. And I did outline 320, let's call it 5 as a downside downside support, I would say, and then upside resistance would be 360. And so that's why I like those strikes. I could stretch this out further, but I don't want to do that, right? Like, I don't necessarily believe that I'm going to be seeing 380, if I wanted to make this trade work. And to illustrate my point, I could start at 375 and go 390, but I don't necessarily know if 375 is the play. Now, maybe, I mean, that's another way to structure it, but I don't necessarily know if this thing's going to be seeing 375 anytime soon. I feel like that's the next leg of the trade. Maybe, and you got to give it some time, and maybe that would make sense, I guess, if you could go to October. But I feel like that's a little harder sell. I would rather just do it nearer term, do it for September, use the strikes that I outlined. Again, outlining that downside of around 325 and selling around that. That's where this put spread comes from. And then I'd like to play for the upside as well. So that's the trade. Looking at lows, one of the things you could do, you could do a similar play in here if you wanted to. This is a lower priced name. And it also has the benefit of hearing about Home Depot's earnings before it actually has its own earnings. So I already have a play in here. I'm already playing this, and this is one of my further out trades. I actually moved this earlier this week. I have a diagonal in here. So it's about 20 points wide, I think, right? Yeah, 220, 240. And I paid probably, I think, 8 and change for this thing. So I already have them both on, but I decided to get a little exposure to Home Depot as well with those earnings coming up. So that's the play. But overall, I think it works in my portfolio. It is one of the few September trades. I have been moving things. It's one of the few longs I have in September now. I was mostly long September and short the August cycle with a lot of either calendars and or diagonals over the last couple of weeks. I've since changed that. That's been a big thing that I've done this week, reorganizing the portfolio. I'm actually only using about, maybe after this trade, about 25% of buying power because, this is just this environment, and I discussed this yesterday on Trade of the Day. We're in an environment where VIX is $14.46. This is a very low volatility environment. It's really what we have been calling the dog days of summer, right? We see this a lot. In many years. We haven't seen it in the last couple of years. It might be a day or two and then things are crazy again because there's always something going on in an economy where the Trump administration is either talking about oil or talking about the war or talking about tariffs. We've seen a lot of activity in the market as a result. So we really haven't seen VIX at these very low levels. I mean, the last time we saw it was about 9 months ago, honestly, earlier this year, late last year. Again, that was another quiet time heading into Christmas around the holiday. So yeah, sometimes we can see low vol on the holiday. There's no holiday, at least not for another couple of weeks here. So this is definitely a little bit unusual heading to an expiration, but I anticipate it changing pretty soon. So I have been dialing back things in the book, waiting for the next volatility pop. But in the meantime, this is the play. When we're looking at Home Depot, I think this is going to be one where let's just see if they can change the narrative a little bit here around consumers and what's been going on with consumer staples. Consumer discretionary. And speaking of looking at that consumer discretionary chart, you can see it's been kind of sideways, right? Like these are the names that are usually going crazy when you look at them, but when you really analyze the list, I mean, Amazon is consumer. Sometimes it's considered consumer discretionary. Tesla, Amazon is up on the year, but only 14%, mostly after the earnings move. Tesla is in that group. HD, Toyota Motors, McDonald's. These are some of the names. TJ Maxx. These are actually a lot of these are negative on the year. Carvana. So we'll see if this is an area where maybe we can start to see some moves going forward. But if we can pull up the graph here, now we can see trade of the day, HD Super Bowl. Sold the 330, 320 put spread to finance buying the 360, 375 call spread. Again, we identified 360 as a level of possible resistance, and maybe if it can break through that, we'll see how it plays out. 45-cent credit on this trade. Again, break even to the downside is 329.55. Below that, we start to lose money. Max loss, though, is $9.55 or $955 in real money. Again, that's a $10 wide spread. We collected 45-cent credit, so that's why our max loss is $955 to the upside. Again, we don't necessarily, we would love it if this thing crosses 360, but what we need is just for it to stay between 330 and 360 just to even keep the credit and make money on the trade overall. That's a win, right? We get a big win, though, if we get above 360 and we start to get a really big move to the upside, which, again, maybe earnings can be the catalyst for that. So that's the trade. HD Super Bowl, onward and upward. We'll see if consumer discretionary can start to make a move, and this could be the beginning of something big in that space. That's my trade of the day. get you over to Mike for his trade of the day. Have a good weekend.
But they kinda like it when I'm feeling myself. Just to look at me, I don't gotta level up. But they kinda like it when I'm feeling myself. I'm feeling myself. I'm feeling myself. I'm feeling myself. Just to look at me, I don't gotta level up. But they kinda like it when I'm feeling myself. I'm feeling myself. I'm feeling myself. But they kinda like it when I'm feeling myself. Just to look at me, I don't gotta level up. But they kinda like it when I'm feeling myself. I'm feeling myself. But they kinda.
What's up, everyone? Welcome back. We got another trade idea for you today. E-minis down 20, NASDAQ down 120. AMAT had earnings after the close yesterday. Unfortunate sell-off, down 26 points or 5%, almost exactly. But still plenty of implied volatility going forward through the end of the year and into the next couple of months here. I did have an earnings trade in here. I had a 600 strike calendar spread. I was able to buy back the short option in the 0-day cycle and roll it out to a butterfly in the 7-day cycle. So I had the 600 long with 7 days to go, and I was able to actually move that to the 600, 620, 640 butterfly, and I was able to pick up a 70-cent credit. So reduced basis a little bit, nothing too crazy in terms of cost basis reduction, but at least we have this shot here. If we get a big move to the upside, like 50 points, which would be well outside of the expected move, maybe this long option gains a little value and we can retain some value. But right now, not expecting that to happen. So I actually went out to the October cycle, and similar to Jermal, just looking at the favorite trade over the last couple of weeks, which is a Super Bowl. I went to the 63-day cycle here and sold the 450, 440 put spread, sort of inside the expected move, and looked at the credit of around $3. And I was like, okay, where can I buy a call spread that is less than $3? And you kind of arrive at this 600, 610 area, which is where I ended up. So I picked up a credit of about $1.50 on this trade, which gives me neutral profitability in the middle here, give up some of that premium. And again, if you look at just the put spread, picking up $3, I'm giving up about half of that credit received. But from a risk standpoint, I'm really not increasing my risk all that much, right? If I sell this for $3, my risk is $700. If I sell it for $1.50, my risk is $850. The percentage change on my additional risk is far less than the additional max profit that I can get to the upside, right? Because if I just sell the put for $3, my 50% profit target is $150. So keep that in mind as we walk through the analysis by adding the long call spread, giving up some of that credit and shifting it to asymmetric profitability to the upside if we get a big reversal in AMAT. But either way, this is still a high probability trade. We're looking at, if we isolate just this trade here, we've got a $1.50 credit in the middle. If I change this price to where I was filled, we've got a $1.50 credit and 1.15K to the upside if we get a big reversal over the next 63 days. So again, can't emphasize this enough. Still a high probability trade, taking on a little bit more risk to the downside. But if we do get that reversal, you can see here, even if we get a move from 510 to 525, 535, like a 20-point rally here, I would reach my theoretical 50% profit compared to if I just sold that put. But if we keep going, that's when you really start to exceed your profit potential to the upside. So if over the next couple of weeks or months, AMAT goes back to 600 or gets up to 600, this is going to be a couple $100 winner with a max profit of over $1,000. So when you think about closing for 50% profit with just the short put spread, if you get the outside expected move to the upside in AMAT, you're looking at a profit that's equivalent to 10 times selling that put spread and closing it for 50% profit. So this is the kind of thing that I think makes a lot of sense from a premium selling standpoint, especially as you build up your portfolio and you have more flexibility to do something like this. It makes a lot of sense from a risk reward standpoint. You're giving up a little bit of neutral premium, but again, still a high probability trade. If everything just expires worthless here in the middle, I'm still profitable, but I'm latching myself onto that asymmetric upside a little bit with that call spread. So that is what I'm looking at here with the short put spread, 440, 450 to buy the 600, 610 call spread. In a lot of situations, we can make this wider. So we can usually do like a 10-point wide put spread to buy a 20-point wide call spread. That would have made me move this put spread up. So if I were to move this up towards like closer to at the money, like a 500, 490, and instead of picking up $2.20, I could have gone to like the 620 here, the 600, 620. Now we're cooking. So same analysis where if I just sell the put spread here, I pick up $415. If we get a rally to 600 without changing implied volatility and just getting that move up, my theoretical P&L is about $150, $200, we'll call it. But when you add that upside profit potential, the 600, 620, you give up $3 of that $4 credit. But again, what's the difference in risk? The risk is a couple hundred more dollars, but now all of a sudden you get this move to 600 and your P&L Theo jumps from $150 to $700. So clearly, if you get a directional move, this sort of strategy benefits greatly from that, but you're still profitable in the middle if you just hold to expiration. So any way you slice it, the main key for this type of strategy is to route it for a credit in the middle. I do think you can route it for a debit, like a small debit, especially in a product like this. Like you look at these options, $2,000 for the call, $1,500 for the short call up here, far out of the money. $4,100 in the put, $3,900 in the put. So if I routed this for a small debit, technically my probability of profit for expiration goes down. But if I route this for like a 20-cent debit or a 15-cent debit, it doesn't really change anything, right? Like you're still looking for that upside move, and that's where your profitability comes from. The lower your credit received is, the more your profitability is reliant on that upside move, right? But expiration risk, like what's the difference between a 10-cent credit and a 10-cent debit? Really not much at all, even though it's a dramatic change in your probability because you're losing 10 cents instead of gaining 10 cents in the middle here. But all in all, the further out in time you go, I think you can be more flexible with your strategy selection and what you're looking to do, especially with 63 days. Like if I put this on for a small debit, I'm still looking for a 25, 30-point move to the upside in AMAT, and that's where my profitability comes from. It's not really going to come from this middle ground here for $1. But that's where I'm at with the AMAT trade. 600, 610, and the short put spread that I have on right now is the 450, 440. So plenty of wiggle room to the downside. Again, I routed that for $1.50 credit. And that is ultimately the way that I view this trade. Now, what happens if the market goes down? Going to be tough. If AMAT just continues to slide here, I'll take on some risk to the downside. But because I routed this for $1.50 credit, I ultimately have $850 of risk to the downside. But like we've said before, and like you may know already, if you get an in-the-money move with plenty of time left, your theoretical P&L is really not going to go much further than half the width. So I have a 10-point wide put spread here. if I look at my Theo P&L, if I go in the money on this put spread, I'm going to be losing about $400 because I collected $1.50 and this spread will be trading for about $500. So my theoretical risk before expiration is about $400, $500. At expiration, of course, you get up to that $850 level. But what you could do is you could roll the position out in time. You could just roll the put spread out in time, leave the call spread on to expire worthless, and manipulate it that way. So if I had a 10-point wide put spread, you can see here, if I buy this back at the 500, 490 before it goes in the money and I roll it out 1 month, I should be able to pick up a small credit here. As you can see, buying back the 500, 490 in October, selling out the 500, 490 in November, I can pick up $1 credit, something like that. One thing I did do in Amazon, which I think is interesting to talk about here, is I forced a credit by making those spreads wider in terms of risk. So let's say in the same example, I'm in the October cycle and we get a big gap down in AMAT. Actually, we might have to go to the September cycle because these are 10-point wide spreads. So let's say I'm in AMAT. I'm in the 530, 520 put spread. It's in the money. If I roll this out, it's going to be for a debit because there's more extrinsic value in my long option than my short, which means if I roll out from September to October, I'm going to have more extrinsic value in the long option I'm buying than extrinsic value in the short option that I'm selling. So that's why if you're going to make an adjustment out in time with a vertical spread without adjusting the risk, you need to do it before it goes in the money if you're trying to collect a credit. Same kind of story though, if you push it out a month and you're paying a 10-cent debit and you had a credit of like $300, who cares? Like, what's a 10-cent debit going to do? I'd rather have twice the amount of time for the thing to reverse. But if you're trying to collect a credit for a spread, you need to route that thing before it goes in the money, unless you're willing to take on more risk. So similar to what I did in Amazon after it gapped higher, I turned my 15-point wide crab trade that was fully in the money into a 20-point wide crab trade by widening out the risk and forcing a credit. So what that would mean here is if AMAT drops like a rock and my put spread goes in the money, I could buy back the 10-point wide put spread in the monthly cycle, roll out to the next monthly cycle, and make it wider. So in this case, of course, I choose the wrong strike. So let's go to the 540, 530. So I'm buying back the 540, 530 10-point wide put spread in September. If we look at October, I can surely collect a credit by widening the spread. So what that would mean is selling the same short put strike at 540, but buying the 520 in October. So we can look at this visually. I'd be buying back this 540, 530 put spread in September and rolling out to the 540, 520 put spread in October here and forcing a $600 credit by taking on another 10 points of risk. So you can see the difference here. If I move this down to $600 exactly, I'm increasing my risk by $400 because I'm adding 10 points to the spread width, but I'm picking up $600 at the same time. So this is called forcing a credit by adding more risk. It's the same as adding another short put spread at the money or near the money to force a credit here. But if you want to stay in a trade with a put spread that goes in the money, this is something you can have in your back pocket if you have the ability to take on more risk. And the ability to take on more risk, of course, starts by trading small enough for you to add another tranche or add another layer of risk to a certain position. So another thing you can do if you really are stuck in a scenario where the short put spread goes in the money or even a short call spread goes in the money, same thing can be said there. But to quickly recap the AMAT position I've got, I threw on the Super Bowl, routed it for $150 credit right in the middle there, so I have no risk in the middle, but the 450, 440 put spread in October to buy the 600, 610 call spread at the same time. This trade is routed for a credit on entry, and if AMAT rallies, it can be exited for a credit because the put spread would lose value, and I would buy that back for a lower amount than the call spread that I could sell out of that is gaining value. So that's how these trades can be routed for a credit on entry and also for a credit on the exit there. So that's the trade. Max risk is $850 because that put spread is 10 points wide, but I collected $150. Max profit is 1150 if we get a big rally in AMAT, but I'm really looking for maybe $200, $250, $300, somewhere around that range. But because I'm in the October cycle, if we get a quick rally in AMAT, a quick reversal here in the next couple of weeks, I've got plenty of time and I have no risk in the middle. So the closer we get to the call spread, the more inclined I would be to just hold it and try and get as much profit as possible. But just like we showed with a put spread that goes in the money, your max loss with plenty of time to go is about $500 on a 10-point wide spread. That also means that with plenty of time to go, if we get a huge rally in AMAT to the upside, my max profit on that call spread is only going to be about $500. So if we got up to $400, $500 in profit in AMAT, I would just close the trade because that would yield that max profit prior to expiration or close to it. But let me know what you think of the trade in the YouTube chat. We've got another trade of the day coming your way right now with E.
Madrugada chegou, não quero mais acordar. Como dá pra sonhar o que é impossível saber? Sentir o gosto do sol, andar por cima do céu, fingir que nada mudou depois de ter você. Deixa eu te ligar, me faz apaixonar, não vejo a hora de te encontrar. Deixa eu te ligar, me faz apaixonar, não vejo a hora de te encontrar. Um minuto longe de você, eu já não sei esperar. Madrugada chegou, não quero mais acordar. Madrugada chegou. Deixa eu te ligar, me faz apaixonar, não vejo a hora de te encontrar. Deixa eu te ligar, me faz apaixonar, não vejo a hora de te encontrar.
Another trade of the day. We had Jermal come on. We had Mike come on. I am now next. And then we got a couple more coming on next. So with that being said, we've been doing these live trades of the days for the last, 2 to 3 weeks now. So as you can see, the portfolio has been getting a little bit more beefed up. I think we might have some similar positions, but every day around noon, you can find this trade of the day segment. So with that being said, we'll jump right into the Tasty platform. I'll share a little bit about what we have in the portfolio so far, how we've been managing some of these trades, and then we're going to get into the trade of the day that we've been eyeing. So with that being said, this market's been pretty volatile today. We're getting a little bit more downside action, which is nice. And it helps out, some of the positions that we have in the overall portfolio, right? We got names like Apple, Apple Oven, Microsoft, Micron, QQQ, SMH, TLT. And then oil has really been helping hedge some of the other live trades that we have on in the portfolio at the moment. But the one that I really want to point out is Micron, because the trade that we're going to put on today relates to this one a little bit more. Micron has 7 days left to expiration. We sold an out-of-the-money call spread, so that time is on our side just in case we don't get that pullback that we're looking for and the duration that we're looking for it in. So I want to keep an eye on Micron. We're down on the overall position, but the trade of the day that I was looking at was going to be an INTC today. And as you guys know, there's a super high correlation with names like Micron, SanDisk, Intel, and some other names. We talk about it almost on a daily basis. But these names are seeing a little bit more of a pullback today. At the bottom of this move at around 81 again. I just use this as a reference point, but this is when Leopold was getting liquidated. And you kind of see the same type of price action, in all of those names. And I think the big question is, after that massive liquidation, right, there's other big names in these names as well. But I think the main question is the momentum going to continue to the upside that we've been seeing, right? Are we back in business? Are things going to go back to normal? Or is this going to be a little bit of a change in behavior, a change of character in these underlines from what we've seen so far this year? And I'm of the thesis that we've seen the top in a lot of these names from the euphoric run that we had seen earlier this year. So I'm leaning to the short side. I'm leaning bearish. We already have a trade on in Micron. But I was looking at INTC, and I know this trade is going to be a little bit different because we don't typically just buy options. But I was looking at the trade page, and I was looking at the September 18th cycle. And more specifically, I was looking at the 90 put that's at the expected move. This is 35 days to expiration. It's pretty cheap considering it is an individual contract that I'm going to be purchasing right here. And this 90 strike right now is being traded for 278. So a little bit of a different trade, right? It's not a diagonal. It's not a calendar. It's not a zebra, which I almost debated on a zebra because it is a $100 stock. And doing zebras in trades under underlyings around $300, $200, $100, I'm a little bit more keen on. But I didn't want to assume all that volatility that we could see over the next 35 days. So with that being said, I wanted to take a cheap shot to get a little bit more directional exposure to the downside on these memory names. Now, this 90 strike is going for 278 right now. So it's pretty cheap, especially considering the fact that there's 35 days left to expiration on these contracts. But I'm not going to assume the maximum risk on this, right? Like, I don't have to sit in this position until we lose the full debit that we're going to pay on this position. But this one's going to be at the expected move. The delta on this is going to be the 22 delta. There's about 25.7 thousand contracts opened at the 90 strike. You can kind of see on the options chain over here. The 80 strike is another popular one, kind of those round numbers. And then whenever we go a little bit lower, we can actually see numbers like 67.5, 65.5 with a ton of open interest on those contracts. But with that being said, I'm looking at the 90 strike, guys. Just a cheaper shot to get a little directional exposure to the downside. So we'll see if we can catch a fill on this one. We got filled 284. So we're almost essentially adding more short delta to the trade thesis that we already have. Again, right? Because we've kind of been working a trade in here. We got Micron. We sold an out of the money call spread there. Over the last 24 hours, we've seen a little bit more of a pop to the upside. So those positions are sitting in a little bit of drawdown. And if we continue this momentum to the upside again, I'm not going to hesitate to get out of the short delta. I'll call it quits, right? I'll get out of the position. I'll take the loss, and then I'll move on to the next one. But what I don't want to do is take max losses. I don't want to be sitting in trades where my trade thesis has already been invalidated. So that's a little bit more of the headspace that we're in right now. And I see Vivek, he said, guys, I shorted AAOI. How do you think we're going from here to the close of the day? We could take a quick look at that. But anybody just joining us for trade of the day, we bought a put in Intel looking for a little bit more downside action. And again, another reason why I want to add a little bit more short deltas is because I believe that the Qs and the overall market could see a little bit more of a pullback. I'm not calling for a full-on reversal, but again, I think we are warranted for a little bit of a cool-off period. So I'm going to be looking at that AAOI. I think I had seen down in the chat by Vivek. I don't think I've traded this one, but we do have an IV rank of 46.3, 13.5 million shares traded on the day. This looks a little bit similar to those memory names we were looking at. User says all-time highs, low volume, really low VIX, under 15. Don't chase anything in this market. Sell and take profit. I think that's a really good point you bring up, user. I think, volatility is super low right now. We're trading under 15 on VIX, like you just pointed out. It's been very low volume. And I got to say, I know Tony Batt the other day was talking about how, in his words, this is like a melt-up, right? And I think it drives Tom crazy sometimes too. But I would agree with Tony on that one. This does feel like a little more like a melt-up that we've seen in the overall market. And I think a better visual example of that is if we pull up this SPY, and then if I can quickly get on the volume bars at the bottom of the screen, I think it'll give us a better perspective of how that volume's really been dying off. And I know I've been using Leopold as a reference point from when his fund had blown up. And look, hats off to Leopold. This man's fund blew up, and he's still, I think, is up around 80% on the year. This man is still beating the S&P 500 by about 8 times. on the year considering that blow up. So hats off to him. But I got to say, the bottom of that move, we had seen the most volume traded, and then we'd seen volume taper off back into an all-time high. So I don't want to take too much time here. I wanted to quickly just see if we can get the volume subgraph on in here. I think if I right-click this, I could go to, let's see where we can adjust this very quickly. I may be able to just be able to click. Let me go to settings right here. We'll go to chart, watermark, candlestick. We'll go to data, and then we're going to click on volume. There we go. Easy way to get to the volume if you want to pull up the volume on your chart. Just a quick right click or click the settings on your chart, go to data, and then you can toggle off and on that volume indicator. But again, the point that I wanted to make, that user was actually making in the chat again, was the fact that volume has been tapering off, right? You can see down here at the bottom of this move, this is again where Leopold's fund was blowing up with a lot of the memory names, and whatnot. High volume traded day, right, relative to the surrounding volume. And since then, volume has only tapered off down to a pretty extreme low on the day today. I guess it is Friday. CPI is out of the way. But with that being said, it's been super slow. So I do have a similar perspective there. But I would love to see a little bit more downside action. And I think because of the fact that volatility has just continued to taper off down below 15, it's going to be interesting to see whenever we do get that expansion in volatility. And it always comes out of nowhere. So it's also, if we don't want to be somebody chasing into a lot of these moves, we kind of have to structure and prepare some of our trades for a potential expansion in volatility, or that's at least how I'm viewing this market right now. Because I think once volatility pops, sometimes it can be difficult to join the move, and sometimes it can be difficult to feel like you're now essentially chasing the move. It does feel like a melt up. Yeah, no, it definitely does feel like a melt up. It's like really slow, kind of that grindy action. We're kind of just slowly stair-stepping higher. And if you're somebody that is leaning short in your overall portfolio, it's not an aggressive switch up on your P&L, but day by day you start to see, that short delta increase, and you might be in the water, almost like quicksand. You just slowly start sinking, and that's how this market has felt. How is SPX and VIX down? Yeah, I think that is interesting. We've been seeing some divergences between that as well. I like to view the market through the Qs, but we'll take a quick look at, I know you mentioned SPX, but we're still going to take a quick look at SPY. I think it's a little bit easier to see the volume over there. But yeah, it's looking like the market isn't very fearful of anything right now. And when things get too quiet, that's sometimes when we get a bit of a shakeup. Everyone at the beach will be back in the fall. Yeah, I don't. We're sitting here. We're not at the beach right now. You know what I mean? So it'd be nice to see a little bit more volatility in some of these names. But I think what's going to help really piggyback this portfolio is going to be this continued oil trade. And something I was taking a look at earlier today was the fact that this backwardation on oil sustains. I think we've seen backwardation in oil pretty much all week. We saw it a little bit more over the last 2 to 3 weeks, and then it went back into contango. And then the entire 5 days of this trading week, we've seen oil sit in backwardation, and we've seen that curve slowly steepen. And I know we have a lot of conflicts going on with the Strait of Hormuz, right? A lot of things going on with the Iran right now. I know Cem Karsan loves to touch on the tone of, these conflicts most likely not being near over just yet. This might be extended out, maybe even post midterms this year. So with that being said, that's another reason why my bullish bias, sustains on a lot of these oil products. So we're going to try and ride this futures contract that we have on in there for a little bit longer. We've been consolidating the last 24 hours. So we really haven't gone anywhere, but it is nice to see that the bottom hasn't fell through the floor just yet on oil. So we'll be patient on it. But if you guys are just joining us, we just did another trade of the day, and the trade that we had sent through was we bought a put on INTC. We have about 35 days left to expiration. This is a put that we purchased, so time is going to be a factor that's working against us. So we're looking for a pullback within the next 7 to 14 days. If we don't get the pullback within 7 to 14 days, I'm going to be managing this position, and I'm going to be taking it off the table. Maybe we be patient and we reposition for a move to the downside another time. But we don't want to take the max loss. I know it's only $284 that we purchased this contract for, so it's not too expensive. But if we start to gain any level of conviction or increased conviction while this trade is trying to work, we could always add more contracts. But we'll start with one 284, not extremely expensive and very easy to manage. So we'll start there. Now, for the rest of the portfolio, we still have an out-of-the-money call spread we sold on Microsoft. We have an out-of-the-money call spread we sold on Micron. We have an out-of-the-money call spread that we sold on QQQ. Micron and QQQ both expire in 7 days, so at the end of next week. And then we have SMH as well. We sold another out-of-the-money call spread there, $5 wide. 98 days left till expiration, a little bit longer. We'll be patient on it. And then TLT, we're long bonds. TLT really taking a hit today. I could imagine if we go over to the gold chart, the metals have most likely been popping on the day. But the bond's trading at 81.88 right now. We had a little bit of a pullback yesterday. I know Ilya was talking about getting long some more of the gold products yesterday into that pullback. Because if you didn't catch the initial run that started about, a few days ago last week, sometimes it can feel, again, that you're chasing into some of these moves. But if you do still have a long bias, yesterday provided a pretty decent opportunity to at least tack onto that momentum to the upside that we're seeing in metals. But again, to my dismay, bonds are down, gold is up. But with that being said, guys, this was trade of the day. I put on the Intel trade. We bought a put for about 274, 285. I know we didn't sell the option this time, so we're switching things up a little bit there. Hopefully we get a directional move over the next 7 to 14 days. If not, we'll manage the trade. That's what trading is about, finding risk to reward that you're comfortable with, that's favorable in whatever trade thesis that you have, and then pull the trigger and manage the outcomes regardless of what happens. But with that being said, Ryan, Andrew, User, Vivek, everybody else, thanks for taking the time to join this trade of the day. We do have another trade coming on next. Be sure to stay tuned for that. We got Chris Vecchio coming on. Always love hearing his thoughts on the market. So be sure to stay tuned, and we'll be right back.
We're back here watching Tasty Live. This is trade of the day, or ideas of the day here. I'm Chris Vecchio. We're going to be looking at a few different tickers here. First, one new trade for this Friday, and then a few others for the weekend review so far, because we put on quite a few here over the past few sessions. But today's trade is Yum Brands, ticker YUM, and the structure here is a short 155, 160 call, sitting out at 63 days to expiration. Now, this isn't the usual time frame that I like to operate on if I'm looking at like a short call spread. But when you look at Yum, it's not the greatest stock to trade. Yes, there's only 550,000 shares traded today. When you look at the options chain, there's actually the volume that you see here in the 155, 160 strike. That's me, I suppose, because there were 0 trades there before I did it. Why am I doing this up here? It's been a really strong tape in this market, phenomenal. In fact, when we take a look at the S&P 500 or the equal-weighted S&P 500, QQEW has charged up to fresh all-time highs in recent sessions. So has the equal-weighted NASDAQ. Well, it may be off a little bit here today. Ultimately, we're going to find a new all-time high close on the weekly charts. So this has been a good tape for not just your tech stocks or your semiconductor stocks, but really your average stock. RSP, this is an all-time closing high if the market were to close here today. So why do we talk about Yum Brands then? Because Yum Brands has not been able to take advantage of this uptrend. Even from the market's lows at the end of March going into April, there wasn't a real substantial rally here. This is a stock that's still in the downtrend, and it's consumer facing. Retail sales this morning were pretty disappointing. Consumers are under pressure thanks to the Iran war. Gas prices are up. Credit is more expensive, more difficult to come by, yada, yada. So Yum, being a consumer-facing brand, feels like a place where if I'm looking for some short deltas to help balance the boat a little bit, it feels like an interesting place to look. So the short 155 call, as always, when we're looking at a 155, 160, short 55 is 160 call caps the risk here. Since standard equity options, as we know, control 100 shares, a one-lot trade here is going to be about $500 for the spread on a $5 wide strike. So the spread here today, look, you're not going to get the exact prices that we usually like. I couldn't find a third of the width within 63 days, right at the expected move, but it's about $1.50. $1.50 is, right kind of where we want to be. It's close enough. Okay, $1.67 would be ideal. So we're not there, but we're there. I decided to take it. Max risk 150 against 350. Okay, that's not terrible with a 67% probability of profit. It's close enough where we can take that shot. So the setup here is selling upside resistance basically in Yum. That over the past few weeks it has been unable to capitalize on a very strong tape. It's not a real bearish statement because if I was super beared up, I'd just be buying out of the money puts with enough time to see my view realized here. It's just momentum probably stalls if it does squeeze to the upside. And if stocks, generally speaking, fall back, Yum probably isn't going to be at the top of anyone's list to go bargain hunting, as it were. You probably see the folks go to the memory names first, given how they performed. And Sandisk is up, 70% over the past 2 weeks. So as always, because this is a short premium trade, we're not going to sit around here like a potted plant waiting for this thing to go down to 0 days to expiration. And at 150 means 50% profit target arrives at 75 cents. So if this decays down to 75 cents at any point in time, including at the market open on Monday, we're out. We find the next opportunity here. If we push through 160 though, right? Getting through 160, we haven't seen a close north of there since July 13th. Right. And if we can stay, that's been a pretty considerable period of time now, going on a month. We just need to stay below 160 on a closing basis for the next month. And I think then we are good to go here. But it's really the Yum trade. Okay. 155, 160 short call spread, $1.50 in credit versus potential 350 in risk, 67% probability of profit in a stock that has struggled in a very strong tape. But let's review some of the other equity trades from this week here. We started with Visa, for example. The trade was a 39 DTE, now currently sitting at 35 DTE, short put spread 340, 345. The idea here was for buying dips. We have a stock that's above its 200, above its 50-day moving average, but just below its 20-day. It does potentially indicate that this has been a correction within a still sustained move to the upside. So that fit the criteria here. It's a kind of zone where medium-term momentum traders like to pay attention to. That's where I pay attention to in some of these charts. So the trend structure is still intact, even though the chart's cooling off. We put that on. It's up now a little bit this week. When we put it on August 10th, the stock was in around 360. It's up to 365. So this is working for now. There's no reason to take it off. We're not close to our 50% threshold. We're getting there. Not there yet, but maybe $1 or $2 or more next week, and we can cross there because when we take a look at Visa here, we got in at $1.08. So we do need it go down to about 54 cents. And right now, again, it's at 72. We also put on a trade in Oracle here. Oracle, 35 days to expiration now, the 160, 155 call spread here. It was failing around a test of its 50-day moving average at the time, which gave us a bearish engulfing bar key reversal there, as highlighted here on the screen. There was no follow through though. Immediately the next day, it bounced to the upside. We saw some more yesterday. Today, it's coming back in a bit. It's actually one of the worst performers, down 2.6%. So while the trade isn't working out as envisioned necessarily, I would point out that it's not broken just yet. And if it were to pull back in again next week, I would consider this to be a false breakout to the upside and give me more reason to hold on. If we're starting to look at a Monday where we're cycling into a new high, where all of a sudden we're through 159.25, I don't need to sit around here and see this thing go towards max loss. It's only $46. But there's no reason, we have plenty of time on our side selling something right at resistance. We can take a smaller loss than having to wait another 2 weeks while it continues to run higher and then press the loss a little bit more here. Finally, we also did Netflix there at the start of this week, and NFL down to about $78. We'll call it $77.98 right now. The idea there was a 79.81 short call spread, which again today wouldn't necessarily take it off because there's still plenty of time at 35 DTE. Also, market is stalling at resistance where we would hope it would stall here. When we take a look at that daily chart right now. So having a little bit of a run, is it turning a corner potentially? But like with the Oracle move, it stalled initially at the 50, pulled back, and then it started to advance again. So with Monday's move, right, if we're trading north of 78, looks like it closed there. I take a small loss. It didn't work out this time around. We had Kimberly-Clark, KMB. This has been an ongoing trade for the past few weeks where we've been rolling the 100-105 short put spread because like we saw with Visa, it had been one of those stocks where bottom left to top right, but had pulled back below its 1 month and was still trading north of its 50. So that has worked out really since the middle of July here, continuing to roll it forward. We move that out to 35 days to expiration. It's now the 105-100 here. And yes, it's working still. Currently could take it off for a small profit, 85 cents. When this particular leg was put on, we go to KMB, it was put on at 103. So ideally, we're looking for something of a decay down to about 52 cents, 51 cents or so before it's taken off for, again, that 50% profit target. And it's getting closer, maybe Monday, maybe Tuesday, we arrive at that juncture. As you notice, there's been a theme here for some of these trades. Not many things related to AI so far. Only one of them really is in Tesla, but that's going to be last on the board. We had CSX, the railroad. Railroads aren't related to AI or the NASDAQ or the semiconductor build-out, right? Pinning this around where it's currently trading around $50. It's been basically holding this 1 month moving average for the better part of the past month. So maybe we don't break too much lower. We don't break too much higher. We continue this slow, steady grind. But this has been a very stable, rhythmic chart this year. If you bought CSX at the start of the year, it was trading closer to $36. It's now near 50. So not nothing, but we're closing in on a 50% move year to date here to the upside. So if there's any more weakness, I may be so inclined myself to look higher. But when you see the railroads, by the way, when the airlines, they're all doing well, can't have too much of a bearish view on the economy. Here it was the 45, 47.5 put side. It was the 52.5, 55 call spread side. So total width was $250 per condor before the credit here. Since only one side can be fully challenged at expiration, that means the math risk is 250 minus the credit. So we just need this to stay inside the short strengths. Ticker TRV, Traveler, which again, a little bit of an oddball name you might find around here, but 350, 360 short put spread. Like much of this market had recently broken out. It's finding a shelf. It's hugging its 1 month. Will it hug this 1 month? Let's give it a chance to do so. That's why we're out at 35 days and not keeping it in shorter here, right? Because it could have a wobble or two and then ultimately rebound. And we want to give it a little bit of breathing room. But it's a very strong stock. There's a lot of these stocks right now, by the way, that are looking like this. Chubb, for example, has been performing well. These insurers, they've had a pullback, but they're still in fairly strong uptrends. KIU, the insurers ETF, is pretty emblematic, where it effectively went through let's scroll this out, went through a multi-month, multi-year consolidation. And only recently has it started to break out to the upside. So the insurer space, no one talks about it, but its charts look pretty good right now. Beyond there, though, the last trade that we took, which was yesterday, was the Tesla short iron condor. Because when we take a look at our charts right now, we find ourselves exactly trading around the midpoint of the pre-earnings close to the post-earnings reaction low here. And so the idea is that within this intermediate window, again, 35 days, we're not necessarily going to break higher or lower. The trim was put on at the expected move, right? At the time, it brought us down to about 300 and up to 365. It's a little bit higher now. This trade's not going anywhere. It was up yesterday. It's in today. It can be basically taken off at a scratch because Tesla, I think I got in yesterday at 177. So, look, there's time on the board. This needs to work. It needs to grind in the middle here. Grinding back and forth in the middle is just fine right now. It's a pretty low IVR, but the raw volatilities are still in the 40s, so it looked like it was worth, a gaunt for me here, as it were. But this is where we are today, right? It's a lot of uncorrelated stuff to the Western Digital, the SMH, the MES, the ES, all that other jazz that I've been trading here on the follow page, because you don't want to put too many eggs in one basket. Things can work on different time horizons, different strategies can work, and that's why you diversify. So here we go back to the trade today. with $5 wide strikes, max risk as being $350, about 67% probability of profit. If this decays down to about, we'll call it 75, 80 cents, we can take it off and we can move on to the next one here. But that's been the full week of the trades of the day, at least from me. We have one more coming at you. Ilya Spivak is going to be here after a brief break. We'll see what he has to say. Keep watching.
Well, we thought gold prices were going to find some support, and so it seems they have. We get a big batch of supportive economic data this morning pointing in that direction, and we can go straight to the charts. The levels we were looking for are indeed holding as expected. So take a look here at the gold futures setup, and it is much as we thought would happen here. So earlier this week, of course, we saw the sort of negotiating here of this level that prices appeared to break out. And our trade for the week was looking to add into the gold position that we'd been building since the beginning of the month. This was the initial breakout here, and spent a lot of time talking about gold as the proverbial beach ball, to echo friend of the show, Chris Vecchio, where real interest rates were surging since the beginning of July, which ought to be the worst of all things for gold, which yields nothing, especially in real terms. And we don't get that sell-off. In fact, gold heroically holds at basically the 4,000 level. And we've been looking at the TIP ETF here as a measure. And here's that sharp decline, almost 3% in the ETF. That, of course, as bonds look the inverse of yield, so too this ETF is the inverse of a basket of TIPS yields across maturities. And so this almost 3% move since the beginning of July is a sharp increase in the real cost of borrowing, which on the flip side, if you're a lender, is also a sharp increase in real yields. And so why in the world would you want to own an asset that yields nothing in this kind of an environment? Well, gold looked at that and said, yeah, well, I'm going to hold here. And when there's this kind of disconnect between the price action and its would-be catalysts, the news flow, cross currents from other markets, that suggests that the market really doesn't want to be going down and is resisting vigorously. And as soon as the pressure at the top gives way, much like a beach ball underwater, it'll pop. And so we have a pop here at the start of August. This is where we started getting long. The vehicle for this, of course, as we've talked about here, has been the 1 ounce gold futures. The idea being that we want the flexibility, first of all, to operate outside of the hours of U.S. cash equity markets, because we want the kind of dexterity in an environment where we get the news flow out of the Middle East giving us sudden headlines. We might get some sort of cross currents on sentiment overnight because Korea's stock market has become such a bellwether for the AI trade. It is an environment that needs that kind of flexibility because you never quite know when something relevant to the gold story might pop out of left field. It's not necessarily something that's a pure reflection of just macroeconomics of the sort of classic look at the data, see where the Fed's going type of a variety. But boy, did we have a dose of exactly that kind of catalysts today. So we've been watching the inflation numbers, of course, all week. CPI came out, PPI came out. Both of them told a similar story. We got the kind of washout of the influence from energy that you might have expected. Energy prices, of course, have moderated off the peaks. And so we can see that in crude oil easily enough. Here's a crude oil chart here. And we can see, of course, the markets attempted to erase all of the war trade, got back to basically where the war started. And then all of these shenanigans back and forth where the narrative seems to change every 48 hours. Depending on which tweet came out when, you have a rebound and then this kind of consolidation that lands us now back into the middle of the wartime range, and lots of back and forth, lots of head fakes, not really a lot of clear-cut guidance, but obviously we're off the peak, so there's some amount of washing out of the inflation story coming from the cost push influence of the war that was going to happen. And so we got that out from CPI and PPI. That much was clear enough. But under the surface of those numbers, what we saw was weakness in service sector inflation impetus. And we saw it in PPI, we saw it in CPI, where core services, the area of demand where most U.S. consumers shop, started to show weakness. Most U.S. demand, of course, is aimed at the service sector. Most of the U.S. economy is driven by consumer demand. 68% of GDP is household consumption. And overwhelmingly, most of that consumption is aimed at domestic firms supplying services. So when you see that kind of weakness there, that's not really an oil story, that's something else. And what we've been positing is that the markets are probably overdone on Fed rate hike expectations if all of these inflationary pressure that's been accumulating really for certainly all of the first half of this year and now then some is starting to squeeze consumers and create demand destruction and send consumers away from sort of other categories of spending where the sort of higher prices on energy and related things might lead to crowding out. Certainly the sort of frothy, aggressive growth in business investment is also throwing off inflation all over the place, and not surprising really, because all of this capex that the hyperscalers have promised is just pouring gasoline on a burning fire. And so we have a situation then where the market sort of has been looking for inflation, but when you look at break-even rates, when you look at sort of the essence of these numbers that we got this week, you end up with a story that says, well, yeah, okay, the oil shock seems to be washing out, but aside from that very predictable turn of events, you're starting to get that weakness from the other inflation that's been accumulating, now turning disinflationary because consumers might well end up paring back. And indeed, this morning, we get that story. Retail sales end up down 0.6% on the month. That's much worse than anticipated. The market was looking for a 0.1% rise. This was, in fact, the first monthly decline in retail sales since October 2025, and the biggest one since May of last year, and in all the wrong categories. Probably the biggest one was a 2.2% month-on-month decline in non-store retailers, so that's shopping online. One theory out there is that because Amazon pushed Prime Day from July to June this year, there was a kind of pulling forward of that spending. And in July, there's kind of a hangover, but it's really all over the categories you don't want to see, the discretionary categories, the categories where you would start to see some weakness in consumer demand, not just gasoline stations, as it were. And so that's one piece of this story. In fact, the kind of big control group number where you take out all of the sort of fair weather influences, you take out food services, you take out auto dealers, building materials, gasoline, and you get the number that's the retail sales measure that goes into GDP, and you get there a decline of 0.4%, whereas the expectation was a rise of 0.3%. So a very weak set of numbers on U.S. consumers for July. And then just 90 minutes after that, you get the University of Michigan's Consumer Confidence Survey, which is the August one. So a little bit more forward-looking there. And again, weakness. The index fell to 51, down from 55.2, well below market expectations, snapping a 2-month improvement, overturning both current conditions and expectations measures. The one-year inflation expectation rose as if to say, well, yes, consumers are indeed being squeezed. The weakness was across categories, across demographic groups, across political affiliations, all of which this survey polls for. So we get a U.S. consumer that's pointedly weak in today's data. And what's the upshot? Well, gold tried to meander back through this level and has very pointedly held it here. So we tried to undo this breakout overnight. We could not do it. And now we're holding right here. If we go to a higher frequency chart here, here's the 4-hour, we can see here's that attempt to overturn it. It ends up failing. This ends up being a failed breakdown. On an 8-hour, you can really see the wick and get a sense for how this is working. So we added more to this position on this pullback. We also added a bit more US dollar exposure through the Canadian dollar. And here there was a break that was likewise pretty clear. Of course, all of this US dollar weakness, again, coming with Fed rate hike expectations fading away. Here we had a breakout overnight. You could see it on the 4-hour quite clearly. There it is. And so I've added a little bit more exposure on the short dollar side. I'm already short the Aussie, or short the dollar against the Aussie, the euro, and the pound. Those are doing well today against the backdrop of all of this. And I've now added the Canadian dollar as well to that mix. The policy expectations for the Fed have shifted, as you might expect. We're about 50-50 now on a rate hike, both in September and in October. September looks weaker. October is a little bit closer to 50-50. September is closer to 70-30 for a hold. Markets still think we might get a rate hike in December, but nothing for all of 2027. So we're going to look for this gold move to continue, and we're going to look for the dollar to continue to weaken as the markets digest that maybe they've overdone what they think the Fed is going to do.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80-plus Forex pairs. 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Investopedia says we're the best for options trading. Stockbrokers.com says we're #1, and Broker Chooser raves about us too. So what else can we say other than boom? Trade like a trader. Tasty Trade.
It's time to trade smart, post PDT rule elimination. Now, traders of all account sizes have more flexibility than ever before, with rapid order entry and bracket orders that let traders manage entry, profit target, and stop loss, all in one ticket. Tasty Trade.
What is going on, everybody, and welcome back to another This Week in Stocks. I'm hoping this little quick recap of the week is going to be more entertaining than the current market environment that we're trading in so far today. SPX trading at its lows, volatility trading at its lows. It's a pretty dry market, and like some of you guys said in the chat already, everybody's off to the beaches, and we quite literally feel that through the volatility right now. So with that being said, let's do a quick This Week in Stocks, and let's check out what you might have missed, what you might have heard about, and what we're going to be looking at headed into next week. And with that being said, record highs, right? Hard reactions. SPY trading at another all-time high. That's kind of been the story of the week, right? We've seen another all-time high this week in stocks, specifically the S&P 500, but it's only gained about 0.5%. So although, yeah, it's a record, we haven't seen much continuation into this SPY or S&P 500 high that we logged this Thursday. So we had CPI this Wednesday as well. Thursday, we saw the all-time high, closing the week off, maybe even a little bit shy of the numbers that we have right now. And then again, that rate cut into September, the probability of the rate cut for September dropping from about 52% down to about 35%. So almost chopping that number straight in half. And I mean, I guess that makes sense. That seems like it's falling in line with expectations, but it's always interesting to kind of see the odds from a percentage view and kind of see how that's fluctuating here. Another story of the week was the fact that retail sales fell about 0.5%. Initial claims stayed at about 209,000. And down in another slide from here, we're going to go into more details about that. But we did also hear about, the tankers that were getting attacked in the Strait of Hormuz, causing Brent crude oil to catch more of a bid this week, which has been really helpful for some of the trades that we've been having on. I know oil's been a pretty popular product for a lot of traders right now, a lot of active traders. And it's one of those products where you very much so have to pay attention to the headlines that's coming out. And with the headlines that can be so wishy-washy, it's been really helpful to just figure out where you want to be long, where you might want to be short in oil, and kind of phase out a lot of that noise, because it does seem, especially with Brent, there's so much news and noise, and I think those two words can be used synonymously a little bit there. With that being said, we'll jump to the next slide here. Again, S&P 500 closing at another record high this Thursday at 7,798.99. So, I mean, if we round that up to about 7,799, just shy of that 7,800 level on SPY. Russell up year to date about 23%. S&P 500 about 13.9. NASDAQ about 15.3, and then Dow Jones about 12%. But you can already see just from these numbers, we're trading in the summer months right now. We still have another quarter of this year to go. So we're not there yet. But I mean, if the year were to end at the end of this month, or if the year were to end today, I mean, we would be beating the benchmark for the annual return that we would expect on something like the S&P 500. So does that provide more of a case for an extended run to the highs into the end of the year, and we put in some record numbers that we could log, bring up that average annual basis, or that average annual return on the S&P 500 a little bit more? Or will we see a little bit of a pullback or slowdown or consolidation, whatever you want to call it, in a lot of these indices headed into the end of the year? But with that being said, S&P 500, another record high this Thursday at 7,799. And as we jump to the next slide here, I'm curious to know if the Qs will still have it in it, if it will still have that momentum to carry it into that all-time high. But we'll circle back around to that. I know S&P 500's really just been doing their thing. More companies that we've been keeping an eye on over this week for the one-day move. We have Varex Imaging. We have Marine Max, Nebius, CoreWeave, Supermicro. And I know these have been some of the underlyings that Tasty traders have been pretty active with Varex Imaging, right, up about 48.8. That's going to be on Monday. Marine Max, 46.1 on Monday. Nebius about 34.1% on Wednesday. CoreWeave 19.3% on Wednesday. Supermicro 19% flat for Wednesday. So I'm going to continue to keep an eye on a lot of these tickers. I think CoreWeave has been the star out of this group. I think CoreWeave has been getting most of the love in terms of options and active traders and what they've been looking at. And as we now jump to the next slide here, it says lame that VIX and SPY are both at low of day. I know we were kind of just touching on the fact that I'm hoping that this week in stocks is a little bit more entertaining than what we've seen in the market here. And it is pretty surprising because we're so used to seeing a little bit of a cool off or a little bit of a sideways market prior to something like a FOMC or CPI. And even post CPI this Wednesday, I mean, we still put in some minimal a minimal range in a lot of these assets that we've been keeping an eye on. So I'm a little personally surprised by that. I know it's the summer months. I know everybody's out on the beach right now, and we're kind of waiting for that fall season. But I am still a little surprised by the lack of volatility we've seen. So I'm with you on that one, Jared. If we're going to be red, at least give us some volatility, 100%. I mean, we got the overall market down and volatility down. Just rubbing in the lack of volatility for us. But here we have misses and crowded expectations were punished, right? On holdings down about 20% from Tuesday. Cerebras about 11.9%, just shy of 12%. Cisco, another really popular underlying, especially for the Tasty community, minus 8.5%. Applied Materials, really feeling it here, especially when it comes down to Applied Materials, down about 6.1%. And then Intel down about 4.1%. And Intel was actually a trade that I had gotten in today. If anybody missed it, my trade of the day was buying an expected move put on INTC in that September 18th cycle. So we got about 35 days left. So, I mean, we're looking for this red to continue in Intel, right? Maybe this gets bought up. Maybe the overall sentiment completely shifts again, but we did add to a little bit more of that bearish sentiment that we've been seeing on Intel. But again, Cisco's still one of the more so popular ones, down about 8.5%, and that's on Thursday. I really want to put on an AMAT Super Bowl here. I'm gonna go price that out. Yeah, let us know how that's looking on AMAT. I don't think I've checked out AMAT this week, Jared, but if we have some more time here, we'll probably get into the options chain, check out what's going on over there. Yeah, and I could imagine zero DTEs. This is probably one of the most difficult weeks to trade zero DTEs, especially if it was somebody putting on a directional position, right? And especially if you're the one purchasing the zero DTEs. I mean, we really haven't gotten anywhere. So if anybody was selling those, that probably looked a little bit more attractive. That theta decay definitely eating up a lot of these trades. And I think the market makers were definitely the winners of this week for sure. What about gold? I know Ilya was just touching on gold. We've seen a little bit of a pullback in gold from yesterday. So I know his bullish sentiment continues there. You could always rewind and check out more of the details that he was talking about. But moving on here, rate pricings moved first, right? We got core CPI 2.5%, headline CPI 3.4% year over year, PPI sitting at about 4.7%, Treasury yields, specifically the 10-year, at about 4.63 right now, 2-year sitting at about 4.15. And headline PPI eased from 5.5% in June. So energy did most of the work, as this slide here lets us know, but it's always nice to get a little bit of a visual, especially for these treasury yields, and kind of see the trajectory that these are headed in. At the moment, things have been shifting really quickly, but always nice to touch base there. And again, what we talked about earlier, July retail sales down about 0.5%. Initial claims were about 209,000. So I think that was probably the catalyst of the week. I know CPI, we had some other interesting binary events to look out for. But this seemed to be most impactful for the market this week. Moving to the next slide here, like we were talking about earlier on oil, we had a couple attacks this week for the Strait of Hormuz. We had one on Wednesday, and we had seen oil fall, right, just shy of, we were sitting at around 89. We fell to about 87-ish, you could say. But with that being said, the momentum continues on these oil products, so we'll be sure to stay up to date with those. I mean, I think it's going to be interesting. Like we talked about before, it's that headline risk, right, and which headlines are still be impactful for the Strait of Hormuz, especially the longer that this conflict goes on. But we are still positioned long in here. We're going to be patient. About 1 in 5 barrels of oil global supply uses this strait. And again, 2 tankers were attacked last Thursday. Moving on there, 3 parts of the build. We got CoreWeave, we got Supermicro, and we got Cisco. So that AI demand stacked up. I know we've seen a lot of momentum in a lot of these AI names. It's always nice to look at this data, but it's going to be interesting to see when some of these things start to stall out. We could potentially be at the beginning of something like that, not calling for a major reversal. But I think that momentum is definitely slowing down quite a bit there. And jumping to our last slide over here, looking into next week, the bottleneck for Wednesday, we got Tuesday, Home Depot housing starts, industrial production. Wednesday, we have Canada duties, FOMC minutes, 20-year Treasury auction. Wednesday, ADI, Target, and Lowe's test industrial and consumer demand. Thursday, Walmart and Deere report, and then Friday, flash PMI and monthly options expiration. So I know we've heard a lot of talk about OPEX. I know Cem Karsan talks a lot about, dealer positioning, options flows with an emphasis on OPEX. So I know that that September OPEX has been another kind of flag point in which we're going to be paying a little bit closer attention to. But we're going to keep an eye on all these things. Again, it's been a slower week this week in stocks. Despite the record highs that we're seeing in the S&P 500, volatility sitting at a low right now. But when things get really quiet, especially, sitting below 15 on volatility, it seems to also be another attractive opportunity to potentially start positioning for a potential expansion in volatility. So we would hope to see that. So with that being said, over and under at 23. Look, whenever I say with that being said, take a shot. All right. And we'll see if you're still standing by the end of this segment. But no, we'll see where the market goes goes for that. Right now, I'm overall positioned short on the overall market. Again, I'm not a bear. I'm not like a Tim Knight bear. I'm not an Ilya bear. I'm not the bear of bad news, but I am positioned a little bit short delta and then positioned long delta on an oil. And they're not a one-to-one correlation, but typically whenever the overall market is selling off, that's typically when we recognize that the oil market starts to catch a little bit more of a bid. So again, not a one-to-one direct correlation, but a little bit of a inverse correlation that we're seeing with some of those products. So that lets us know we need to be mindful on any big moves in the market, because if the overall market is selling off, we're short delta. We don't want to Leopold ourselves into a lot of these positions where both moves on both sides of the market is impacting the portfolio. Are you still doing the TikTok videos? Yeah. I think I posted about one time this week on TikTok, 100%. We'll go live a lot on there as well. There's a lot more of the younger generation that we'll kind of connect with on TikTok too. So we'll be live in there quite a bit and checking out everything that's moving in the market. But with that being said, guys, we are coming to a close here. I appreciate you guys taking the time. Jared, Point, Deep, Vivek, everybody else. Nice boy. Thanks for taking the time to hang out for a little bit. Be sure to stay tuned for more amazing content that we have coming on next. Thanks for hanging out for this week's of Stocks. We'll catch you guys here in a quick minute.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Investopedia says we're the best for options trading. Stockbrokers.com says we're #1, and Broker Chooser raves about us too. So what else can we say other than boom? Trade like a trader. Tasty Trade.
Good Friday afternoon, everybody. It's 1 o'clock. We're still trading here. I'm Tom Preston, checking out the markets, and we can check some open positions and put on a couple of new ones, hopefully. So, okay, we gotta move kind of quickly. All right, so here's what I did. So around 9 o'clock, a little before 9, I sold the SPX Iron Condor. The short put strike is 77.75. So we're right there. So I have it loaded up here. The question is, I'm going to put this out to the crowd. So I have the YouTube chat open. If you want to weigh in, this is one of the decisions to make. Do I leave in a working order to buy this back for, what's my working order? I mean, symbol. Let's do this. Symbol filter. Here we go. So do I leave the working order in to buy it back for $1.35? Because right now it's trading for about $1.80, $1.90. And here's the deal. If the SPX just sits here, it's probably going to get filled, unless it makes a big move down, in the next half hour or so, which it could do. I mean, it could absolutely do that. The question is, I've waited this long. It is 1 o'clock. We've got 2 hours left. Do I leave this in for $1.35, and while I'm chit-chatting, talking about trading and doing new stuff, maybe I get filled, or do I cancel this order and let it go? Here I am saying I've worked this so hard on this article. I haven't worked at all. I pressed a couple of buttons, and that's what the trade is. But it's gone on so long. Should I just cancel the working order to buy it back and roll the dice the next couple of hours and see if we can, get a little bit more profit? What says the crowd? I don't know. Let's see. Anybody want to put up an opinion? Let's while we're deciding that, here's another thing. I'm going to show you folks how I'm dealing with this trade in Oxy. So right now I am short an Iron Condor and Oxy. I've rolled some of the, I had an Iron Condor, rolled up the put side when the stock rallied up. Oxy's, let's see, take the money and run. Oh, geez. The only contain, it's all about the risk out. Take it off and move on to the next. Okay. Wait till, all right, take the money. Or does that mean just let the $1.35 bid work? All right. Okay, fine. You guys are no fun. Just kidding. No, that makes a lot of sense because what can happen on a Friday, volume isn't huge right now, and there's a lot of potential surprises. If I can buy that back for $1.35, just get out of the stupid trade. It took longer than I thought. Leave it over for me. Yeah, okay. No, I like to have these discussions, and because I've been trading for over 30 years, have been working on, the retail brokerage side, building the technology for 25. And I got to say, I learned so much talking to all of you, each and every one of you. You have questions that I never thought about, things, hey, TB, what does this mean? What does that mean? How can you explain that? And it makes me really think about new things. We're getting new opportunities, new ideas, that sort of stuff. So I love getting this feedback. Sure, all right, fine. We're going to close it. Fine. If somebody takes pity on me and wants to sell me that Iron Condor, in other words, buy it from me, I'll do it. So here's what's going on with Oxy. Oxy rallied up right in my face. Thought it was going to stay in a band, and it didn't. It shot up. Right now, the stock's trading at 58.43. I rolled up the put side of that iron, so I'm in it for a net 74, maybe $75 credit total from the initial credit of the iron to the rolls. Where I bought back the worthless puts, sold out some new puts. So I'm in it for about 77, let's say 74 cents. I don't want short stock in Oxy. I just have no interest in dealing with short 100 shares of Oxy. So I'm short the 58 calls right here. It's probably going to be in the money. So what I'm going to balance out, and maybe I might try to do this on air. Do I try to buy this back? In other words, I'm not going to pay 58 cents for that call. Why? Because paying 58 cents is 15 cents over the intrinsic value of that call. And I know I'm not going to get 38. Nobody's going to sell me that call for 38 cents because right now the intrinsic's 43. And market makers, they're not in the business of giving me any money. That's fine. But so the question is, if I can get this for 44, right? I should probably buy it back. We're here now 42. Maybe I could put a 43 cent bid in. If I can't get filled, what I would do is look to buy the stock, or short the stock for as high a price as I can. Okay. So, buy the stock for as low a price as I can. I was thinking of a shorter put. So short a call. If this is in the money at the close, I'm going to be assigned 100 shares of short stock. Okay, fine. I don't want it. I don't necessarily want to be short Oxy. So I need to buy it back. So the question is, if I cannot get that call back for a reasonable price, I'm just going to buy 100 shares for as cheap as I can get it. So let's just try it. Let's see if somebody bites at 40. Let's say somebody bites at 43. Mid price is 47. No, I don't like that. Let's go down here. 43. So I'm watching the market. Let's put in a 42 bid. And I don't think we're going to get filled. Let's see if it pops up. There's some 42 bid. Watch the stock price. If it goes, I think if it trades 41 again, definitely 40, I would probably get filled for 42. So that's what I'm looking at right now. Let's go into the watch list that I have loaded up. A couple of stocks that I'm looking at. SPX, yeah, it's coming back now, down $16. Nvidia, I'm thinking about stepping in and doing another bullish trade in Nvidia. Nvidia has been one of my reliable winners over the past year. So the stock's rallying up. I don't know if anybody has any opinions about Nvidia, but kind of bullish on it. I don't necessarily want to trade through earnings. Volatility 23%, not bad, but I think this is debit spread land. So here's how I evaluate debit spreads. Let's go out to 10 days. Markets are very tight. I like that. What I try to do is buy this spread, buy a call spread to get positive theta. How do I get positive theta out of a debit spread? Seems counterintuitive. I'm paying premium because the 222.50 put has $2.94. Is that right? Yeah, 250 plus 40. So about about 290 in intrinsic value, and I'm paying less. The debit of the spread is less than the intrinsic value of that 225 call. Then it should grow into that intrinsic value and generate positive theta through that. So about 13 cents, it's a little bit optimistic. I'm just going to take a shot long Nvidia for 10 days ahead of earnings. Okay, all right, you're all clamoring. What's the skew tell you, TP? Okay, the skew, stocks at 225, down 2.5, up 2.5, 283, 222 half puts are 283. The 227.5 calls are 340. Yeah, the skew is more to the upside. Let's go in for 260 on this. Ship it, filled. All right. How about, I was looking at Tesla. Jeez. They filled me on my Iron Condor, $135. All right, I'll take the win. I'll take the win. I did not do this in any kind of big size. I had a weird feeling it was gonna test me today, and it did. If I traded it bigger, the profits would be much bigger. But I'm happy I made a couple of $100 on that trade. Let's go into Tesla. I was thinking, I don't know. Who wants to try a 0 DTE, like Iron Condor in Tesla? Oh, what? Question for you. Short the D's into 49 put, have been managing about those on rolling strikes down to convert intrinsic. Let me aim at the Super Bowl. So short of D's, let me pull this up first. I have time to do this. Let's do into it. So Manny asks, short of D's 490 put. All the way out here, 490 put. So it's in the money. Okay. For $46 credit. Okay. Been managing for a bit. Thoughts on rolling strikes down to convert intrinsic to extrinsic, to go down to 440 without paying more, thanks. You're long a lot of delta. So what you got to look at here is how much delta you have. And you've got 84 delta. So that's you're long 84 shares of stock. That's the equivalent of that 480 put. Is 480 put? 490 put. 490 put's 86. So if you like being long into it and don't want to buy the stock, you're long here to generate some credit. Yes, you could roll down to the 460s, 440s, Yeah, I mean, you could do that because the four, keep getting confused with the strikes. The 90 puts have about $11, 11.50 of extrinsic. And you go down to the 440s and basically cover that. So if you bought this back, you'd be paying about $11 and change of extrinsic value to buy this 490 back. And then selling out the 440 would get you a little less short delta and collect about $17, $18 of extrinsic. Yeah, you could do that. You could roll down, and by doing that, you would be maintaining most of your long deltas and capturing a little bit more theta. So we go from delta, let's switch over to theta, is because here's how I think about this stuff. The 490s are generating $11.23 a day. The 440s are generating $17.80. 1780 is higher. Yeah, that's not bad. What you could do if all you have is that naked short put on, you could just sell the 440 calls against it. Treat that short put as and you are short a put. Yeah. So short a put is basically long stock, and you could sell a call against it. There are a couple of different ways of approaching it. You could roll down. You could do that. And you could also sell an out of the money call against it. And it would be kind of like a pseudo, or I should say, maybe not a poor man's covered call, which is buying a call, or buying a call, slightly in the money call, because you don't pay too much for it. Selling out of the money call against it, because you're short a put, you're huge. This is a rich man's short, or a rich person's short put. Okay, rich man's covered call. You short a deep put, sell a call against it. Let's see, 0 TD butterfly over an IC. Yeah, we'll see. Okay, so let's get back into Tesla. So I hope that answers your question. If you have any questions, it's TP@tastylive. I think that's my email. I don't email myself very often, but people find me. So let's do this. So stock's at 41. If we do, can we get... I mean, there's such a disparity in the opportunity. This is looking a lot better. How about we buy this, sell 2 of these, buy 1 of these. How about we buy I do a 0 to over an hour card at this point in the day. How about just this regular put butterfly? We take an 80-cent shot on it. We take an 80-cent shot. If it sells off down another buck, if it goes unchanged, we could have the potential of maximizing the value of that butterfly. What do we think? Yeah, let's go for it. Let's do 80 cents. Let's do 80 cents. Oops. 80. First day with new hands. Ship it. Filled. Fold on a butterfly. Yeah, I don't do a whole lot of butterflies like that, but just to play. Let's go into what else do we have? NVIDIA, that Apple, Avgo. I was also looking at Avgo. Avgo has sold off a lot today. Avgo popped up in my big standard deviation mover list. So Broadcom, don't know too much about the stock. I've traded it a fair amount over the years. Big sell-off. So this was like a 1.5 standard deviation move down. It's a pretty big sell-off, even for Broadcom. Again, this was huge. We've seen, so this thing swings around. Looking at the skew ahead of earnings are coming in September. 7 days. And the markets are relatively tight. If we go to, I just had Theo. Did I have that right? No, yeah, you're right. I had theta. Good catch. I was looking at theoretical value, not theta. Duh, that was a stupid mistake. I apologize. Let's get back into Avgo. Well, actually, no. Let's look into Intuit just to make the discussion fair. Intuit, I'm still going to suggest that the 490, yeah, the 490 puts are generating $13 a theta. The 440s are $15. So yeah, you generate a little bit of theta for that, doing that trade. Let's go into Avgo. Let's see which way the skew is pointing ahead of this number. So 380, so it's 390-ish. Say down 5, up 5. The skew is pointed to the downside a little bit. Just a little bit. Could we sell an iron condor 7 days out? We go through the weekend. The 272 puts are trading about 240. These are about, yeah, they're roughly the same price. So if I go to the 407 halves, do this for a 91-cent credit. According to my math, 2.5 divided by 3 is about 80 cents. So I'm collecting a little bit better than that third of the width of the strikes for this. Let's see if we go down one strike on the put side. What do we get? 78. Yeah, let's do this. Let's sell it just out of this expected move. We'll go over the weekend. Hopefully nothing catastrophic happens over the weekend. Ship it. Submit. Filled at 78 cents. Thank you very much. We'll see how Avgo treats us. One of the things I saw a question, why is the VIX down? Just because it goes down. It's nobody, the panic is gone. Complacency settles in across the land. Everybody's happy. The VIX is down. You know, this is what happens. So why is the VIX down with the SPX down? Day to day, you're going to see that. And especially when it hits really low levels like this, you know, like, the 14 handle. When I talk about handle, by the way, the handle of something is the integer part. So 14 in the 14 handle. All right, that's how a trader describes it. The VIX is in the 14 handle now. Right? So it's down. What's happening is, especially as we go into the weekend, there just doesn't seem to be a lot of demand. People are not bidding up the out of the money SPX calls and puts. They just aren't. And this sell-off in the SPX, which is $16 on a $7,700 index, is 1/5 of 1%. Okay, this is, hate to break it to you, but this is not a sell-off. They're just sucking premium out of those options. And so what happens is, yeah, the SPX is falling a little bit, but because they're just lowering the prices. Remember, the VIX is based on SPX option quotes, not trades. So when the bid ask of the SPX options change, the VIX changes. It doesn't have to trade there. So if the market makers are lowering their ask price, lowering their bid price, just taking everything down a little bit, 5 cents, 10 cents, or whatever, simply doing that will pull the VIX lower. And that, I think, is what's happening today. And somebody said, yeah, VIX calls are really cheap. Yeah, when the VIX is in the 14 handle, stuff looks very cheap. And it's frustrating. I hear you, going to do these SPX iron condors. Geez, you're still doing those things. Yeah, well, that's part of the mechanics. And volatility, it's not a perfect predictor of what a stock or an index might do in the future, but it's the best one we have. And maybe one of you or maybe one of your kids or your grandchildren or whoever will find a better metric for measuring potential risk of a stock or index, but I don't know what it is yet. And I'm still working on it, and I've got some ideas, but the volatility, the current implied volatility of anything, whether it's SPX or Avgo or Tesla or whatever, is the best, not perfect, the best. Tesla pump, they're rallying against me. Yeah, VIX down, market down usually means there's still tall skew despite direction of the price. Yeah, you're right. Oh, I need to get that shirt. Yeah, so this is a local Austin guy. This is my flame shirt. It's a little hard to wear outside. I'm in my little trading room here that's 68 degrees, so I can afford to wear this shirt. It's a little heavy, but I can't go out. So it's like 104 degrees out there today. I send my wife out for for taking care, going to errands and stuff. Hey, can you go to the store? It's I'm too delicate to go out there in 104 degrees. So anyway, what else we have here? Tesla trading week. Yeah, I'm actually having a pretty good trading week. How's my Tesla trade? Probably blown right through it. Where's Tesla? It's in the money. Yeah, it's right there. Yeah, it's killing me. It's killing me. Let's go in and do another trade. Let's go into Apple. We could go do an AMAT trade too. AMAT had earnings. Did they have earnings? Yeah, I think they did. This I don't know. Could we do a 0 DTE AMAT trade? 502? 59-cent credit? It's right there. Who wants to be bullish on AMAT towards the close? How do you handle your weekends with the market closed? I fix air conditioning. I'll have to tell you the story. I'll go to Buc-ee's today. Or not tomorrow, Saturday. So I replaced the air handler blower on one of my air conditioning units last weekend. It worked out pretty well. I got a quote from the HVAC guys for a motor. So I looked up the motor model, and I'm pretty good with electronic-y things and stuff like this. So I replaced it, saved myself a couple $1,000. I think 500 protected on AMAT. I mean, we could go down. I'm going to sell this put spread for, let's say 60 cents. Let's ship it. Let's ship it on AMAT. Filled at 61. They gave me a penny. Did a Super Bowl. So one of the things too is when you're looking at those Super Bowls, it's an interesting trade. Selling another out of the money put spread, buying an out of the money call spread. You got to look at your total deltas. And it may be more cost effective for commissions and slippage to look at the money call verticals. Not saying you can't do a Super Bowl, just understand what exactly you're getting into there. And if you're looking to get long deltas, sometimes just an at the money call spread could save. It's 2 trades, not 4. Just kicking it out there. Okay, so just be aware of what that trade is synthetically. Waiting for my AC. Yeah, so Dash Tube. You gotta learn how to change the capacitors too. Have a little supply of capacitors pop the cover off the condenser unit, the thing outside that spins around. Pop the cover off and look for a cylinder, not a big cylinder, kind of a medium cylinder. Medium cylinder, probably your capacitor. Don't touch it. Turn the power off at the breaker, at the shutoff thing, because that capacitor has power in it. So be very careful. Don't be fiddling around with any capacitors. But you want to get the correct size of it. Order a few for your closet. All right, we're coming up on 126. Wait a minute. What's up, Frank? Good job. Motors can be traded to pull out of the blower housing. Yeah, mine was actually pretty simple. I'm not going to jinx it. Any other trades? Let's get on this. Watch list. NVIDIA we did. Apple we didn't do. Let's do a quick one on Apple. Bullish, bearish on Apple, people? I think you're all bullish. Everybody loves Apple. Let's go to 35 days. 33% IV rank. $1.60. I'm not getting it. Let's do 300, 310. Let's do it. Slightly positive theta. Submit. Filled. All right. So we just did a pile of trades. I'm going to push these out to the follow page in case you want to play along at home. We'll see how NVIDIA, what did I do? AMAT, short put spread, Tesla, put butterfly. We'll see how those treat me towards the close. Anyway, None of this trade recommendation, and if you do this stuff, please don't do any more risk, take any more risk on it than you are comfortable with. Folks, stay tuned for some more programming. It's great programming, and I will see you on Monday.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Bad Money with Jim Blamer. Blamer's hot stock tip of the day. Trade ideas? Trade ideas? You're coming to me for trade ideas? I'll give you a trade idea. Trade me for tastytrade.com. Those guys are great. I love those guys.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Yeah, and I'm fun on the block all day, all night. Is an A and no stress, no fight. Fun on the block all day, all night. We just living it up, yo, that's real life. Wake up, sun grinning through my window. Text my crew like, what's the plan? Let's go. Shirts wrinkled, jokes twisted, nothing too official. The outside flexing on my bike, got the bell with the whistle. Corner store, pick up chips, 2 shoulders. My board in the slides, trying to dunk on the stroller. Kids running loose, auntie sipping lemonade. Every front porch got a beat, yeah, that's homemade. No drama, just heat waves of laughter. If we got problems, could we solve them after? Grilling on the curb, grill marks on the shirt. Somebody brought the tools, man, let that Luke word. Fun on the block all day, all night. After with my people, yeah, we feeling alright.
Welcome back. You're still watching Tasty Live, and it's still Friday, August 14th, 2026. This is a Futures Power half hour, although maybe a name change coming soon. Producers are putting together a list of names. Too Fast, Too Futures was at the top of the list. It's still a work in progress, as you can tell. But maybe Back to the Futures, Past President Futures, we'll figure it out. Either way, sponsored by CME Group. I'm your host, Chris Vecchio. He's Ilya Spivak. Ilya, markets here, a lighter day today, especially as oil has taken a turn higher. I can pretty much draw a straight line between oil going up and when market stocks decided to roll over a bit. Bonds felt a little bit more pressure, heat under the collar. Other than that, it feels like it's a pretty light Friday here. It's already 2:30 Eastern time, which for the long-term watchers of this particular segment, use 1 million contracts traded market. That benchmark. We are at 650,000 contracts traded. 650,000 contracts traded here today. Like, it's small, it's tiny. There's no volume in this market. No one's doing anything. What's the concern? This is not to be excited about.
This is a concern we've been having really since stock markets had their most recent run out of congestion. Volumes have been falling apart all along. You look at the lows back in late July going into August, this has been the story of August, a precipitous decline in volume, even as stocks have accelerated on the upside. Now, standing in front of it doesn't feel any better because there's weak participation. Market will still take your money. So as we've talked about this week, I've gotten out of the way, taking the premium I collected on those short calls that I've been nursing for some weeks, and took the remainder and walked away. What is more interesting to me is the kind of trying to have it both ways that the stock market is having and not succeeding. Not succeeding in this sense. I mean, obviously we're within a hair of record high. So what is not succeeding mean?
I was about to say, like, can you please define that?
No, it's up there. It's up there. It's up there. I think what the mark, I think when I say not succeeding, what I mean is we're not finding that the markets are building a pattern, building a consistent reaction function where you could say, well, here's the theme. We're falling into place. Sentiment has a narrative. Here we go. We're not seeing that. So, for example, yesterday, the PPI numbers come up soft. Markets go, hey, great. Fewer chance that we're going to get an aggressive rate hike cycle. Fed funds futures wash some of that out. Of course, gold was anticipating that with about 2 weeks lead time, and so it had a little comeback. But look at what we see today in the wake of those retail sales numbers that were god-awful, in the wake of the University of Michigan Consumer Confidence Survey, which you could take issue with the data collection. It doesn't matter. It was all terrible. Pick a category. There was no nuance. It was just bad across age groups, whatever you like, political groups, gender divide. Any way you want to slice this consumer confidence survey, any issue you want to take with its data collection, doesn't matter. Forget about it. It was all bad. So when you look at then those same inflation numbers that the market said, oh, goody, the oil shock, it's going away. Okay, yeah, but also under the surface, what do you see? Weakness in core services inflation. That's not a good sign for demand. As a matter of fact, half of the drop in year-on-year CPI came not from energy, but from core services. When you look at the contributions of the various sectors to the headline number. And so you look at all of that together and you go, should the market be happy about this inflation? No. And so you get a market that seems to be trying to have it both ways, but can't find the consistency to say, oh, fewer rate hikes, so and we have growth. Good. Wait, but we don't have growth. Maybe not.
Yeah,
good.
you know, that's what I was looking for. We were talking about this on it was in the morning note, and then we did in the daily. Which when we recorded the daily video, you can go check the tape. Of course, it's slightly different than what was shared with Jermal and Mike when we got on, because it was after the retail sales report. But I had recorded in that video that if you get a soft retail sales report in the context of that weak jobs data and weak CPI data, all of a sudden it goes from like being a rate relief trade to, okay, maybe there's some weakness in growth and that could come in. New York Fed nowcast is revised down today from 2.24 to 2.21% for this particular quarter. So losing momentum, as it were. But Ilya, I mean, if the market was so super concerned about growth coming on the other side of all this, wouldn't the bond market be behaving a little bit differently here? I have highlighted on the screen with ZN at least.
Drunk.
Bond market seems perfectly sober to me, given how I'm positioned. But right, like this is another episode where at least since July, I've kind of just bracketed that 1 month moving average where we've come into its territory, into its gravitational wall. It's been a springboard for the market to push off of. And we saw that rebound yesterday after the PPI data, which, okay, didn't get their CPI. PPI gave us a little something. Oil back up today, immediately gave it up, right? So is this a growth concern? The market's telling you, I mean, at the long end of the curve?
At the long end of the curve, I think you have this interesting thing that happens, and it's a curious thing to see. Because when you look at the front of the curve, you see something different. And so you and I have obviously been toying with this idea for the past several weeks that if you pull rate hikes forward, then you should have lower rates at the longer end. And so bonds should go up. If you push rate hikes back, you should have actually higher rates at the long end because the tightening is still going to come. It's just going to come later. It's an interesting thing to think about today's move in the bonds because you do have weakness at the front of the curve. Fed funds futures have taken out more in terms of rate cut or rate hike possibilities. And so you get a swing back to the bottom of the range on things like ZN and things like ZB. Okay, fine. What does that mean? Well, in my mind, it just means the market still thinks we're going to get this mythical tightening that they've been betting on, except all of that has been built around an oil shock that's already fading out of the inflation numbers. We see that already. And if the issue is that we would have lasting inflation, okay, fine, but that depends on economic growth. And if we're starting to have questions about economic growth now, well, then maybe what we actually have is disinflation coming downwind. If you look at the Fed funds futures, there's a very interesting thing now. So September is not going to be a hike. The market is kind of centering around conviction on that idea. Okay, it's like approaching 70-30, no hike. October has now gone to 50-50.
Yeah, I'm looking at the Fed Watch right now. September 67% chance of a hold. October is only 52% chance of a hike. Market's still leaning into a hike for this year, but this may be the first week. Year. But this may be the first. Depends where you're. I mean, like 51% chance of a June hike, but then immediately back by September, it's going back to a cut. So, but effectively,
once you look at the aggregates, once you look at the aggregated probabilities for the CME tool, I mean, you're obviously right. When you look at the sort of granular stuff, you see back and forth. But when you look at the aggregated,
it's still one more hike by the end of this year, and then no hikes through the end of next year, right? But that's right. I mean, this might be the first week that I can remember in several weeks where we haven't seen a full hike priced in for December. Right?
Yeah.
It's probably going back to mid-June, right before that last Fed meeting.
Yeah. And so it's getting a little soggier. And so the bond market has been weird about this all week. I mean, yesterday you had the big pop at the long end with soft PPI and the front end, as though the market went, this is not a sequencing thing. And today it's back to maybe a sequencing thing. Again, there's not that consistency where you can
agree with you.
Draw a line.
I agree with you. What does the Fed care more about right now, inflation or growth?
I think the two are intimately tied at the hip. I think the biggest story
this is probably why we're divided
now is growth.
Okay, so when I look at the market right here, oil prices are in, they're up, they're down, they're sideways, inflation's coming in. We could look to the various submetrics, core services, chained, mean, trimmed. Okay, I see the crack ETF for the refiners, your MPCs, and we've been talking about this for a few weeks here, where not all oil companies are created equal. Excel's had a little bit of a better run here, no doubt, but it's been throughout the war, PSX, Marathon Petroleum,
It's the refiners.
Phillips 66.
The refiners are making the money.
I want Phillips 66, PSX. Pull this up here on the screen. Thank you. Why didn't that work the first time? Okay. Refiners are the ones making the money. MPC, PSX, Valero, VLO. Okay. So when I see these charts, I think that inflation is still coming. Like it's still going to be such a problem.
Very much could be.
Which is why when oil is up 1.4% today, we take a look what's going on in ZB here. And this all goes back to a trade, Ilya. 108 and 27 ticks. I'm in at 14 days still, the 108, 107 long put spread here. but I kind of want to treat this more like a double bear or a super bear trade. So in the inverse to Mike and Jermal's super bull, which is short a put spread, long a call spread. So you're collecting premium, and hopefully net you're collecting enough premium so that what you collect in the short put spread side pays for the long call spread side there. It adds a little bit of convexity to the trade. So you do need it to work and go up in order to make a meaningful amount back. But with this, I don't want to.
It's not dissimilar from the way I've mentioned. I've managed stocks where I'm either buying puts and sometimes I'm selling calls against the buying of the puts to reduce cost.
So right. So what I see here, Ilya, I see a market where I don't want to go into ZB. I actually want to bump on over to ZN to do this. And I am going to duration match here at 14 days to expiration. So in ZN, this is another beautiful touch of our 50-day here today, which when we go to the continuous chart, it shows a slightly different story. But ever since we got that opening candle when the Iran war started, that's this candle. This is a big bearish engulfing key reversal. So since we get this candle and begin our thrust, we have not really put in much time above that 50. These jaunts into this 1 month 50 envelope, the sell the rip criteria. Trend is down still. So if we tried breaking out of that this week, we got knocked away here. I'm going to treat 109.5 as a level to operate around. I'm looking at it 14 days. Is there anything I can do there? Right. So we start working through the question. There's a good chart set up. What does the market want to pay us to take this kind of risk? At 14 days to expiration, duration matching may not be the way to do this because I can't really get strikes at the expected move, even half a point wide. Getting paid 5 ticks on where half a point wide, I need a little bit more than that here, Ilya, right? If we're thinking about these, they're going in 32 increments. So I need at least 16 and 5 ticks. I'm going to need at least.
This is worse than 4 to 1 here.
No, but I need I need at least 10 ticks here, and I need better than 4 to 1 to justify. So I can't go to 14 days is what I'm getting around to, just looking at that pricing. So I push back a little bit. What does 109.5 look like? That's 7. We're getting closer. To do this, it might need to be 42, where 109.5 is paying 9, right? And all of a sudden, 53% probability of profit. We're talking about $360 of risk for a $140 gain. I can stomach this, and it also then staggers my risk here, where let's say in the short term, the bond market stabilizes, ZB may just fade away, but ZN could still work because it's a short call spread and it's not a long put spread. So it's kind of like a broken super bear across 2 products. I don't know, but the idea there is the same, that the long end of the curve is going to remain pressured. I just don't want to put all the eggs in the ZB basket with that 14 DTE. So I'm going to ship.
That makes sense.
Maybe we get filled.
That makes sense as a thesis. As a directional thinker, that's not what I want here. Only because I think the risk reward, looking at the chart, doesn't give you the kind of directional conviction that you'd want.
When you say risk reward,
the range.
You say risk reward here. I know you're looking at TLT. I know you're looking at these longer term charts.
I'm looking at ZN. I'm looking at ZB. I'm looking at TLT. I'm looking at IEF as the reflections. Yes, TLT looks great. Yes, ZB is at the bottom of its range. So the risk reward, whether you look at the futures product or the ETF, looks the same. The problem is that, as you just very artfully described, the trend is down. And trying to pick a bottom in this thing has been the widowmaker.
We've tried for 3 years, basically. Various success.
Yeah.
But it never...
I tried.
Never got the acceleration.
I tried, man. I tried. No. And by the way, it's not like things aren't working. Fed rate hike expectations are fading. Gold and silver are rallying on it. The dollar is selling off on it. So it's not like we got the idea wrong, but the bond market just does not want to do this right here. And so you look at sitting at the bottom of the range and you go, okay, I can try to pick this bottom, but the track record on trying to do that has been 1 tooth knocked out, 2 teeth knocked out. Pretty soon you run out of teeth. So, okay, fine. Maybe I want to look for continuation because clearly the bond market is telling me I see all the news, not unlike the gold beach ball underwater in reverse, right? Bond market saying, yeah, okay, fewer rate hikes. Yeah, okay, other markets care. I refuse. I am going to drive these rates higher. And by the way, the run up in real rates has been absolutely relentless. So maybe all of this is long-term inflation because we're building AI and we're going to juice up the economy and blah, 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 blah. Okay. I might even believe that there is a sovereign concern because the situation in real rates is the worst it's been since April, since Liberation Day April last year. Okay, I believe you. Okay, fine. Sovereign risk. I'm going to bet on higher rates longer term. We're right at the bottom of the range. What am I going to sell when my nose is getting squeezed against support? I'm not crazy. Give me a break. Give me a break through this support. Then I'm there.
I guess I'm crazy.
Give me a 4-hour close through the support.
TLT has been poking on down here. This is the low from 2007, and
it's right there. It's right there.
We're chipping away at this very long-term supply.
What I want from the bond market is conviction. Show me something, and then I'll trade it. But in the meantime, I'm going to take these rate hikes are overdone ball, and I'm going to take it to the metals. I'm going to take it to the dollar, where I've added exposure and where it's working.
Well, the next question is then, it seems that we're at a low point in terms of hike odds for this year. I mean, do we really think that the Fed is not going to hike in 2026? We joked when Warsh gave that first meeting talking about task forces, attorney generals, whatever, that we might not see a hike until December at the earliest, because Warsh would have the ability to turn around and say, we're still in danger. We got to just look at the long-term arc of history here. And so we'll wait for the consultants to get back to us, and we'll let you know in December, hoping to ride out, a window where hiking probably is appropriate, but that's not what the guy who got him into the job really wants at this juncture. So, Ilya, if the window where we're not going to get any hikes continues, I think that we're going to see higher yields. Now, if the market were to snap back and all of a sudden we look to September and we see that a hike is coming onto the board here, it's 32.5% chance right now. At some point next week, if that's north of 50 again, we're having a little bit of a different conversation about what the long end looks like. And I'm going to be abandoning a bunch of my pretenses here. So my view is really predicated on the Fed just always a day late, dollar short. They're always fighting the last war. And
I think that's kind of what they're doing here.
I want to move on here to equities, though, because we've been talking about bonds for most of, if not all of this here so far. Ilya, S&P 500, 7806 on our chart right now. It's been a day of oscillation, down 15 points. The Nasdaq down by 0.3%. I know you and I have been approaching.
How do you feel about the S&P having lost the break of the high?
It doesn't bother me because I'm looking at the equal weighted indexes up here as well. And, this is going to close at a high. S&P is going to close right off of a high. So in terms of the positioning, one of the things that we've been discussing around here is what to do with winners that are being run and getting rung to the upside right now. I think it's just let them run. 34 days until the U contract needs to be rolled. I don't see any weakness here right now. I'm a trend guy, Ilya, and we're holding up above the 1 week.
I think you're right.
Hold on tight. ESH7. I do have a game plan coming together here for how to operate around this because it's only $55 away from getting to the long strike that we put in back in April. And so if we get up to 81, that's when I would take this off, Ilya, and I would roll up my positioning into just two 8,400 calls for the end of this year, because I think this thing is going to still run. I know you and I disagree on that, but I like buying markets at high.
I mean, I'm starting to get curious about
bull curious.
Not unlike I bought IGV because I thought it was ridiculously beaten down for stupid reasons, and that worked. Because I'm not opposed to buying things when I see value. I don't think it makes sense to be a doctrinaire bull or a doctrinaire bear ever. I think you just do what makes risk reward sense. And so for me, I don't think I want the NASDAQ. I don't think I want the S&P. I think they're expensive, and I think the volumes have been weak, and I think the response to the earnings this week has been soggy on a good day. So I look at all this and go, okay, I don't want these. But does that mean that there's no opportunity out there? No. And I've been looking at I hope you have some cleaner for that white wall background because your head might explode. I'm looking at Korea. It's been absolutely shellacked, but it might be turning. And we're going to see
call yourself a bear.
Fed rate hike odds.
You can't call yourself a bear if you're trying to get long Korean
I'm
stocks.
not trying to call myself a bear. People have called me a bear.
It looks like
people have called me a bear. That doesn't mean that I'm a bear.
Okay, hold on a second.
I am
The
a Russian from
technicals here.
California, so I have some bear credentials.
EWY here, technically, the 1 week is now back above the 1 month for the first time since June 30th. This chart looks really familiar. SNDK, for example, breaking its downtrend. Micron here, breaking its downtrend. Still may have a little bit more to go, but you can see the recent shelf or ceiling, it just started to clear. Western Digital's had a really nice day bouncing back, which for me, at 7 days to expiration, I really would like for this to bounce a little bit more so I could take this off. I'm not getting myself wheeled into another position right now. SMH is doing enough for me, which today a little bit weaker. So on that 35 days to expiration, that short call here, it's still doing what it's doing. I'm getting this nice little bounce back higher in this. Okay, working. That short call is still well. I put it on when the stock was trading closer, the ETF was trading closer to like 510, 515, at which point I was like, okay, I got to wheel this thing out and really try to make some money back here. So, I mean, a lot of these stocks, they just look the same right now. XLK here, as it were, you see a breakout. The point is, I'm with you on EWY. It looks like so many of these other charts because it's just semiconductors here. And if EWY is going to bounce, I mean, the memory stocks can pull this market higher into another leg here. And we have a few more days until OPEX. Who's to say that we can't have another burst higher and then we chill out and then NVIDIA and FOMC? I mean, that to me is where all the risk lies in this market, not next week, the week after.
Yes. I mean, why not? Why not? If we're going to get a story that says, you know what, money's not going to be more expensive. Okay, yeah, maybe that's not the greatest thing for the U.S. economy, but it's a great story for hyperscalers spending money they don't have. Where are they going to spend it? Korea is a place they could spend it.
Can't believe you're talking to me about Korea. You won't buy the NASDAQ, but you'll buy Korean stocks. Make it make sense, folks, in the chat. Make it make sense, folks.
I own Brazilian stocks for like 2 years now.
But Brazilian stocks aren't the gambler's paradise like Korea has been.
Depends. How do you like Lula's chances versus Bolsonaro's son this year?
I don't really think about that. Ilya, we're gonna have
right, but I do. I sit here obsessing about, is it Lula or Flavio? And should I get out of EWZ or not?
The GV6 contract first, because this is something that we're going to have posted up for the CME 5 futures trade, which you do every single Friday in partnership with CME Group. You can go check that out for trade ideas that are canned. I would say that you're getting a little bit of a sneak peek early preview here. 41 days to expiration, 41.85, 41.80 short put spread here. Why this strike? Why here? Let's see. We're in the GCV6 contract, Ilya, not the GCZ6, which is the default on the platform right now. So just keep that in mind. 42.53 is where our 1 month moving average is. And I want to point to this level right here. That swing high on July 6th, now a test of the 1 month, flipping over, becoming support. So what can we do down there? We actually can bring this up and collect a little bit more in credit in the GCV6 contract, 42.20, 42.25. This is a really tight trade right now. $1.40 in credits, not quite $1.67 on the $5 wide. However, you're still getting $1.50 against the 350. So I'm going to send the 70% probability of profit, a little GCV6 trade to potentially work. And we're going to do a breakdown on that on 5-minute futures, which is literally going to be recorded after this. So go check that out on our YouTube page later today. But Ilya, we are done here. Laura just said we have about 60 seconds left, and I think that was 48 seconds ago. So we'll wrap this. This has been Futures Power Half Hour. New name coming soon. Did you like Too Fast, Too Furious? Our producers really want Too Fast, Too Futures, as the name for this segment. I'm in protest, but you, the audience, has the final decision.
I will protest too, but we're going to get overruled. Watch.
Yeah, we will get overruled. Also, I do appreciate the multitude of tweets yesterday of people comparing me to Hassan Piker and Rachel Maddow, because those have now leaked into my personal life, where people who are unrelated to this job are sending me screenshots of the tweets that people have been sending me. So thank you all.
I want to know why the internet keeps trying to shave parts of your head.
That's our producer, Matt. We're done here. Goodbye. We'll see you after Tim Knight for last call.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
Hey, Tim Knight with charts, and it is the end of the week and the end of our first week with our twice as big chart show format, and it's been fun. Got a lot of good feedback. It's popular, and delighted that Tasty has afforded me the time to spend more time with you and talk about these wiggles on the screen that I've loved all my life. We have a very welcome red day on our hands, not tremendously red, but beyond the fractional losses we're seeing in equity futures, more important to me is the fact that we have a very modest failed bullish breakout. And without charts, I'll just sort of describe what I'm talking about. So over the course of the summer, we were range bound with these wild, wild ranges. And last week, we finally conquered that, burst above that range to new lifetime highs. And then we spent like 6 days just kind of hanging out in that general territory. And earlier this week, we finally got above even that level to yet more lifetime highs. So we had a giant range, broke above that, and this little bitty range of about 6 or 7 days and broke above that. And all through last night, we stayed above that breakout level. But less than an hour into the trading day today, we kind of slipped right below it. Now, again, we're down only, 0.25% on the ES, but it seems to me that there's not going to be any follow through today with the breakout. And so we finally have some red. We're down triple digits, barely, on the NQ. So it's a nice, for any surviving shorts out there, it's a nice change of direction. For my own positions, we've got 25 different shorts. 5 of them are up a little bit today, but 20 of them are down. So that's a good thing. Let's dive into the charts and wrap up this week with some broad items and then some very specific items. Here we have the entire history of the S&P 500 futures. And I went through this in some detail yesterday. But zooming in, we have a lifetime intraday peak yesterday. We didn't match that today. And we're actually carving away some of yesterday's big gains. It's going to take a couple of failures for my beloved bears out there to have any hope. One of them is to crack below this level, 7724.25 on the ES. And that simply will eradicate this little setup we had of this teeny little base I was talking about. We burst above it yesterday, but we got to get below this level. And it seems to be a truism that, well, to go down, we have to go down. Well, there's more to it than that. These are specific levels I'm talking about. So that's the first one. And the second more important one, and the tougher nut to crack, is this lower level at 7629, which is the top of that long range that I've tinted here in this lovely powder blue. So today is a very, very, very tiny failed bullish breakout. This would be a better one, and this would be quite a grand one if we could get down there. I've said all along, I'll say it again, that any real action to the downside, I think, will be relegated to post-midterms. Could be the very next day. But between the election day, which is something like 80 days off, until the swearing in January, there's going to be 2 months of fun, I think, within that. Until then, I'm just trying to pick up a nickel or two in front of the steamroller. But those are the 2 levels to watch. As far as the NQ goes, this is uglier. And I made another video today specific to memory chips that will be rolling out this weekend that talks about that ugliness in that sector. But up until, like, on this day here, the last day of July, things looked real sweet on the short side for the bears. They looked picture perfect. This kind of was a fly in the ointment, and this was the killer. This day right here, August 4. And we cut above this descending trend line, and we've been just pushing our way higher ever since. Today, on an intraday basis, was even higher than yesterday. We're not at lifetime highs, but this has really wrecked this beautiful diamond setup. And it's a shame, because this was just a honey of a pattern until the end of last month. But the thing with patterns, and the helpful thing with patterns, is that they tell you when you're right or you're wrong. Because if you base your bearishness on this, then, well, you better rethink it starting here. And that's why I lightened up when this started happening. So there we are, and it's just kind of a no man's land at this point. It's like, well, who knows, you know? There are varying degrees of confidence based upon the clarity of the pattern. And this is just muck at this point. One thing I think we can broadly count on is that the U.S. Treasury bond market will continue to sink for maybe even years to come, certainly months. We're well into the 7th year of this bear market. That sounds good to say, but this is just for bonds. And I think it'll end when the U.S. does, basically. I mean, this is going to be just a wreck all the way down. So it keeps weakening. We got these sensational, if implausible, CPI and PPI numbers this week. And what did that do for bonds? Well, it lifted them for a day, yesterday. Where are we at now? Lows of the week. So these carefully calculated numbers are rolled out, And the joy and the celebration, the adulation for these is good for a day. And now bonds are selling off again. So the interest of the world of throwing assets of the U.S. in exchange for a pledge that will pay you real soon now, later on, with a little bit of interest, no thanks. So it's I'm short bonds. I'm long TBT, which is the ultra short fund against bonds, and that's up nicely today, more than 1.5%. And the cool thing about this particular instrument is that usually when you look at a leverage instrument, it's just dreadful because it tends to just gobble itself up with its own arithmetic. This could be just like a maker of drones or something. And this is a good-looking chart. This is a bullish-looking chart. But it's not. It's a leveraged, bearish fund against the T-bonds, which I think is indicative of how persistent the downtrend in the Treasury bond market has been. So yeah, short TLT, long TBT. In terms of some big ETFs, the Dow has really been left out in the cold for almost a couple of weeks now. We had our lifetime high on the Dow back on the 5th of August. This shooting star pattern was fairly prescient in as much as it telegraphed that, well, I'm done for now, because for the next 7 days, it's just been kind of tripping lower, even with this insane buying going on, everyone falling all over themselves. You know, that PEs are only 70 instead of 80 now. So down it goes. I guess all the attention is in the realm of more high-tech stuff. So Dow, a severe laggard and making it kind of a bifurcated market. In sharp contrast to this, the small caps, the IWM, is up to a lifetime high. It's going to have a strong close. And this one, let's change this to green because it's really serving the role of support now. So it's got a breakout and it's held that breakout, and small caps doing very, very well. Over in the Middle Kingdom of China, FXI is up 0.16%. That is okay because we've had a nice tumble this week. We peaked right here. So Monday, strong open. Strong open and a strong close. That was Monday. Tuesday, Wednesday, Thursday, and then today, Friday. This is, probably going to take a lot of time, and I've got like 220 days on these options left. So, and to my eyes, they seem crazy cheap with respect to the extrinsic value that is embedded in these things. The only thing I don't like about the FXI options is the bid-ask spread is quite wide. Oftentimes, like the ones I'm in now, is like oftentimes 3.20 by 3.50 or something like that. It's just okay. You buy and you're down 10% instantly if you don't get lucky. So that's not too good. But I think this will work out well, and it's been a bright spot this week. Another item which is intriguing is SpaceX. SpaceX is pretty much going to close where it opened this week. It has held its recovery, and the range that I've been talking about has held true very, very nicely. In simple to remember numbers, 100 to 150. More precisely, it's about 104 to probably like 148. But 100 to 150 is the broad range. We traversed that range in the span of 5 days, and we've been just kind of hanging out in the upper portion of that range for the past couple of days. And as I said, we could be here for many weeks. The day will come that we burst above 150, and I'll probably change that to support. And there are plenty of more unlocks coming between now and December 9. The other 80% of the locked up stock is going to come free, with the exception of Elon's. My recollection, because I actually went through the S1 on this thing, my recollection is that his shares are non-tradable for until a year after the IPO. And I suspect he will hold on to them for a long time. What else is cooking? Well, let's look at crypto. That's been another bright spot this week for Mr. Last Bear on Earth here. Here's Ethereum. I'm not trading this or anything, but I think it speaks well to the exceptionally perilous position that crypto is in. There was a time when this was the cat's pajamas. It was just sensationally ascendant, and you remember the crazy predictions for how price would go. Those fellows have settled down in recent days about those predictions, although the videos are still there. But what's happened is that we've got this trend line, which we cracked here, and this goes back to my old notion about roll switching. So this changed from support to resistance. Down we go, down, down, and then climb, 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 climb. Resistance, resistance, resistance. You are not going past this line. And so that's what's been going on there. So it's been clinging to that level for about a month or so. But I imagine that in the weeks to come, that will loosen up and it will succumb to gravitational forces and fall away from that line farther and farther and cut below into new lows for the year. My focus instead, though, is on Bitcoin, which, God bless it, has been quite weak this week. You can see here, we peaked at 65,401 in the cash market, and we're presently at 62,843. So let's call it about a little shy of $3,000. That's not much. That's like not even 5%, but I'll happily take it because assets tend to move together, bonds notwithstanding. And in spite of equity's ceaseless insurgency, Bitcoin is just sort of bumbling its way lower. And the point I made this morning was if and when the happy day comes that somebody actually sells a stock and we get more than a 0.1% decline in the equity market, I think you'll see Bitcoin really start to sell off. And in fact, I think Bitcoin is going to lead the way lower. So I did do a Bitcoin video, which is out now. I encourage you to watch it. Because like I said this morning, I don't trade it, not directly. I've never owned any Bitcoin. But I still think I watch it religiously 7 days a week. It's a very important part of the financial landscape and getting the sort of zeitgeist of risk on, risk off psychology. So check out the video. I think you'll like it. The items that I made mention that I have three positions in this respect. I'm long BITI, B-I-T-I, which is the bearish fund. Actually, might have four positions. Yeah. And I'm short MARA, Marathon, M-A-R-A, which is kind of sloppy. It's kind of a B-plus pattern. But in prior instances, these tops have yielded good results. Oh, there's one I didn't even bother painting. Let's just fix that. Like so. And this is the most recent one, quite a wide one. And we're breaking down on this. So down not quite 1% today on MARA. Also short Michael Saylor's strategy, MSTR, which is down nicely today, over 5%. And that is a honey of a head and shoulders pattern right there. I would be thrilled to see this cut below to new lows for the year in the weeks ahead. That would be down about $10 more from here. And that would just, I think, set off a cascade of sell orders if that were to transpire. This is just kind of a different view of Bitcoin. This is IBIT, an ETF to trade Bitcoin. This is a +1 correlation as opposed to BITI, which is -1. And you can see that it's looking pretty ill. What else? Well, we're on digital gold. Let's go to gold. Here's GLD, up a little bitty bit today. We zoom in, and it is a hoofy beast. It's refusing to really fall with any meaningful gusto. It started to fall hard last night, but it recovered from that. But the pattern is still absolutely intact. This bearish pattern, this right triangle top. It would need to, if you're looking for a bullish signal, if we cut above this 409 level, that would be a buy signal, I think. And I'm all for it. Love gold. As it is now, that is resistance. The descending trend line denotes resistance, as does that price gap. So think of the cleaner, 409. That's the level that would need to be exceeded. Otherwise, I think it's prone to dropping back down into this thicket of trading activity. As far as its younger brother, silver, SLV, same setup, same trend line, not a price gap, but the same right triangle pattern there. So both of those are worth watching. I actually covered for a smallish profit this morning my GDX, my short. I guess I just feel kind of like I'm betraying the metal to continue to be short that. But yeah, I took profit on that. XME also got out of. But of the two, if one were just dying to short one of those for the weekend, this is, I think, the preferred one with a stop at, let's say 119.75. I think would be a sensible stop loss level. But I think it's much more prone to a descent than GDX. Since we're heading into the weekend, and you know what the weekend means, Iranian chatter, and we've won, and they haven't won, and yes, we did, no, you didn't, and crude oil and all that. Here we have CL, and it's kind of stuck right now because there's not a lot in the way of change going on. It's just chatter going back and forth. So we're kind of seem to have reached a happy equilibrium in the lower 80s. But I will note that I made mention yesterday about XLE and sort of sheepishly said that it was a bullish breakout. And that seems to be following through because XOP not so much. It's not as clean. This one's quite clean because we had a big burst here, which tagged the trend line. And look at this. 1, 2, 3, 4, 5. It's not like the count. 5 green bars over the course of the, that's the gap right there, over the course of the week. And closing at not quite a lifetime high, but we're getting kind of close. The lifetime high was back on March 30, of course, and that was at the this whole run up here, which was, there's not a downtick in sight. This whole run up was because of that's the funny thing as I look at it right here. This was the war itself kicked in right here. So isn't that interesting? I'm just kind of glancing at this. This was in a very strong bull market before that weekend announcement came. So, kind of cool. Maybe XLE anticipated this war better than any news did. As is often the case with charts, they can sniff out stuff before anybody's talking about it. Anyway, that's XLE having a good day there. Over in Techland, we've got the cubes, which are down about 1/3% on the futures. It's down 101 points right now. And these are a ways away from lifetime highs, which are right here. If any fellow bears are out there, there's 2 levels here that are our friend. And they almost to the penny are the same. One of them is this prior price peak. And this is kind of the last man standing. This peak right here at 737.62. Be nice to stay below that number because that was the most recent lower highs. In other words, record high, lower high, lower high. We want to have another lower high. We don't want to exceed this. And the other one, which lines up beautifully, is this descending trend line. You can see how those two just match right there. It's like the apex, bang, right along that level. It's nice we're seeing a little weakness today. At least we're going into the weekend without yet another breakout. Although it looked chancy this morning. Things were quite strong, as you can see. We were at the highest level today that we've been since the beginning of July. So a good 6 weeks there have transpired since we were at levels like this. Semiconductors, always important. SMH. This one we peaked, hopefully, yesterday on this. We're starting to slightly turn away from these levels. We can call this the Tim Dumps' SMH puts peak. I think that's how it'll go down the history books. So I hope you were paying attention because that was a great signal. And so it's reversed away from that, and we'll see if it plunges or not, at which time I shall mention it ruefully on a daily basis. But that's SMH. I have a simple short position in SMH, and also for no particular reason in SOX. They're virtually identical. I didn't even know there was such a thing as SOX, but I've been reading. I'm now a paying subscriber to Michael Burry's Substack, and he's got a bunch of, I guess, March socks puts, although he's been pretty PO'd by what's happening too, for obvious reasons. But yeah, socks, I lined them up, and it's just almost penny for penny. They're pretty much the same. Let's pick up the pace, because Mr. Blabbermouth here loves to pad his time, so I've got 7 minutes left. Let's get cooking. Here's some short positions I just wanted to share. Bloom Energy, BE, having a nice day there, down 3.3% away from, and this shows, again, here's the pattern. We did violate this pattern to some degree, but this was easy. Had a lot tougher time here, and now it's starting to wheeze and cough its way lower. Cracker Barrel, CBRL. This one had this insane recovery, just exploded higher. It bottomed down it more than doubled, actually, looking at this. Way more than doubled. But I shorted that yesterday. It's starting to turn south a bit. We're down about 2% on Cracker Barrel. Salesforce CRM. I think I mentioned this this morning in the segment. I've set my stop on this quite tightly at today's high. So this was a new short this morning. So that's down about 2.5%. Also mentioned this one this morning, Intuit, INTU. The price gap here being the basis for the trade. And that's open strong and it's trading weak right now. I got to thinking about all this because of my work day, WDAY, stop out yesterday that I spoke about, and the value of stop loss orders. And I looked at other SaaS type stocks, and they've all recovered for many, many weeks, but some were really appealing on the short side, and those were a couple. Another one which has recovered to the point, I'd stopped watching this a long time ago because it had fallen so much, but it's risen so much that it became interesting again. Blue Owl, OWL. And Blue Owl, as I understand it, is one of the most important financiers for the hyperscalers. And from a charting perspective, I think there's a couple of things going for it. First of all, it has in the past had this darling little head and shoulders here, which produce really good results. So that's kind of a nice sign to see that it's sort of intrinsic to the nature of the stock to heed these things. This is a much bigger pattern than this little peewee over here. So this is its much larger descendant. But the thing is that Blue Owl peaked in early 2025, I guess, for whatever reason, before any kind of concerns had crept in about hyperscaling. They got up to around 25. They fell dramatically down to about a third of that level. And then they've recovered mightily. And they've burst higher here. But like I said before, this is kind of the easy part because there's very little to cut through. Get up here, though, and there's this horde of Visigoths just waiting. They've all bought their shares and they want to get out. And the closer you get to those price levels, the more eager they're going to be to click the sell button. And that has finally started turning this thing around. So I like I said, I don't know if I've ever even traded this before in my life, but I've always liked the chart. But today, early, I shorted Owl, and it's down over 3% right now. And that is a huge pattern. One more of these individual ones, Astra Labs, ALAB, down 1.33%, a much younger stock. As you can see in the chart in front of you, there's 3 topping patterns, each of which is produced, or the prior 2 which produced good sinks below that. So we'll see if we can do it for a third time. In the time remaining, I just want to thumb through, I've got these crazy economic charts with crazier symbols still. I just want to kind of give you a taste of these. No real conclusion. None of these are tradable. I just wanted to kind of share with you some exceptionally long-term charts. Some of these go back before anybody watching this has been born, in some cases. So the first one, labor force participation rate. This is essentially how many folks out there who are in a position to work are actually choosing to work and are employed right now. It's never been like 99% or something. At its peak, it was, well, this is the peak right here. And this was back in the beginning of the millennium. And we got up to around a little over 67. What the other third were doing with their time, I have no idea. But as you can see, we've had a very dramatic fall Nominally, it's not that big a deal. It's gone from like 67 to 61. But that is still about 10% for the whole. And it's kind of fascinating. And it too had its own little head and shoulders top right here. So see, these patterns work everywhere, don't they? It's actually kind of fascinating to me that it did this. But yeah, labor force participation had this topping pattern, and we've been falling ever since. And I imagine it'll keep falling. Maybe AI will have an outsized influence on this too. These are basically homes being built. How many total units? This is a 5th rounded top on this one. Seems to me likely that this will fall a lot from these levels based upon history. CPI, Consumer Price Index. Spot the trend. Ever since 1938, it's been doing nothing but go up, and lately it's been going up exceptionally fast. Savings rate, not so good. After the COVID checks were thrown around, the savings rate went crazy because a lot of people just like, cool, and just throw it in their savings account. I'm not going to spend it. These days, though, it's just plunging. And back in kind of more temperate times, the savings rate was very persistently in the like double digits, even the mid double digit, like in the teens, the mid teens. These days, it's like 2%. So this is falling hard. How much people sock away. This is a chart of how many the total assets the Federal Reserve has gobbled up. The areas of green are those brief eras where they've actually backed off some and sold some of their holdings, but you can see the broad trend here. We've gone from relatively sensible times to trillions and trillions and trillions of dollars to attempt to prop things up. And that's part of the reason we're 40 trillion in debt. This is the SOM rule recession indicator, which seems to project ain't no recession coming. Although when it does, as you can see, it comes really, really quickly. This is like standing in the middle of the road and say, I'll let you know when a car is on its way. Then you see the headlights. And then this is also Federal Reserve data here about the Treasury securities they own. So they've been buying them up again. Anyway, just to close up, bottom of the hour, there's the spider. And we are a little bit weak today, but it's going to take a lot of selling to break the bullish victory that we've witnessed the past couple of weeks. So that's it from me. Swing by Slope if you want to say hello. Otherwise, I'll see you here on Monday. And thanks for stopping by. Take care. Bye-bye.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Welcome back. You're watching Tasty Live, final 30 minutes of the trading day, final 30 minutes of the trading week here on this Friday. I'm Chris Vecchio. As we go about this week, we've been bringing on these guests to bring us through the final minutes of the trading day. We're going to do that in just a few minutes here with Ben Sturgill. He's a decades-long options trader who brings a wealth of insight and some trade ideas here, perhaps, to the program. Before we bring him on, though, quickly, we take a look around the market right now. S&P is still trading a bit lower here by, we'll call it 0.25% right now, 18 points or so. The NASDAQ, it's off around 88 points. That's 0.3%. Your Russell is up by 0.4. So broadly speaking, one of the themes we've been watching this week has been that breadth improving. RSP is sitting at a level where another penny or two, it's going to be a new all-time closing high. All eyes are on the oil market again as we go into this close because we've had a little bit of a bounce here. It's up nearly $1, a little over 1.2%. And with that coming up, we see that bond prices have come down. Yields have actually been moving higher steadily at the long end of the curve as a result of today's session. Maybe it was the retail sales. Maybe it's just folks paying attention to oil. But the big news for today are the semiconductors, which is why we're bringing on Ben Sturgill here. He's a veteran options trader who spent roughly 2 decades in the markets. He's kind of like me. He has a bit of an unusual options process where he also uses technical setups and momentum to identify trade opportunities. So this is a conversation where it's going to sound like maybe two people in a mirror speaking to one another. So apologize to the audience for that ahead of time. But we've seen so much of this aggressive call buying come through right now. And I want to bring on an options guy who can talk us through it all. Ben Sturgill, welcome to Last Call.
Thanks so much. Thanks for having me, Chris. I really appreciate it.
Thank you for joining us. So let's just start with the semiconductors because the price action on the options activity this week has been absolutely extraordinary. SanDisk itself is more than 70% off the lows that we saw just a few weeks ago. I guess only 62% right now, if we're going to be fair about it. But we're also getting weakness in names like Applied Materials and Broadcom. So when we look at all of this flow around the AI infrastructure trade right now, how is it making sense to you?
Yeah, for me, I still think that AI, that semis, that capacity for CPU is going to continue to be a narrative into the future as we build out more data centers, as AI becomes more of a regular part of our life. And so, what goes up must come down. I see, the chart here in semis, and what we see is that, as you can tell, even from your moving averages, the 5 is starting to cross there back above the 21. And so we're starting to regain some of that structure. And I think how much of this came down to that pullback with the unwind of that massive, hedge fund, or whether it's, just kind of the summer doldrums that we typically see. But
what do you think of that? Don't mean to interrupt you, but I'm a believer that situational awareness is unwind all these South Korean levered traders getting taken out in a cart. That was a really important episode for the market to kind of recollect itself.
Yeah, I couldn't agree with you more. I mean, anytime you see the kind of parabolic move, I mean, I was in SOXL, all the way back in April of 25, and that went from $8 to $300. That's a pretty significant move with a technology that is only becoming more and more necessary and more part of our lives. And so, as I said, what goes up must come down, but I don't think that narrative is over. And I think that's the unwinding, as you mentioned, of the Korean traders and several others that were just over leveraged and late to the move.
I mean, the market loves hunting these names right now. Why hasn't Bitcoin bottomed? Maybe because Michael Saylor hasn't been taken out yet, but Bitcoin bottomed when Sam Bankman-Fried and FTX went under. I mean, it was literally the day. We saw this with MF Global and the European yields. We saw this with long-term capital management. I mean, this happens in the market where we hunt levered names.
That's right. Yeah. I mean, to speak specifically to Bitcoin, I think Bitcoin is so, tied to liquidity, and with interest rates and all the question marks that we've had about that of late. I think that when you see M2, global money supply really start to push, and you see the money printers go burr, whether it be through any of the mechanisms that the government has to be able to put that money into the system. It's a 90 vol asset. It's a risky name, and when people have more cash to put to work on those risky names and money is ample, I think that's when you're really going to see Bitcoin make that turn.
So we've had a pretty calm market here throughout August. Volatility today, we could just pop out to the VIX, or we could go to VIX futures here. But VIX is sitting at 1430, which will be a low close for the year. Volatility futures for the September expiry, it looks like this will also be a low close down at 1790 or so. But next week is VIXpiration, right? Wednesday, or VIX expiration. I like to shorthand it. And then we have the monthly OPEX up next Friday as well. Is this going to be a clearing event in your eyes? There are a few folks like myself who are looking to NVIDIA and then FOMC the week after in Jackson Hole and wondering, funny that these are all lining up one after the other.
It is curious, isn't it? I've been looking at Jackson Hole for a while because I think that we're starting to get the data that Warsh needs to be able to hold rates or even drop them. And so, yeah, I mean, anytime you got, VIX expiration and OPEX, you're going to see volatility because market makers are going to be moving things around in order to be able to make the most people cry possible. And so, yeah, I definitely think you're going to see that volatility come back into Vixpiration, which I like that word. I'm going to steal that and use that, Chris. But it's one of those weeks that you can just pretty much expect fireworks in some degree. But then I think after that, once this narrative about our rates going up or going down, whatever we hear from Jackson Hole, and then certainly into the FOMC announcement in September, I think we're going to see VIX stay down here as long as there's no new Iran news, personally.
So when I'm taking a look at something like SPX over the next few weeks, going through the end of the month right now, I'm looking for big concentrations of open interest here on either the call or the put side. I'm not seeing too much of anything that suggests we're going to find some magnetism to a particular level. But when traders like us mention things like that, like the big pockets of open interest in the market and a stock and index getting pinned, do you use any sort of that information to inform your views, or is that just noise distracting people in these markets?
No, it's, I'm glad you brought that up, Christopher, because I gave my traders a trade, after the CPI, I look at historic data to see, what the market tends to do in the 3 sessions after, whether we come in line with the CPI data, whether it's a hot print or whether it's a cool print. And there was a 71% probability based on historic data that there would be a spike up, a pullback. And I was looking to buy the SPY on Wednesday on that pullback. And it came back down right to that level where there was heavy concentration at 772 for the August 14 SPY calls. And it came back, it held that level at 772, 773, and then it bounced back up from there. That was the perfect level to be able to take that play from, and we took that trade off yesterday. So yeah, I definitely use those levels because market makers, they're going to defend their positions if they can.
They are. So you mentioned in the pre-notes here that you had some ideas that you were looking at. There were some charts that intrigued you. You're a technical guy who likes to use the options overlay to try to figure out the best, way to express your particular view. One of those names that you mentioned here was FCX. I've had my eye on FCX for a little while here, in part because copper has just been so dang strong compared to gold and silver in recent months. It didn't really have that 50% decline from the January high like silver did. But what are you seeing in FCX right now that you think may be opportunity in the option space?
Well, you can see the flat top right across the way on FCX, so it can't seem to kind of break that 70-71 level. And then every single bottom, including, the last 3 have been higher and higher and higher. And then as you can tell from those, 3 moving averages that you use, it has positive structure. It's got the 5 over the 21 over the 50. And so from the technical level, I like these names on pullbacks to support at those moving averages or previous support. And as you can tell right now with FCX, it's coming down to that previous swing high. And so that's one reason I like it. Another is that, I've seen some options plays come through on this, particularly the September 18 $70 calls. A few days ago, we saw $1.1 million go into that particular name. And so, I would love to see FCX come back down if it can, and hopefully find some of that support kind of right there as it did already today. This was a trade I was looking at right around that 65.50 level. It bounced very nicely off that level today, and it's made its way back up here to close above 66.50. And so that's usually the combination I tend to look for. But I will say, Chris, if I might add, that copper is a massive metal when it comes to building. And with all the data centers we have coming up and all the electricity that's necessary, it's also, not just a gold or silver play, it's a utility play for the need of that copper to build out all the electrical that goes, into that, AI CapEx expenditure that we continue to see coming.
So it sounds like you're treating FCX primarily as like a macro copper trade rather than an individual stock view at this point in time.
Well, I think really it's a convergence of both. Anytime I can see, what you're showing there on your screen in terms of, that upward wedge, and then I believe that there could be those wins behind it of the larger macro copper play, to have both in play. That's really what, my favorite type of play right there, because I think both can support it.
So in your flow scan, you also mentioned that HPE, Hewlett Packard, showed up. This has also had a real nice run here over the past 2 or 3 weeks. And like so many of its counterparts, it did have a little bit of a comeback in June, but the uptrend here remains. It has not put on a close below its 50-day, I believe, since late March at this point in time. So when you talk about momentum, this looks like a candidate.
Yeah, again, in a market like this, I just like to play bullish names in a bullish way and look for a good risk reward entry on these. As you can see on HPE, since July, this has really respected, the 8 EMA. Every time it's come back, it's bounced. That just tells me momentum, momentum, momentum. And so every time it wants to come back to that 8 EMA and continue that momentum, that I think gives me a pretty good risk reward to believe that it's going to continue to trend until it doesn't. And so, for me and my traders, we were looking at HPE on Monday, and it was above that 8 EMA. We were waiting for that pullback. It happened on Tuesday. We entered right around 53.50, and we're shooting for above 60, and thankfully got it yesterday to take off the trade. So I bring this example up just again show you those are the type of names I look at, that when it's positive, it's strong, and it's likely to just continue in that direction. That's when I just identify the best pullback areas for a good risk reward.
Sure. I'm just taking a look at HPE right now. It's Friday. You got to go to 14 days, and the earnings are at 20, a little past 21, well, actually 19, if they're September 2nd. What's the expected move for the expiry right on the other side of those earnings? $8.60. Ben, I'm seeing something here that I kind of like, because you mentioned that this market has positive momentum. There we go. A little bit of a shelf near 52 with our 1 month rising through there. And that's just beyond the expected move, is catching my eye right now. So is there something that maybe we could put on here for the follow page? 51, 52, 50, 52. Yeah, I think we could put this on the follow page here. Put this on HPE. We'll get that filled, confirmed, and sent. All right. And then Amazon here. I approach the market the same way. Every morning I start my day with a little technical scan. Find me something that's below its 1 month, but above its 50, above its 200, or vice versa for a sell the rip. And these things are fitting the criteria like a glove.
Amazon was a great example of that. I mean, once this thing exploded after earnings, you see the massive gap from the low at about 225 prior to earnings, and then it ripped all the way to almost 290 a couple Mondays ago. And one of the ways that I tend to measure moves in the market is through the ATR, the average true range. Sure. This was at about a 3+ ATR. And anytime I see something like that, again, just through historic data, the probability of that continuing above that is pretty slim. So I love that idea of selling the rip. And that's exactly what we saw. We saw this thing come back down from that level. And I'm waiting to see if it can come back down, into the 260, 265 level to give it a much better risk reward. As we saw from the earnings announcement and from, the follow-up press conference, AWS is booming. And so I could see this thing start to come back down. I wouldn't want to necessarily start to see it fill the earnings gap that it left, but if it can hit that 21, and start to show some reversal signs from there, I'm looking for Amazon all the way out into November for, maybe even 310 calls for November 20th, because I saw some pretty significant options and open interest in that zone, and it gives it plenty of time to do that, out into the future. Now, that gives me a pretty good risk reward, because if it starts falling into that gap, I can cut that trade pretty quick. But again, a really strong name, just kind of coming back down to previous support where it was a swing high from all the way back in July. And yeah, even spreads on that, I think, could make sense, going into the fall.
It's interesting because I was in a double bull. We call it a double bull, a super bowl around here, where you're short a put spread, long a call spread, kind of adding a little bit more convexivity to a trade here. And I had a nice one working in Amazon. I've been looking for the next leg of this, quite frankly, and I've been hoping for a little bit of a pullback, because I think you and I see the market very similarly here. A recent pivot high that's kind of right around that 1 month moving average. So if on Monday, I'm not really super keen on putting trades on Friday. If I see something I really like, I will. But if on Monday we're down maybe another $2 or $3 and we start to hold and we go down to that 1 hour, 4 hour time frame and get some basing, this is the exact candidate that I'm thinking about rolling this out again. And then I like what you're saying here, looking at near 300, 310. There is a lot of open interest there. 20,000 at the 305, 9,000 at the 310, 10,000 at the 300. And so right at the expected move here, can collect 27 cents of credit, selling the put spread, getting along the call spread. So I want to keep that in my pocket here. But I do have one question about Amazon, because the names that you showed me here today, we had a 38 IVR in FCX, we had a 58 in HPE, but there's only a 10 in Amazon right now. And the raw volatility is they're only in the 20s or 30s here right now. So when you see that differential, that low implied volatility on a relative basis, does that influence your trading style or how you structure your trade?
100%. I mean, you can never forget the expected move, because the expected move oftentimes can tell you, where the market makers have kind of priced, their top and their bottom. But again, Amazon on that breakout from earnings kind of crushed through that expected move. And that's where I just think that there's a lot of people that go back and watch that and say, hey, I missed it on that initial breakout. It's a name that is so intricate to the market. I don't know if you remember a couple months ago where AWS went down and it felt like half the East Coast went down. And so, they're so intricate to this. They're already turning that AI CapEx expenditure, into value for them through AWS, and they're building all these data centers for clients. That for me, there's times like that where I always take, the implied volatility, in mind. But after I see a tremendous move up after sentiment like that, I believe that there's going to be remaining sentiment, especially in a name, that fits into the, what are they calling it these days? It was the Mag 7. Now is it the Mango 8? I'm not quite sure. But it's a well-known name, and it's a name that I think you'll see a lot of folks that when it comes down to more viable level, will want to get back in. So I do pay attention to those. In fact, kind of what you were describing before in terms of, going back down to the lower time frames and finding the basing, that's exactly what I do to look for that reversal. And that's where I tend to, give Amazon a little bit more credit because of its, recent earnings and announcements afterwards.
Yeah, you mentioned the Mag 7, Mango 8, Mag 10 here, the CBOE's Mag 10 index, which kind of feels like it's persisting near the highs. It hasn't broken out yet, but you can see how it's taking those little technical steps forward, new level, consolidating, digesting momentum, not giving up gains, even though time is passing. So I'm with you. I'm looking at, I remember last year, Ben, you turn on CNBC or Bloomberg, and they'd all say, how can this market rally? It's only the Mag 7 names. And now this year, the Mag 7 names aren't really, until recently, they weren't doing anything for the broader market.
That's right. Yeah, that's right. I mean, I think we saw other names really carry the weight, even though these names are so heavily weighted in the indexes, especially the QQQ. And we, again, what I saw happen in April and May was really just a market that was over leveraged to the downside. And then once that break, happened, there was a lot of people playing catch up, which really pushed it higher across the board. But as you can, tell here, we still don't have all-time highs yet on the Qs as we did on the DIA, the Dow or the SPY. But these are names that I think that once we had other names carrying the weight, I think we can get back to seeing some of these names, do that trick moving forward, especially if money becomes cheaper, and we get news around the Fed interest rates, whether they're going to hold or whether they're going to drop.
He's been Ben Sturgill. He's a veteran options trader. You should definitely check him out. Find more of his. What's your social here, Ben?
At Ben Sturgill on Twitter, or The Real Ben Sturgill on YouTube. You can check me out there.
There you go. Go like and subscribe to his channel. Ben, it's been a pleasure. Hopefully we cross paths again soon.
Thanks so much for having me. Appreciate you, Chris.
Ben is now done with us here today, which means we have just about 10 minutes left to this market close. I like when the producers book someone who brings on an easy conversation, someone who sees the market and the world the way that I do. Confirmation bias is fun, isn't it? And it was good to have a friend here because now there's no one else, which reminds me, producers, good time, refer a friend, grow your trading community. This is so much better to do with people who are also on the same wavelength as you, right? Your friends, you watch baseball together, you go to movies together, you trade together. All right, tastytrade.com/refer a friend, tastytrade.com/refer a friend, $100 for you, $100 for them. And everyone can start trading together. But let's get into this end of day market right now. I'm just going to run down the futures board here because you have our S&P 500 off 16.75 points right now. It's a little bit of a loss, down by 0.22%. NASDAQ down by 0.22%. That's 65 points. And is it still breaking out? That's a good question. It feels like this market is trying to hold above this key level right now near 30,000, 30,050. We'll see what the close gives us. But those swing highs that we had throughout July and even here at the beginning of August, they are beginning to break. That August swing high was 30,074. Through there to close on the other side. One of the things I'm watching then, because of how these charts are shaping up, would be thrusting the NASDAQ to all-time highs once more. So I haven't put on many trades here today. I really don't like putting trades on Fridays, but with Vixpiration coming up and maybe, just maybe, a little bit of squeeze potential here to the upside, a move into a new all-time high here for the Nasdaq would only require 748. The expected move for the next week is up to 742. Looking for a move back to the all-time high during Vixpiration week if we wanted to be really cheeky about this with like a call butterfly here. Let's actually reverse that. We're going to go all this backwards. We're going to buy the call here. We're going to sell the call here. We're going to buy this one here and double the middle strike. 23 debit for a potential gain of $3.77, 10% probability of profit. Not great trade, but the market seems to be running up towards the highs. And I want to have a little sweetener on the top here just in case it does continue this extension. 7 days to expiration, the call butterfly there, 744. I'm doing a lot of just trade management, and that is another egg that's going into the long equity basket for me here because the market continues to run. I'm very much with our prior guest there, Ben Sturgill, the options trader, who joined us here for the last call today. When we talk about a market structure where it looks bullish and becoming more bullish, momentum is starting to improve again right now. And yes, in the short term, you're looking at a market where there's no trading volume. I think for today, we're going to get to not even 800,000 contracts traded. But for longtime viewers of the show and been watching Tasty Live, you know my view during the summer months: low volume, low volatility, positive technical drift. It's a good day to go to the beach, which I think I'll be going there after this, in fact, because all three of those conditions are met. But that's why you stay long. If the market's going to be boring and scratch and claw its way higher, who are you to say that you should be shorting this in size? I'm not. And our data shows that when the VIX is below 15, you get paid more in terms of average daily returns and lower standard deviation of those daily returns by simply being long the market as opposed to trying to sell straddles or stringles out there. So I'm going to stay long the MES. I've likewise received questions on how I'm managing the ES87 position. If you missed futures hour, half hour earlier, which we will be changing that name. No, I haven't done anything with the longer standing 8,200 call spread here because we haven't reached the long strike yet, and there's still 139 days to expiration. But my game plan is, especially if this happens in the next week or two here, I may think about structuring this where I get out of the full thing. I buy two 8,400 calls, and I sell something like an 8,600 call as well. I think the market's going to keep squeezing higher here. We just had a slingshot quarter. What's a slingshot quarter? Our friends over at Carson Research, Ryan Detrick, allows us to share some of his charts here on the show, encourages it even. And he's pointed out that for the second year in a row, and now for the 18th time, in history, we just saw back-to-back quarters where the first in the sequence was negative, and the second one was positive by 10% or greater. 16 of the past 17 occurrences have produced a market that is green for the next 3 months, for the next 6 months. And where does that bring us? If this is the 17th of the 18th occurrence here, we should be looking at a market that has maybe another 10% of history as any sort of guide, given what's happened in those 16 of those 17 previous occurrences. So for me, the market's trading around 79.40. What's to add something in like the 5 to 7% range to the upside is a little bit of a sweetener, longer term, out of the money. It makes sense from how I sit. So I'm not really looking to do much of anything else, but we talk about this close here. What's been the winners? What's been the losers today? We head over to our sector leadership board. It's been your semis by and large because SanDisk has been just such a monster again following their investor day yesterday where they unveiled a new line of products that are specific for AI inference. There you go, 1633 here. The low that we had on July 29th was 998.19. I certainly took my lumps in July, holding on to long semiconductor positions. Got assigned a bunch of stock in SMH, which we've been wheeling out here on the follow page, assigned at 615. I've been selling the 630 calls against it, now in the second leg of that. So continuing to reduce the cost basis and allowing the position to work more in our favor. But the general thrust has been, this is a market where semis have been making their way to the upside, and momentum is starting to come back into the equation here. We're no longer treating the moving average envelope as resistance. It's becoming support, and volatility is getting drained out. IVR in the lower panel there on the platform. IVR is getting drained out of this market as we're beginning to stabilize. Why does that matter? Volatility can go up if people are buying a ridiculous amount of calls. And we talk about all the additional leverage in the system thanks to over-leveraged South Korean traders or Leopold Aschenbrenner situational awareness. The call buying stopped, the volatility came in, the stocks went down. And now they're rebounding with the volatility coming back in, even though that aggressive, perhaps tail wagging the dog situation has ended in the short term. So broadly speaking, this has been a constructive day. It's been constructive no matter where you look in the semiconductors. You can go to Western Digital, you can go to STX, pick a name out of the hat. Applied Materials is still struggling a bit after its earnings report because no one was really a fan of their guidance. But it's a space where overall today has been a pretty good day if you are in the semi arena. The earnings next week is the next question right now on the board here today as we wind down this session. Next week is going to be a pretty dry one. So if you thought this week was boring, I regret to inform you that next week may be a little bit worse. There's nothing that's going to move the NASDAQ to the degree that we saw this week, last week, or any of the prior weeks. But there are some more consumer-facing names that are coming out. And as we know from today's retail sales data, the consumer may not be doing that well. Sentiment-wise, they're in the tank. It's not fantastic. Tuesday, you're going to get Home Depot earnings. Home Depot here trading in today a little bit weaker, down by 1%. But likewise, for that 7-day to expiration, we're looking at a $13.34 move, which means if today, before the close, you were to put on a short iron condor position, we'll just call it $2.50 wide on the strikes, just on the cusp of the expected move, you could collect maybe somewhere in the neighborhood of $1. Let's take a look at this. Maybe this is a trade. 352. Might want to go a little bit higher or lower than that. Might want to go a little bit higher or lower than that. The recent swing low is in that 323 neighborhood. The recent swing high is up at 358. Could we do this? That's not really paying here. All right, we're going to give this a little bit more room to the upside, but at 54 cents credit here, I kind of like this. It's not a third of the width of the strike. It's a Friday near the close. I'm not putting it on. Tuesday, what do we have? TJ Maxx, Lowe's, Target. Those are all going to be on the board as well. Consumer-facing names. Decent implied volatility here in the 60% threshold when you look at Home Depot, when you look at Lowe's, when you look at Target, 50% or so for the expiration cycle for Lowe's. But that really has been this week. This week was a quieter week. This week was really about the semiconductors bouncing back. It was about tech stocks finding continuation. Those Fed hike odds coming back in, and stocks are able to breathe a little bit more. But long and bonds are still going up. Oil has not given up the gains just yet. So while we are closing down this particular week in this particular session with an S&P 500 trading in at 78.05, there's going to be a lot more for next week as we get through Vixpiration on Wednesday and, of course, monthly OPEX on Friday. We have NVIDIA earnings that following Wednesday, the 26th, and then Kevin Warsh's speech in Jackson Hole on the 28th, 2 weeks from now. So the period of the dog days of summer might be coming to a close, folks. Enjoy it while you have it. Tasty Live programming is going to take a brief break. We don't work all week long. We do get a little bit of time off on the weekends. So we will see you in 49 hours and 55 minutes. First call begins on Sunday at 5:55 Eastern, 4:55 Central Time. So be sure to join us there. Ilya Spivak will be hosting. I may or may not be the second host. We will see how that all pans out. But either way, hope you have a nice weekend. Good luck trading, and we'll see you on Sunday night.
What's up, Tasty Nation? Welcome to the show. Happy Friday. It is August 14th. We've had a slew of earnings this week, mixed bag of results, some up, some down. And the E-minis and NASDAQ have ripped a little bit higher to end the week here. My name is Mike Butler. I'm here with Jermal Chandler. Join us on the YouTube chat. We're streaming live there. We can check out your trade ideas, questions all morning. Jermal, how you doing? Got any fun plans this weekend?
Heading up to northern Wisconsin, actually. Today, just to hang out one last time before things get cracking here. I mean, it's school time for the kids. It's fall time for us, where I imagine things will get busier than they have been last week. But yeah, that's about it. What about you?
Not too much. Maybe playing some golf, but it looks like it's going to rain all weekend. So
I know, right?
I might just be a shut-in and do nothing, do some housework. Who knows? Who knows? But hopefully my weekend is a little more vibrant than this trading week we've had, which has been crazy. Just narrow ranges every day. And then yesterday I had that big pop and then a little bit of a drift lower. But we've basically gone nowhere in the E-minis this entire week, other than just ending at the highs from their trading sessions. It's crazy.
Yeah, for sure. It's been mostly a quiet week until yesterday, which was a pretty big move. It seemed like it was the sort of blow-off top situation. I shouldn't say blow-off top, but it was sort of the blow-off move to the highs after inflation didn't seem to scare anybody. We got retail sales, which is probably hitting the tape right about now. And as long as that's not negative, I think it clears the way for the market to continue to drift higher. I did have a Super Bowl that I took off yesterday. It was for today. I put it on 2 days ago for that same thinking. I was like, well, it seems like nobody's scared of inflation, and retail sales will probably end up being positive as well. And we'll just continue to reach new highs.